Hi, this is Jim Francis. Well, if you're getting this video, it means that you were at the workshop on October 17th, 2020, went through how to learn how to trade, or you were scheduled to be at the workshop, and for some reason you couldn't make it, so it was an action-packed day. We talked about the markets in general, we talked about how to protect ourselves and how to make money on the upside, a little bit about on going sideways with respect to it. We learned a little bit about stocks and picking stocks, or whether we should pick stocks or not. We used some systems that we got familiar with or were introduced to, whether that was the canceling system, William O'Neill, or whether that was, Warren Buffett's 7 steps. We went through kind of 6 of them and went through the 7th one in kind of detail, which is the dividends. And from dividends, we went into Dogs of the Dow, which is a great system that since 1973 has earned about 17.7%. We also talked about the 4 keys. We talked about when you're thinking about a stock, you want to make sure that fundamentally it's correct, that technically it's correct, that there's insiders buying it and it has good valuation. So we actually had a tool we can use, iVest Plus. So we used that tool to kind of pick those stocks. When we talked about a little bit about Dogs of the Dow, that system that does 17.7% or 21% since 1973, we talked about putting that on steroids, by renting out the stock each month, which is a strategy called, covered calls. So we went into covered calls. We looked at the math of covered calls, earning that 1% a month and strike price. And we talked a little bit about stocks and the average price movement to give us hints as to what our target price was. And then we talked about, reward, risk, and probability. To kind of learn that, geez, we risk 1 unit to earn 3 units. We have to have stops, whether that's a hard stop or a trailing stop. We got into technical analysis, and we got into technical analysis. We started with moving averages, the 200-day, 50-day moving average, but then we got into a system, called 25, which are moving averages, and using that to target getting into a stock or getting into an index or getting into some sort of option or some sort of day trade, whether that's futures or not. And I did a couple of examples of each of those using 2025. And then we got into the 55 system, and we talked about directional trades, whether it's a put directional trade or a call directional trade. We talked about, geez, sometimes we can look overnight and know we're having a big day. And if we're having a big day, we anticipate it's going up. Just because we anticipate it doesn't go up, it means it's not going to go up. It could not go up. So we talked about confirmation of positions. We talked about confirmations when we take a look at a candlestick pattern like a doji or a hammer. We talked about what are hammers and dojis. What's an engulfing pattern? What's a bearish pattern? We talked about 3 white soldiers and 3 black crows. So we covered, and then talked about confirmation of direction to make sure we're getting into the trade correctly. We also talked about, hey, we can actually play it with no risk or non-directional. So we know if there's a bias to the upside, we can kind of do a vertical put, right? Which is a way of making money that's fixed, but it's a pretty safe fixed kind of piece. And doing that either weekly, monthly, or actually kind of doing that on a day. So stay tuned for an action-packed day if you missed it. In addition to which, those of you that attended, I'm sure you want to review it. As part of that, I got questions during the breaks, questions at lunch, and we spent about 45 minutes afterwards answering some questions, so some people are really engaged. And I was surprised to find out that some people, aren't doing credit spreads. That they were there to learn about stock trading, but not really there, or options trading, and not really there to learn about spreads. And spreads is such a great piece. It is a system, that earns 6, 7, 8% a month. It's using a vertical put, which we talked about towards the end of the day. Using a vertical put and a vertical call, and making 6, 7, 8% a month, winning 9 times out of 10, and it takes less than 30 minutes. So those of you that didn't, or don't know what a credit spread is or how to use it, I do have a training program on credit spreads. It's about 9 hours of training. It has about 8 hours of solid, get to know what a spread is, and then about another hour of reminder videos, and it's well thought out. It's very systematic. There's written materials for you to go through as well. There's also a website, that you will have access to, where you can kind of look over my shoulder each month and see what I'm trading. So a great program for somebody that's brand new that doesn't know what a spread is. And there were some people there that have spreads, but they did the self-study program, and they're still looking for a little additional guidance. So I'm kind of excited to kind of announce that we do have a credit spread coaching program. It's done with me, myself and my son. We either teach together or he does a session and I do a session, but between the two of us, we do 8 sessions. Each of the sessions is about 45 minutes long, and we take you from the beginning to the end. You know, it's very well thought out. In fact, if you go to finseminars.com, you can actually click on the credit spread coaching program, click on it, and you'll see the itinerary, the schedule with respect to it. But very inexpensive. We either do the 8 sessions once a week, or we do the 8 sessions twice a week, depending on how fast you want to move. And both Mike and I are comfortable doing either one of those. You know, and we do have a mentorship program. We had somebody already sign up for mentorship. You know, normally it's $15K. When I do a workshop like this, I offer it for $10K. Kind of tied up in November. I've got the last kind of weekend in November available, or one of the first 2 weekends in December, or the first weekend in January. But if you're interested, you know, take a look at the mentorship program. Great program. I come to you for literally 2 days, and in those 2 days, we trade. We trade 2 to 3 years worth of credit spreads. You know, we also trade on the Monday live about 50 times. So it's a great program. If you get a chance to, please join me for one of those. But stay tuned for this video. It's incredible. About 7 hours of video there. You know, go through it. Make sure that you learn something. If you have 1 or 2 questions, feel free to email me. I'm not your coach at this point unless you're paid for coaching. You know, but I'm happy to answer 1 or 2 questions about the content of this video. Thanks for either being there, or thank you for reviewing it after the fact. This is Jim Francis saying so long for now. We'll see you next time. Oh, it's good to see all you guys. I got some past students. I've got some new people. I've got some credit spread people. I've got some mentorships. I've got some hockey players. You know, I got a pile of Canadians that are coming in as well. You know, that's always good to see. Winnipeg and Montreal and Quebec and all over. So that's pretty cool. All right, we're right at 9:05, and I usually give it 5 minutes to get started, so I'll get started now. Hey, welcome! Glad you guys are here. We've got an exciting day. It's action-packed, lots of strategies, lots of concepts and ideas. And when I talk about concepts and ideas, I'm the kind of person that really wants to get it to practical application. So if I talk about something, I'm probably going to go show you a trade that is, you know, that I've done, that demonstrates it, or we'll go online and take a look at how to demonstrate it, you know, with respect to it. I'll talk a little bit about brokerage accounts. I'll talk a little bit about stocks and picking stocks and different systems for stocks, some simple, some a little more complex. Talk about, you know, doing options. I know I've got different people at different levels in here. Some people, you know what a credit spread is and have traded some credit spreads. That's an type of option. Some people are brand new and don't know what an option is, you know, so we'll kind of go from, you know, kind of basics and move forward with respect to that. So I'd like to get started right away. Not going to talk much about who I am, but just want to kind of get a flavor for who I am. And this is really about learning how to trade. You know, when I say learning how to trade, it is really you starting wherever you're starting and getting better at trading. Now, that might be that you're not trading at the moment and you're just beginning, but I'll kind of walk you through the process so that you get it. And I just want to make sure that everybody will see my screen when I share it here. So give me a thumbs up if you can when I share my screen, so that you can tell me that you are seeing a couple of characters right now, a couple of cartoon characters. And is that what you're seeing? If you are, give me kind of a thumbs up or oh yeah.
Well, yeah, there's characters, and then there's a whole list of them on the right-hand side of the screen.
Yeah, lots of characters in this audience, that's for sure.
Yeah, no joke.
Got 1 or 2 speakers. They got some traders. They've got some people who are pretty dynamic. Quick background: 8.5 years Fortune 500, Tony Robbins franchise speaker. I've done 17 seminar companies. Took a company from 0 to 108 million in less than 4 years. Do some international speaking. I've been trading since I was 22, not always successful. You know, I would say that, you know, for the last 30 years or so, it's been very successful. You know, and I've done all kinds of trading, whether it's fundamental trading or whether it's technical trading, options, Forex. I really try everything to see how it works. If it works for me, great. I continue and put it into my arsenal. And if it doesn't, I kind of move on. I really do believe in mentorship. You know, the quickest and easiest way for you to learn in terms of this is really to get somebody on your team, that can demonstrate it, show it to you. And that's really my plan, for the next 7 hours or so, is to kind of be on your team, to get you started, to get you moving on. If you are trading already, you're going to find some concepts and ideas you can apply immediately. Probably a couple of strategies that you haven't considered, a couple of bonus ones I'm going to throw in there as well. So I think you'll enjoy it. Mentorship for me has always been important. I've had 50 plus millionaire mentors and 2 billionaire mentors. And on the stock side, I've had quite a few mentors. I've had some great people that I've worked with. One of the best people I ever worked with was Tony Robbins, obviously. And this is kind of me having a breakthrough, literally, with Tony. But, when you're thinking about trading, you really want to get somebody on your team that knows how to trade and is really good at trading. And there's a lot of topics to cover when it comes to trading. We may be talking a little bit about fundamental analysis. We may be talking about technical analysis. We'll talk about different choices. Do we buy the stock? Do we buy the index? Do we buy the option? Do we buy the future? So there's a lot of different things we're going to cover in this next 7 hours. Don't expect you to be a master immediately, but I do expect you to move from where you're at right now, which may be a non-investor or investing in the market in terms of mutual funds or something of that nature, and move to, maybe doing some index trading, maybe doing some options trading, maybe doing some futures trading, at least paper trading so you get good at it. I'm going to talk about all kinds of strategies. I'm going to share one of my favorite trades called the Christmas trade. I'm going to talk about some systems. A 25 system, a 55 system, vertical options, and I do vertical options as a credit spread, but talking about vertical options as a day trade, as a trade in general, some seasons, some futures, so it's quite an active kind of day. Whenever you're thinking about, learning something new, I often think of it as kind of a jigsaw puzzle. And as a jigsaw puzzle, you've got to have a strategy, right, to do a jigsaw puzzle. You don't start with the small little pieces. You really need to think about how do you get there quickly. Well, the quickest way is, and people will say this, is to put the edges out. And that's really not true. I mean, the first part about a jigsaw puzzle is you have to see the big picture. You have to kind of know where you're going. And then once you know where you're going, you can kind of build the edges and then starting putting the colors together and things of that nature. So we're going to start kind of with the big picture kind of this morning, and then we'll get into the edges, and then we'll move right into some details. And when I say details, I'm talking about actually doing some trades or looking at some trades that we could take or will take, with respect to it. So maybe a little slower pace for some of you guys that have been trading for a while when we first get started, but very quickly we're going to get into some stuff that you've probably never seen again. When I think about, wealth in general, I kind of break it into 6 major sections, and those 6 major sections are having a good mentor, making focus on strategies on income, growth, big hits, leverage, and taxes and asset protection. Now, I know as I do this, you guys may be taking some notes, and I'm going to move fairly quickly through things. So every once in a while, I'll throw up a slide that has a lot of content or a lot of information on it. And I know that you will want it. So just so you guys know that after the workshop, I have a notes package. And that notes package takes a slide like this, and it's in the notes package so that you'll have it with you. Of course, after the workshop, we're also going to have this video that you can refer back to. Take me about 24 hours for it to render and for me to clean it up in terms of getting rid of some of the, breaks and blank spots and things of that nature. But I'll clean it up and get it out to you within the 24 hours. So if you miss a section, if for some reason, you've got to take a 60-minute lunch versus the 30 minutes that I'm kind of allowing, you realize that there will be the video and also some notes that come along with the video with respect to it. You guys have my email address, so after the workshop, if you have a question or two, I'm happy to do that. When I say that, it's a question or two, not me becoming your coach for the next 2 years, so just realize that I'm happy to answer some questions about the content and the information as we kind of go forward with respect to it. I've had some great mentors when it's come to the stock market. The guys that I studied with or the guys that I study, are people like, Warren Buffett, Rance Mashek, one of the best options traders I know and teaches options traders, Keith Craft in terms of, doing futures. Mike Cobalt, definitely an options credit spread kind of guy. William O'Neill, you may not know, the guy that started IBD, which is International Business. IBD is the magazine that talks about something called the Can Slim method of investing. Phil Town, Noah Davison, Justice Brothers, Dr. John, Dr. John Nardanian on CNBC, learned literally, married puts, credit spreads, and butterflies from him, so great strategies that you can use that are options kind of based. Sir John Templeton, the Templeton Funds, $1 billion company. That's actually him and I in the Bahamas teaching together, about 7 or 8 years ago. Right. So I've had some great people, and that's fine. My goal is to be your mentor for the very short period of time we're together, and to get you kind of out of work mode and start to build that second income stream or third income stream for some of you, or whatever that might be. Because the 40-40-40 plan doesn't really work. I mean, when you're working hard, it doesn't allow you to do the things you want to do. I love the fact that, I wake up when I want to wake up and do what I want to do when I want to do it, and trading and real estate investing and all of those things kind of pays for that. Most people get kind of lost in the maze, and I want you to break through the maze. So we're going to kind of shortcut trading, right? I'm going to show you some strategies, and then I may say, yeah, that's a great strategy. Here's a better one, so that you get good at it. You guys that are trading already, I'm going to clean up some of the issues you may have, like your loss issues or whatever that might be. I'm going to suggest to you that as we go through the workshop, you kind of write down ideas, but also write down any questions. I will address questions at a break, and I will address questions at the lunch break and also afterwards. And I'm happy to stay tonight a little bit to answer some more questions if you stick around. But make sure you write down the concepts and ideas. There'll be some websites that I mentioned. They will be in the notes package I send to you, so you will have an ability to look at the notes package, no question, but you may, want to write down those questions so you get them answered at a break or at the lunchtime or whatever that might be, right? So make sure you're writing it down for me, right? So that we get you going. So write down your questions and your ideas. Sorry there for a second. I just had to add a couple more people. Right. So, we'll have some great pieces. Right. And my computer just froze. So hold on a sec. A little bit of a disclaimer. I know that's a kind of something that you wanted to see. We are talking about stocks and investing. So, it must have a disclaimer. Yeah. OK. We can't see that. Right. OK. So everything I'm going to talk about, is real, works, has systems and strategies and back tests, and I've traded it, or there's a system for it, and it is for educational purposes. It's to kind of teach you what some of the other options in life. You are responsible for your own investing. If you are going to take some of these concepts and ideas and start to use them, I'm going to suggest that you paper trade first. So you paper trade either the past, or which would be a back test, or you paper trade the future, and that might be a few days, a few weeks, just to get good at it. Once you get good at it, that's the time that you want to kind of move forward, right? So we definitely want to do this for education. Right? A little computer problem there. Big kind of picture. I really believe that there's 3 major vehicles for wealth. There's a stock market, there's real estate, there's business. And unfortunately, most people get locked into doing 1 or 2 strategies, not all strategies. So the average person, when it comes to the stock market, what they do is they invest in mutual funds. They invest in a self-directed, they're listening to their financial advisor. And I have had all my financial advisor licenses. I was a supervising principal, which means I actually supervised other brokers. And that statement sometimes is true. Sometimes they're broker than you. That test is a pretty simple test to take. You got to get a 70 on it, and immediately you're an investment advisor. I studied for 7 hours, took the test, was with a financial advisor. That doesn't make any sense to me. I mean, I didn't know anything about the stock market. On the test, there wasn't a question about the stock market. There's a question about, a young person starting out and what you should do, and a middle-aged person and an older person. And if any of you have had that license, you know that to be true. Your education begins after you get the license. So I'm going to suggest that you don't trust the financial advisors. You don't trust the mutual fund manager. A mutual fund manager does not have your best interest at heart. And I'm going to suggest the number one strategy for you to take out of this whole thing is take control. Take control of your investing. No longer just stick it into a stock blindly. It drives me crazy when I see somebody, that's betting on Tesla, and they make a couple of $100 maybe, and then they lose a couple of thousand because they're listening to news, they're listening to hype, they're not looking at the company as a solid company in terms of the PE ratios or the fundamentals, or even better, the technicals. Is it the right time to buy the company? So I'm going to talk a lot about that. And we want to change that. We want to get better at what we're doing. We want to make sure that we're moving in the right direction. I'm also going to suggest that, you just don't become a devotee of, futures. Futures, I like futures. They're high risk, high reward. In 30 minutes, you can make 20 grand or you can lose 20 grand, right? That's too risky for a lot of people. And most people, have their money in a CD, certificate of death, or they have it in a savings account, or they have it in a 401k or a mutual fund. That's too risky. Okay, I mean the average stock goes up about 7% a year over the last 100 years. And that's not a really good rate. In fact, I'm going to show you some statistics that kind of say you shouldn't even do that, right? So we want to start thinking about a longer term perspective and taking some of the stuff that we may have that's growth and putting it into income producing strategies. A strategy where we make money each week, or a strategy where we make money each month, right? And then I'm going to add to that, layer to that, hey, do you want to do something like once a week, for an hour or two to make some extra money? Right? Maybe doing a future, or maybe doing an options trade, or a day trade, right? So we're going to start with the kind of basics of, okay, we want 45% growth, so here's some growth strategies. We want 45% income, so here's some income strategies. And then here's 10% we want to put into high risk, high reward. Notice I said high risk, high reward, right? It doesn't mean it's risky. It just means it's a little more risk. So therefore, I've got to have some rules to protect myself on that risk. And that's kind of the big picture for this morning, and then we'll move into some more little detail with respect to it. Biggest mistake that people make is they put all their money into one thing, and that's growth. They put it into mutual funds or the stock market, right? And that can be a major blunder for a lot of people. In fact, this is the plan for most people. Mutual fund, savings, CD, I buy my house, I have a job, okay? I really believe you have to have more flavors than that. You've got to have income producing stocks or indexes or strategies. You've got to have some speculation, where you do $1,000 once a year on something called the Christmas trade, right? And you make 500 or $1,000 in 6 weeks, right? That is a small investment of a bigger investment, but it's a great rate of return. And I'll show you literally the Christmas trade today, when I'm talking a little bit about seasonal patterns and things of that nature. So lots of stuff to learn, and you've got to start by taking all that stuff that's in mutual funds and CDs and starting to distribute it into other strategies and concepts. Not going to talk about real estate, not going to talk about business. And those of you that know me know I've done 100 plus properties, and I've owned several businesses and took one public. Key word for today is action, guys. If I teach you something, you must take action. You can't wait. You've got to take action. And take that action today, Sunday, Monday at the latest, right? Because if you don't do it within, 24, 48, 72 hours, you're not going to do it. It'll be something that you think about down the road, okay? And the stock market, investing in mutual funds or the stock market, that can be a bit of a challenge. In fact, this is a chart of the market, right? The Dow, right? From 100 years kind of up to present. And if you take a look at it, you hear the brokers all the time say, listen, stock market always goes up, right? And it does. Over 100 years, it has gone up. Problem is, it goes up, right, and then it goes sideways, right? It goes up, it goes sideways, and we get these situations where, you know, it'll go sideways for 20 to 22 years, right? And then it'll go up, right? And then it'll go sideways for another 22 years. Then it'll go up, and it'll go sideways for the next 22 years. And then it goes up dramatically, and then it has these big ups and downs, right, for the next 22 years. And we're in the middle of a sideways market. You know, it literally is choppy. We're having big years and we're having big down years, right? And that's been happening now, you know, for a good eight to 10 years, right? So what does that mean? Well, it means, you know, if you got 100K sitting in a 401K, 100K sitting in the market, you know, in the next 8, 9, 10 years, it's going to be another 100K. Yeah, it'll go up to 150, and then it'll go down to 70, and then it'll be going up to 100, but it'll still be there. You got to have more strategies than blindly trusting a financial advisor and hoping and praying that your stocks are going to go up. So I'm going to teach a couple of strategies, and some simple ones and some more difficult ones, you know, for you to pick good stocks if that's what you want to do. It's not what I do in a major way, but it can be something simple for you. So we definitely want to take control of our financial future by making sure. And, you know, you can, you know, take control by thinking about just investing in the market in general. Now, when I say investing in the market in general, you know, some people don't even know what the market is, what it means. So, you know, I know there's 2 or 3 brand new people here. You don't even know what when I say the market, they don't even know what that really is. Well, there's kind of 3 major markets. You know, there's the Dow Jones, you know, which is 30 blue chip stocks. Those are big stocks, right? They're stocks like 3M, Merck, Microsoft, you know, and this is a list of some of the Dow stocks. They're Coca-Cola, they're IBM, they're Pfizer. You know, when you hear the Dow went down today, you know, 300 points, it's those big stocks that have an international kind of flavor. But there's 2 other major markets that are out there. You know, there's the S&P 500, and the S&P 500 is 500 stocks in the USA, you know, and people watch the S&P, and the symbol for the S&P is SPX or SPY. You know, we'll talk about that in just a few minutes when we get into trading a little bit. But, you know, this is just, you know, 50 of the 500 S&P companies. Oh, by the way, I should mention this. The S&P 500 includes the 30 Dow stocks. So they're not separate, you know. The 30 Dow stocks are the big blue chip stocks, the Dow, you know, but it is part of the S&P 500, right? And then you've got the Russell 2000, which is 2,000 different stocks, you know, that are out there. And I'll trade the Dow, I'll trade the S&P, and I'll trade the Russell. You know, for cash flow, I quite often trade the Russell, doing a system called credit spreads, which earns me between 6, 7, 8% per month. And I know quite a few of you are credit spread traders. One of the things that you can think about is, should I be trading the stock or should I be trading the overall market? And I'm going to suggest to you that I have no qualms about you trading a stock if you have the right reason, right? If you have the right reason for trading the stock, that's great, you know, but it's a good stock. Like I hear people say, I love Tesla. What do you love about Tesla? Hasn't made any money yet, right? But the story is good, and technically there might be some reasons to trade Tesla, you know, certainly from a covered call standpoint, that has a great rate of return, you know. But we want to get into stocks that are going up or going down, and trade strategies that are up strategies or down strategies. And I like trading indexes. So I like trading the Dow. I like trading, you know, the Russell. I like trading the SPY or the SPX, which is the S&P 500, because I kind of know, right, that if I pick those, right, if I do that I'm going to get a good cross section of pieces, you know. And I also know that if you pick a stock, 75% of a stock's value is directly related to the overall marketplace. right? 75% of a stock's value is directly related to the overall marketplace. 50% about the market, 25% about the sector it's in, whether it's a financial or a drug, or whether it's, a commodity or whatever it might be, right? Because certain sectors go up and down at certain times in the year. Usually, January, February, drug stocks tend to go up, right? Think about oil and things of that. Oil, you need more oil and more heating in the winter time, so therefore there's a propensity for it to go up. Utilities, certainly in Florida, we need more utilities June, July, and August, to pay for the air conditioning. So there's certain times where the sector will cause it to go up a little bit or down a little bit. But 75% of a stock's value, 75% is related to the overall marketplace. What does that mean? Well, that really means, if I'm trying to trade this stock, I better know what the overall market is doing, and not just that the stock is good, right? I need to know what the overall marketplace. So what I would rather do is trade the big three. Trade the Dow, trade the Russell, and trade the SP, right? SP 500. Now, we can trade that in big quantities or small quantities, and I'll kind of talk about the mini Dow, the mini Russell, the mini SPX, which is the SPY, which is easier because it's cheaper for us to get into those, right? And a good example of that is kind of one of my first trades. I've been playing hockey pretty much all of my life, and I played up in Toronto, Canada, and I worked for Rogers Telecommunications back up there. And I was one of the executives, and this is when I did my 8.5 years in a Fortune 500 company, Rogers being $1 billion kind of company that owned Paragon Cable at the time down in the US, so it was listed as a Fortune 500 company. And I had saved, while I was working for Rogers, about $7,000. And one of my buddies on the hockey team that I was playing on, was a broker, right? Now, I didn't have a license. I wasn't an active trader, and happened to be in a meeting where I heard, right, that Rogers was going to have one of its best quarters ever, right, in the history of Rogers, which had been around for 50 years already back then, right? Now it's like 90 years, right? It was going to have his best quarter ever. So what should happen to the stock? Well, it should go up, right? So I was talking to my hockey buddy, having beer afterwards, who's a broker, and I mentioned to him that Rogers is going to have one of its, he asked how the work was going. I was going to have one of its best years or quarters ever. He said, well, you could trade that. And if you traded it, you could buy some options, and if it goes up, you could make out really well. Now, forgive me for this, but at the time, I didn't know that that's kind of insider trading, insider knowledge, right? But I happened to be in a meeting where I heard this, and I unbeknownstly, I guess I broke that regulation, and I traded it. I gave him the money, the $7,000, and traded it, and immediately the next 2 weeks, the stock market crashed, right? And I mean crashed, right? Major pullback, 30%, something like that. So what happened to the Rogers stock, which I was expecting should go up fairly dramatically because of this great quarter we had, and the overall market forced it down. So when you're trading, if you are going to trade individual stocks, one of the things you must do is look at the overall marketplace kind of first to see what's going on with it before you actually trade, IBM, before you actually trade Coca-Cola, before you trade Rogers Telecommunications or whatever it might be, because that will be 75% of the value. Right, and I literally lost $3,500 of the $7,000 I had saved. So not a good story, but it was a good story. In fact, here's a strategy for you. Okay, an idea and a concept for you. 9 out of 10 mutual fund managers, right, and most people that put their money into 401k or self-directed have a choice between a fixed fund, a balanced fund, a aggressive fund, an offshore fund. Whether that's Asia or whether that's South America. And one of the statistics that you should realize is that 9 out of 10 mutual fund managers cannot beat the S&P 500. Now, that's literally what I'm saying, is that if you put your money into the S&P 500, okay, and Susie Orman talks about this regularly, you would beat 9 out of 10 mutual fund managers who know what they're doing. Okay. So, I mean, it's a simple strategy, but it's a good strategy because literally what it can do is it can make you do better than the fund that you're thinking about investing in. So take control of that. Put it into things like the SPY or the SPX, or if you are going to put it into a fund, make sure the fund is based on the S&P 500, an ETF, an exchange traded fund, right? 75% of that, right? And this is an interesting statistic that I saw about 2 years ago now, and it came out according to numbers complied annual performance data by Delbar. The average stock mutual fund investor has seen an average annualized return of 4.6% over the last 20 years. Just investing in the S&P 500 would have paid you 8%. That's double what an investment fund is doing, right? So literally, it is a great way for you to invest, right? Just that simple change can be the difference between, making 7%, and making literally 12, 14%, right? So we definitely want to take control of those things. We definitely want to take control of our investing and everything. And I know your growth, your plan, your next few months, next few years, you're going to start thinking, well, geez, do I really need to put my money into a CD, savings account, a mutual fund? And the answer is no. Right? Because if you're in a CD, you might be making what, 1%, right? You got 3% inflation. Every year you're losing 2%. You're thinking about a mutual fund, you got 7%. And Tony Robbins just wrote a book recently about investing. I actually introduced Tony to Charles Givens decades ago. Tony actually has a number of people on his team that are investment advisors, not necessarily himself, being a financial guru, but he does have a book out there. And it talks about, one of the things it talks about is when you put your money into a mutual fund, you're losing about 1% a year in fees that are all hidden and you don't see them, right? So although the stock market and the mutual fund might be going up by 7%, you're losing about 1% in fees. So we need to kind of take care of that and get rid of it so we can do better. So mutual funds are not really the choice. In fact, I'm going to show you a strategy in a few minutes, simple strategy done once a year. Since 1973, it's done 18%. If it's done 18%, that is better than putting money into a mutual fund or a stock. And it's a simple strategy done on December 31st of every year. And you trade on the 1st of January or 2nd of January, whatever it might be. And then I'm going to take that strategy, which is 18% a year, and I'm going to put it on steroids so that you can do 30% a year. Now, when I use statistics and numbers, they're very accurate based on what I know, back tests, real situations. But I have to do this, just because I have had those licenses. Anytime you're talking about a number, past performance doesn't equal future performance. Investment does have risk. You'll want to know what you're doing before you do it. Yeah, I've said that a few times, no question, right? So we can get to 18% pretty easy. In fact, out of this workshop, a couple of strategies, you should be doing 15 to 30% this year. And just so you know, 15 is a magic number. I don't take any investment that pays less than 15% a year. You've got to make that. And the reason for that is the power of compounding. What's interesting, though, is if you learn a little bit about options, if you learn a little bit about options trading, right? And rather than buying the stock, we buy an option on the stock. Or if we buy the index, we buy an option on the index. What we can do is get our trading, past that 25, 30%, get it up to 25% or more, right? Yes, you'll have an occasional loss, but that's what the math is about. And in fact, the next section I'm going to talk about is kind of the math of trading, right? And also some insights as to when to trade during the week or during the day and things of that nature, right? Because those are all important and can play a major role in terms of your trading. But we can get to 25, 30, 40%, on our trades per year. And in fact, in credit spreads, I often make this statement, you can make 6%, 7%, 8% per month, right? Win 9 times out of 10, right? And it takes less than 30 minutes, right? Well, 9 times out of 10, 6%, you can kind of figure the math, right? If you lose once, you're going to make about 50 or 60% a year. If you could take that loser and turn it into a winner, you can make 80%, 100%, 120% on your money. Just on that one strategy. And it's the strategy towards the end of the day I'll visit. And the reason I'm visiting it towards the end of the day is I know about half of you are already trading credit spreads. You know, you're either a mentorship student that worked with me one-on-one, you know, like Jimmy or David or Christina or whoever, or maybe you took a credit spread course a little while ago, whether that was self-study or live. Guys, it gets better than that, right? Once you've kind of mastered options trading, you know how to trade an option for income or for growth, right? Or for protection, because you can use an option for protection. And in fact, you know, I know one of my students, you know, in February when the market was crashing and burning, we had talked earlier about a protective put, and I know in 10 days they made 100 grand, right? 10 days and 100 grand while everybody else is losing money. That's a pretty good day at the office, man, right? So you can make that, but you've got to get better at trading and mastering those techniques. And it gets better, guys. You know, you can get into futures. In futures, you can make 10% a day. You know, if you think about 10% a day, depends on how many days you trade, right? You can actually take that and do one trade and make 800%, you know? So we're going to talk a little bit about futures trading and some systems for futures trading. I've got two that I want to share with you that are good that I use on a regular basis with respect to it. So you can do 200 plus, you know. When I retired, and I'm 64 now, guys. Hey, I look good for 64, man. How many people think I do look good? Thank you, Kevin. I appreciate that. Thank you, Jimmy. Thank you. You know, so, but when I retired at age 40,
as good as I do at 69.
there you go, Kev. Right. So, you know, when I retired at 42 for the first time, you know, after doing pretty well, you know, I decided I was just going to trade. Right. That's all I was going to do. Right. And I traded every day for 18 months. Right. Started off being an hour a day, then it was 3 hours a day, then it was 6 hours a day, and then it became a job. You know, and that's where I kind of went, okay, I'm day trading and I'm trying to make 25 cents on a stock, right? You know, but I'm buying 100 grand worth of AOL, right? Right. You know, and you guys that remember what AOL was, you know, it was before the internet, that kind of stuff, right? You know, so you're laughing, right? So, but I try to make 25 cents, right? Now 25 cents on 1,000 shares, right? And I tried to do that 4 times during the day, make $1,000 and then go home, right? So, you know, and I had a $150,000 account back then. I think I did something like 278 that year, just trading the stock, right? Before options. Man, if options had been around, or I had known options back then, you know, 22 odd years ago, you know, I probably would have done 1,000%, right? You know, so there is a major difference. As your education gets better, you get better. So we definitely want to learn. And it's all about ROI, guys. End of the day, it's all about ROI. You know, if I can show you one strategy that can double your ROI, that's great. If I can show you 2 more strategies that can quadruple your ROI, that's fantastic. And this is just an example of that. Here's $10,000 today, put in at different rates of return. Okay? If I put 10 grand into the marketplace, right? No more money, no more additions. I just take the money I make from it and compound it into the next investment. You know, we see some pretty dramatic. At 5% a year, you know, you take your 10 grand and turn it to 58,000. At 10 grand over 36 years, right? At 8%, you know, you got 135,000. You know, 10%, you move from, you know, 5% to 10%, double your rate of return, you know, you got 309,000. And the magic number that Charles Gibbons taught me decades ago, and I'm talking like 40 years ago, was you must make 15% on your investments or do not invest. Okay? And that's kind of a magic number, because if I take 10 grand today, put it away for 36 years, you know, it's worth 1.5 million. So what's better, the 1.5 million or the 58, right? And in this class, the bigger number is always the better number, right, Serge? right? So we definitely want to get good at it. And you can get it, guys. You can get it through options. You can get it through dogs of the Dow. You can get it through directional trades. You can get it through futures. You can even get it in real estate, something like tax liens and deeds, 18% in Florida, right? Bob, you're in Texas. I know you moved from Florida. Texas, man, 25% every 6 months on tax liens in Texas, right? 25% every 6 months, that's 50% a year, and they have penalties on top of it, right? So you've got to be thinking outside of, you know, just taking your money and put it into a mutual fund. You know, a tax lien sits there for a year in Florida, 6 months in Texas, right? You make your 25% and go home, right? 99% of the time, you make your 25%. 1% of the time, you end up with a house, right? What's wrong with that? you know, so it can be a great strategy with perspective. And it's all pattern trading. Everything I'm going to talk about is about a pattern. Everything I'm going to talk about is a system, okay? I don't blindly to say, okay, I'm going to buy Coca-Cola this thing because Warren Buffett bought Coca-Cola. I buy it because I know that these patterns are happening with Coca-Cola, whether it's a technical pattern, whether it's a fundamental pattern, or whatever it might be. My allergies are kind of kicking in, guys. So we definitely want to learn some patterns. If we see a box of triangle, star, box of triangle, star, box, triangle, star, we see a box of triangle, we know the next one's a star, right? And that's kind of what we're going to kind of learn today as well. And we'll start with something that's a little easy and move to the complex. So let's start with some easy stuff on investing. Some strategies that one or two of you have heard and many of you haven't, and they're called seasonal patterns. And I like to take these seasonal patterns from the concept stage to the application stage. So if it's okay with you, I'll take some of these concepts and show you how to use them to make money. Is that okay? If it is, say, oh yeah, or put your hand up nice and high so I can see you. All right. So I'm going to talk first about the big four, and then I'll come back and talk about another one, which is the best 3 months to invest. So there's the January barometer, best 6 months, the Christmas effect, and the worst month to trade, right? These are seasonal patterns that happen. So since 1950, there's been a system called the January barometer. The January barometer has two parts. The first part is, in January, the first 5 trading days, you look at the first 5 trading days, and if you look at the first 5 trading days, there's an 85% correlation. Whatever happens on the first 5 trading days will happen for the balance of the year. So I'm always interested in January. What's going to go on in January to tell me what kind of trades I should do for the balance of the year, right? I know that if I see that the first 5 days are up, then I'm probably thinking about, buying stock equities, or I'm thinking about buying calls, options. That was my dog, by the way. Options, going up, right? If it's going sideways, I'm thinking about, wow, that'd be perfect for cover calls. A cover call is a sideways strategy or a little bit of an up strategy, and I'll talk about that towards the middle of the day. If it's a down, then I'm thinking about, geez, I got to be thinking about a protective put to make money or to protect my account, right? So I'm always interested to see what happens those first 5 days. And as I said, there's about an 85 correlation in the first 5 days. Part of that January barometer is also the first 30 days. So the first 30 days of trading, January, there's a 91% correlation. So there's a 91% chance of me knowing what direction it's going to be. Now it's based on the S&P 500, the 500 stocks in the USA. So literally, this is the S&P 500 from this year, from 2020. You can kind of see, started off, went up a little bit, and then came down a little. The first 5 days, it was up. So I was thinking, geez, this is going to be an up year. But it's not much of an up year. It hasn't moved a lot. Then she kind of reverses and comes back down, right? And she closes lower than she started. So that would indicate with a 91% probability that this year should be a down year. Now, this is January 31st, guys. January 31st, I'm seeing that it's going to be a down year, and there's something technical that's happening as well, right? So immediately, I'm posting, and in fact, I posted on December 31st this, you should be thinking about a protective put, right? If you have money in a mutual fund, you have money in the stock market, whether it's Canada, the US, or internationally, you've got to be thinking about the next 3 months to 6 months could be a down month, so we're thinking about protective put, okay? Something simple like that can protect your account, okay? So we look at that, and we expect this year could be a down year. There are actually 6 months of the year that are the best time to invest. And in fact, in the market, this is called, trade until May and then go away. So in May, you go away. November 1st through April 30th of every year, the market, the Dow Jones on average goes up about 7.4%. So it has a major uptrend during those months. Now, what's interesting about that is most of the gains happen November, December, and January, and then February, March, and April, it goes sideways, which might give it a little bit or down a little bit. So it's kind of choppy. But those months are the best months to kind of invest. If you simply use that strategy and you only put your money into equities, stock, November 1st through April 30th, and then in the other months, May through October 31st, you were in a balanced fund, an income producing fund, a bond fund, if those are your only choices, in your 401k or whatever it might be, your RSP. If you simply did that, you would have missed all the major crashes that happened, right? The crash of 1929, 1987, and 2008. Now, you would have gotten hit with the one from 2020 because that was February of this year, which is supposed to be a pretty good month. In fact, you can actually, if you're kind of the analytical kind of type, you can actually look at all the statistics of this. And these are actually all the trades that happened during the best 6 months and when we would take them and how we would take them. And I didn't make all these trades, guys. So, I have some sources of information that are really good. One of those sources of information is stockalmanac.com. Okay, stockalmanac.com. Stockalmanac.com will allow you to look at past trends that are seasonal, and it'll tell you things like, hey, Monday's usually an up day. Friday is usually a down day. Wednesday is usually a down day. Tuesday is usually an up day, right? And can that help your trading a little bit? It can, right? So just to kind of think about the application of this concept, right? If you have mutual funds, you have, you invest in the stock market, you're in an RSP, and you're picking what funds, November 1st through April 30th, you're picking an aggressive fund. You're picking a stock fund. You're picking stocks and equities. When May rolls around, you call your broker, you call your plan administrator, you go online and do it online. Many of them are online nowadays. You move to a balanced fund. You move to a bond fund. You move to a municipal bond fund, right? Municipal bond fund may be 3%, 5%, 6%. Guaranteed by the fund. It's balanced, right? So in those months when it's crashing and burning, stock market, or it's going flat, you're not in. Or you move to a credit spread trade during those months, or you move to a covered call because it's going sideways, right? So a great application of those pieces. If this is making sense to you guys, give me a nod with your head. Would that be okay? All right, thanks guys, appreciate that, right? Okay, so we want to be in equities and stocks, and remember, lots of the slides that have numbers and statistics or a fair amount of data I'm including, so you'll get an email from me, which will have the link to the video, but we'll also have handouts on the slides as well, right? So don't freak out if you don't write everything down, right? StockTradersAlmanac.com, right? Great piece. They also have a magazine that they recommend or have a relationship with. Just hold on one second. Wasn't going to do this, but Stock and Commodities magazine, right? If you don't get this magazine as a trader, you're crazy. This is a great magazine, right? Every month you get new ideas and concepts and data and back testing, so I don't have to do the testing myself. So great magazine. These are just on my credenza, by the way, right? So read them kind of regularly. So you definitely want to pick that up. In fact, I have a 5-year subscription to that. Okay. Stock, index, or options, futures, and a margin account. Okay. So one of the things I really believe in is about leveraging your money, right? Leveraging money in real estate. You put $10,000 on a $100,000 house. The house goes up at 4.5% per year on the 100,000. Which substantially means my 10 grand grows dramatically, goes at 40%. Because 4% on a $100,000 house is $4,000. I put a $10,000 investment. That's a 40% rate of return on a property. So I like using leverage in real estate, in business, and in particular the stock market. So a couple of things you should be aware of. And leverage just means that I can control more with less money, right? So when you're thinking about a brokerage account, one of the things you should do is, first of all, get a margin account. Okay, so a margin account on a brokerage account basically means if you put 100 grand there, they're going to give you $200,000 to trade. Well, that means, you know, I have $100,000 in my account, but I'm controlling $200,000 worth of stock, which means when I get a return, it's on the 200,000, but it's actually only on the 100,000 I put in. And you know, brokerage accounts will do a margin account for you just when you say margin account, right? They'll approve you right away. So it can be a great way of buying stock, you know, or buying extra stock with respect to it. Options. Options have an 8 to 10 to 1 leverage. Okay, and I'm just going to say 10 to 1. Some are 8, some are 10. But what that means is, you know, I can buy Coca-Cola for $50 today, or I can buy an option on Coca-Cola for $4 or $5. Okay, what's better? Well, it depends on what you're using the option for, right? And knowing a little bit about options. But options give you 10 to 1 leverage. Futures, 25 to 1 leverage. Right? $1 controls $25 or more in a future, okay? Which means my dollar goes further in a future trade than it does in an options trade, right? It's one of the reasons I like futures. Plus the fact that futures basically trade 6 days a week, you know, 24 hours a day, right? They trade all the time, okay? So futures, you're up at 2 o'clock in the morning, guess what you can do? Trade. Right? So, you know, you can make your lifestyle, you know, match whatever you want to do, right? You work from 9 to 6, you can trade at 6 o'clock, right? So futures can be a good thing, but you have to have a system to trade, right? And the systems I'm going to talk about will work for a stock, they'll work for an index, they'll work for an option, they'll work for a future, and they'll work for even Forex, right? The 25 system I used on Forex for 3.5 years, right? It was a great system, right? So we definitely want to use leverage to our advantage, right? And when I say, you know, leverage, here's a good example. I was talking to a student just recently. When I was talking to that student, they were thinking about buying Alibaba, right? Alibaba is that big Chinese stock, you know, that does imports and exports from China, you know, into it. And looking at the stock, I mean, the stock is $300. Right? That's a pretty expensive stock. And in fact, if you take a look today, you can actually see that stock. But it's a $300 stock. You know, if I buy 100 shares of that, that's 30 grand, right? And actually, in a few days, and I'm looking at Alibaba, and when I'm looking at Alibaba, I'm looking at, geez, if it goes from 300, it should go to 310. If it breaks 300, it should go to 310. And I'll talk about average price movements in the next section, but we can kind of figure out what the movement should be or could be of a stock, right? Or an index or any commodity, right? So I'm thinking, well, Alibaba should go from 300. Once it breaks 300, it should go to 310, right? So if it goes to 310, which is a kind of a $10 move, you know, I can make a little bit of money, but I'm investing 30 grand, you know, maybe to make $1,000. And in fact, during this period of time on Alibaba, which was only, you know, a few days, right? I'm talking this week, you know, the stock went up to 308 and then actually went past just up to 310, which was the target price, right? Which means you're making 2.7% on your money, and 2.7% on your money or 3% on your money in 5 days is not a bad rate of return. But dropping 30 grand to buy the stock, that's pretty expensive, right? So if we do an option on Alibaba, right, you know, we would do much better because it costs us less, right? And this is literally the option from this week. Option price is $26. Now an option, when I say an option is $26, you have to buy one contract or sell one contract on a stock or an index. So if I sell one contract, that represents 100 shares. So one contract on an option equals 100 shares. So what does that mean? Well, it literally means that this is going to cost me 26 bucks times what? 100. Okay, so the investment, is more like $2,600. 30 grand or 2,600 bucks to control the same 100 shares of stock. Probably we go with the 2,600, right? Okay, and it is about the return. So one contract equals 100 shares. It cost me 2,600 bucks to buy Alibaba for 5 days. And Alibaba within 5 days goes up to 308. So when it goes up to 308, right, it cost me $26.15 to get into the trade. When I got out of the trade, it was $29, right? That's a $285 return on my money in less than 5 days. Is making 10% in 5 days a pretty good return on my money? It is, right? Right? And pretty much knew it was going to go to 308, right? So that's 11%. Is 11% better than 3%? Yep. Is 11% and spending less money to control it better than spending 30 grand? Yeah. So most of the time, if I'm thinking directional, right, I'm thinking about, buying the call, or I'm buying the put, which is a down strategy. Okay. I'll talk about calls and puts in just a few minutes, right? So if we think the market's going up, and this is for you guys that haven't traded an option, if we think the market's going to go up, we buy a call, right? Because we think the market's going tall. So we buy a call when we think the market's going tall. If we think the market is going down or it's going to crash, right, we buy a put because it's going to the foot. So you'll hear me quite often say call, tall, put, foot, right? Because I used to get them confused as what should I buy or what should I sell, right? So we buy a call for going tall and we buy a put for going to the foot, right? Very simple kind of rhyme for you to remember, which of those options you buy. And I'm just going to give you an example here of Coca-Cola. Coca-Cola right now is running about 50 bucks a share. If I wanted to buy 100 shares of Coca-Cola, gonna cost me in the neighborhood of $5,000 to control 100 shares of Coca-Cola. Okay, that means I'm gonna spend 5,000 bucks to control 100 shares, and I expect Coke will probably go up to 60 bucks, right? In fact, Coke during a monthly basis usually goes up about $2 or $3, right? Or goes down $2 or $3, right? So I kind of know what the average is of a movement up in a monthly basis, or the average of a movement down on a monthly basis for Coca-Cola. Something that's important for us to know, and something we'll visit in the math section with respect to picking a stock or picking an index or whatever it might be, right? So, Coke we're expecting to go to 60 bucks for whatever reason, so it's going to cost us 5,000 bucks to do that. If I buy the option on Coca-Cola, right, it's going to cost me less. If it does go to $60, right? Coke goes to 60 bucks. I bought it at 50, right? It goes to 60. I sell it, right? I get 6 grand comes into me. I made $1,000 on a $5,000 investment. That means I made 20% on my money. Now, 20% of my money is actually pretty good if it's a month. It's actually pretty bad if it's 2 years, right? So I need to know what's the likelihood of Coca-Cola going up in a period of time, right? So it's not just blindly thinking, I hope Coke is going to go up and I'm okay if it goes up. It is knowing, geez, Coke goes up normally about $2 or $3 each month, or goes down $2 or $3. Based on a technical pattern, it looks like it's ready to break through 50 bucks and should go to 60. And that's the reason I'm buying it. And then I'm just deciding whether I buy the stock or I buy the option. And my propensity is always going to be to buy the option, right? Because the leverage of the option, even if I lose, the leverage of the option over time is going to make me more money. Okay, so definitely want to be thinking about options trading as a stock investor, right? If I buy the contract on Coca-Cola, one contract equals 100 shares. So if I buy a contract on Coca-Cola and the contract is a $5 premium, meaning I'm spending $5 to buy an option, okay? If I spend $5 to buy an option and I buy one contract, that's 100 shares, I'm going to spend 500 bucks to control the same 100 shares that somebody else spent 5,000 for. That's 10 to 1 leverage, right? I can either do it cheaply or I can buy more of them. If I had $5 grand to invest in Coca-Cola, I'm going to buy 10 contracts which is 1,000 shares of Coca-Cola. versus buying, 100 shares. Now, what happens here, and I have to be careful because some of you guys trade some options, when Coca-Cola goes up to $60, right? That means I have the right to buy it at 50, and when it goes up to 60, I can sell it for 60, which means I make the 10 bucks, okay? Now I can actually exercise my right, buy it for 50 bucks and then resell it for 60, or the option value will go up. And this is called the intrinsic value of an option. The intrinsic value of an option is what the true value is if you sold it today. When I say true value, you buy an option for 50 bucks and the stock is at 55, there's $5 of intrinsic value in the option. It's worth $5 just because you could buy it at 50 and sell it at 60 or 55, right? So what literally happens is, rather than selling the stock, I sell the option. And because there's $10 of intrinsic value, right, the option value went from $5 to 15 bucks, which is the $10 between 50 and 60 on Coca-Cola, right? Now, most options also have other elements, and we'll talk about that a little bit later when I get to explaining how an option works and why it works and things of that nature. But think about this for a second. I have a choice. I can spend $5 grand and make 20% on my money over a period of time, or I can spend $500, make the same $1,000, right, and spend less money. The option is going to give us a 200% rate of return. 200% rate of return is better than 20%, right? Even if I'm wrong occasionally, 200 is better than 20%, right? So we definitely want to be an options trader if we're thinking about the stock market, right? And indexes as well, because you can buy indexes on options. Now, an option is kind of a fun thing. It can make you a lot of money, but it also has some characteristics that you need to be aware of. And this is one of the reasons that people fail quite often when they buy options. You'll hear people say that options are risky. People are risky. Options are actually really safe. Okay? If you know how an option works, they're very safe. In fact, options were created to reduce risk. Okay? And if you know how to use an option, you actually have less risk in an option than you do in a stock. Okay? Think about it. Coca-Cola, you buy it 50 bucks, right? Can Coca-Cola go down to 0? Could, right? And there are stocks that do that. They go down. So there's maximum risk on that piece. If I buy an option, my maximum risk is the premium I paid, right? So it's the $5 I paid, okay? Well, if I have 5,000, I can do that 10 times before I'm out of my 5,000. It was actually created to reduce risk. Now, here's the big problem for most people. They buy the wrong option, right? Or they buy the wrong time period for the option, okay? So options expire over time, okay? So if I buy an option on Coca-Cola, I have a choice to buy a 30-day option, I have a choice to buy a 60-day option, or I have a choice to buy a 90-day option, okay? Now let's just use that example of, Coke's at 50 bucks right now, and I think it's going to 60, okay? Options expire, decay, and here's the decay curve. And as you take a look at the decay curve, you can see if I buy a 90-day option, it decays a little bit, and then as it gets into the 60 days, it decays a little bit more, and in the last 30 days of an option, it decays 100%, okay? So let's say that I buy the $5 30-day option. I buy the $5 30-day option. All $5 in the next 30 days is going to disappear. All $5 is going to disappear. So if I think Coke's going up from 50 bucks to 60, the first 51, 52, 53, 54, 55, if it goes up to 55, I made no money. It cost me $5 to buy the option, and if it goes up to 55, I can sell it for 55, which means I made 0. Okay? So you need to think about, geez, what do I expect the stock or the index to go up, right? And I've got to take the cost of the option into consideration when I'm doing that, okay? And, you know, I'll see people all the time. They'll see a $6 option and they'll see a $5 option, and they'll take the $5 option because it's cheap. And they don't realize that, geez, that means if we were doing Coca-Cola, Coca-Cola has to go to 55.1 for you to break even. And then it starts to make money, because at 56, you'll make $1. At 57, you'll make $2. Now, think about this from another perspective. Rather than buying a 30-day option and having all that decay that happens in the last 30 days, I decide to buy a 90-day option on Coca-Cola. Cost me an extra $1, right? But the decay on the 90 days is very small, right? So the decay on the first on the 90-day option, that first 30-day section of it, you know, is 40 cents. Okay, so what does that mean in terms of my trade? Well, that means that, you know, Coca-Cola has to go to $50.40 to break even, right? But then if it goes to 50-50, or it goes to, you know, 51 or 52, I'm making money, right? And remember what I said, Coca-Cola on average goes up or down $2 or $3 in a month, right? You know, so buying a 90-day option and playing Coca-Cola for 90 days, you know, I can see it going up to $53. I lose 40 cents in time value, the decay, right? But I still make $2.60 based on it going up the $3 I anticipated to go up in the 30 days, right? So the rule is pretty simple. When you are a buyer of options, you buy 90 days or more, okay? If we were thinking about doing a protective put, if we were thinking of playing the downside, right? Because you can do this on a call, but you can also do this on a put, because puts decay as well, right? We would buy a 90-day, 3-month option or greater. And usually when I'm doing a protective put, I buy 6 months, right? Because I'm expecting the market to go down, but it doesn't always go down, you know, within the month I'm expecting it. It might take a couple of months for it to happen, right? So we definitely want to make sure when we're buying an option, whether it's a call option to go tall or a put option to go to the foot, we're buying 90 days or more. Okay? Now, there are some circumstances where it's not going to matter, right? I'll show you one a little bit later on this afternoon when I'm day trading, you know, where the option value is actually 1 day, okay? But it's a different strategy. It's not a long-term strategy. Longer-term strategy, we want the option to work, and we want to pay as least as possible. We probably on this option, just so you know, kind of like moving forward in time, if I bought a 90-day option on Coca-Cola, you know, I'm probably going to, and Coke doesn't really move, I'm probably going to wait until day 45, right? And then I'm going to get rid of the option and buy a new 90-day option, okay? And the reason for that is I don't want the option to go into the decay curve if I'm playing an upside or a downside, okay? So literally after 45 days, if the stock has not moved or the index hasn't moved, what I do is I kill that option and buy a new one that's 90 days. Okay. Okay. So we definitely, if you have questions, remember, write them down. We'll talk about it at the break. Right. So that can be a great piece with respect to it. Rather 40 cents, right? Rather than losing a full $5. Lots of different types of options, guys. You know, there's 36 different types of options. I'm only going to talk about a few of them. I'm going to talk about single options, vertical options, covered call options. May get into a straddle or a strangle just because of the presidential thing that's happening, you know, in November, which should be high volatility, you know. So, but we'll definitely get into each one of these, understand what they are, how they work, and why they work. Each option has a risk profile, and what you're seeing on the back of this is risk profiles. That basically says that, you know, if the option goes up, it's going to give me X. If it goes against me, it's going to give me Y, right? So I'm not going to get into risk profiles today because they can be a little complicated, and I want to kind of keep it simple for you. But you do want to begin to learn a little bit if you're trading options about risk profiles. Right, we're talking about seasonal patterns. We're talking about stocks. We've been talking a little bit about January barometer. We talked about the best 6 months, right? There's also the best 3 months, which I'll talk about in a second. But I want to talk about the best 6 weeks to trade, you know, a stock or an index. And the best 6 weeks are December 1st through January 15th. And there is a system I use regularly called the Christmas system. I know 4 or 5 of you know what the Christmas system are and the rest don't. So I'm going to kind of review it with you. And I want to give you the trading parameters for it, which are the exact things that you should do. A system, right? A way to, and we do systems trading. We just don't trade blindly. A system means we know when to get in. We know when to get out. We know the probability of success. We know where to reduce risk, right, by putting in a stop. We know what the reward is, and we have a high probability win ratio, right, which means we have a pattern that we recognize, which has been back tested or real life tested, that gives us an exact result. And that's what the Christmas trade is. Christmas trade wins 8 times out of 10. Okay, 8 times out of 10 is pretty good, right? It definitely is a thing. And when it wins, it has not yielded less than 30%, and quite often yields 60% or greater. Okay? So it's a great trade. It's based on the fact, and this is proven since 1950, right? So we've got a lot of data, 70 plus years of this, that the Dow, right, which is the Dow Jones Industrial, the 30 big blue chip stocks, the Dow on average goes up from December 1st through January 15th, 9%. Okay? So if it goes up 9%, we could buy the Dow, right, and profit 9% on the Dow. Now, some years it's 3%, some years it's 9%, some years it's 12%, but on average, the 9% number is the statistically accurate number. So we can buy the Dow. I don't know what the Dow's at right now, but I think it's at like 28,000 or something like that, right? So we probably can't buy the Dow because not many of us have 28,000 to buy one piece of the Dow. So we can, each one of these things, the Dow, the S&P, and the Russell, they have big markets, and then they have mini markets. So we can buy the mini Dow, right? And the mini Dow, the symbol for it is DIA, right? DIA. The mini market for the Russell 2000, and the Russell is RUT. The mini market for the Russell is IWM, right? The mini market for the SPX, which is the S&P 500, is SPY, okay? And they are 1/100th of the market. They track with the market the same. And they're 1/100th, which means they're more affordable. And certainly the options are more affordable, and that's what we're going to do, because we're not going to buy the Dow, right? We're not going to buy the Dow at 280, right, which we did last year. We're going to buy the option, which is maybe 10 bucks, okay? So we will take this pattern and we'll turn it into a process where we'll do really well. So this is the Christmas trade. And if you go in the past and look at it, you can kind of see, put in a large chart, you can see it kind of goes up, right? So this is actually December 1st, 2nd, or 3rd of 2013. Got a nice upward trend. The Dow Jones Industrial is trading at 16,000, all right, which means that the DIA should trade about 160, right? So we are going to trade the DIA on the Dow. Now, I'm not trading the SPX, I'm not trading the Russell. I just mentioned those so that you guys know that the mini market's what they are. But we're going to trade the DIA. So this is the same period of time of the Dow, which is at 16,000, during this period of time, 2013, December, right? And I think it's December 2nd or 3rd that it's trading. Nice steady uptrend, right? And when you see a nice steady uptrend, one of the technical patterns that you'll notice with an uptrend is it goes up a little sideways, up a little sideways, up a little sideways. And you can kind of see here, it's going up a little sideways, 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 right? And that literally is something called a stair step, right? We're stair stepping up, okay? So we are realizing, and I need to just move you guys out of the way so I can go back here, right? We realize that it's stair stepping up. Now, stair stepping is probably going to continue, and we think, you know, that we would buy a call in this situation because we think it's going what? Tall. Statistics say that 9% rate of return on the Dow. That's going to mean, you know, 30%, 60% on the DIA if we buy the option piece, right? So this is where we're at back in 2013. And I'm going to kind of show you the numbers for 2013 if I can move you guys out of the way. Okay. Remember that options decay, right? So if we're going to buy a call option on the DIA, right, we want to buy what? 90 days or more, right? So we definitely want to buy 90 days or more. Okay. So we're gonna buy 90-day option or greater. Now we're in December 1st, 2nd of 2013, which means we're probably going to be buying, right, a March option, right? We're going to buy a March option, right? Mini Russell was IWM, right? So we're going to buy a March option, okay? So here is the option we're going to buy and kind of the result that we're going to kind of see. And you guys are all over my screen here, so I have to move you. Right? Okay, so we're at the Dow is at 1,600. Right today, on the day we're buying, the DIA, which is the mini Dow, right, is running at 159. Right, so we're going to buy, you know, the 159 March position, right, which is 90 days, and that option, right, is $4.55. So that's for one contract, which is 100 shares. So this option is going to cost us $455 to buy. Okay, if this is your last $500, I'm going to suggest you don't do it, because it's a high reward, high risk kind of trade. You want to make sure that this is 5% or less of your account, right? Less than 10%, right? And most people can afford this $500. So if you got $5,000 investing, this is a great trade for you to do, right? And you're going to take one of them. You know, if you got 100 grand, you know, I might be putting, you know, 10 of these to work with respect to it. Okay. So this is actually the Thinkorswim platform. Many of you have Thinkorswim, some of you have E-Trade, some of you have some other choices, you know. But if you take a look here, I'm gonna be on the 12th of December, right? And on the 12th of December, okay, I've got the Russell or the DIA at 159, almost 160, right? And I'm gonna buy at the money or in the money one strike price. Okay. So at the money would be 160. In the money means it has intrinsic value. So if I buy the 159, it has $1 of value already, right? So I'm going to buy the March position, and the mark, which is the average of the bid and the ask, is running at $4.55. So that's likely how much I'm going to spend for this trade. Just so you also know, on Thinkorswim, all the calls are over on the left side and all the puts are over on the right side. Okay, price is always in the center. Okay, so I buy this and buy 100 shares of it, right? And then, you know, I kind of see the price. You know, I see the rate. I want you to write that down. You know, 455, 159, and then what I'm going to do is just fast forward. I'm going to fast forward to the day that we execute, which is January 15th. Right? So on January 15th, we are going to get out of this trade, right? So we go take a look at, hey, I bought it for $4.55. What's it worth today, right? And you can see that the DIA, you know, went up, you know, to 164, right? So the Dow went up, right? When the Dow went up, you know, the DIA, which is 1/100th of the Dow, it went up as well, right? And it is worth $6.68, right? And that's that 159 position, you know, that we bought, you know, 45 days ago, right? And the rule is January 15th, you get out, okay, right? So if it's if January 15th is on a Saturday, you get out on the Friday, right? And we just hold it until January 15th, and then we get out of the trade. Now, take a look at what happened with the DIA. Well, the DIA from December 1st of 2013 through January 15th of 2014 went from 159 to 164, only had a 3% increase, right? So if we had bought the DIA, we would have made 3% on our money in 6 weeks. Not bad, right? But because we bought the option at $4.55, right? It went to $6.68, which means we made $2 on the option, right? $2, right, on $4.55 invested, $455 is about 47%. Is 45% on our money better than 3%? No question. So we definitely want to trade the Christmas trade. Now, that's a trade from the past, which I showed, which is pretty good cha-ching, but how did it do last year? Well, same system. We know what the entry point is. We know what the exit point is. We know what the probability is. We know what the reward is. We know what the risk is, and we know what the time period is. So it's a 6-week kind of time period. We know we're going to get in on December 1st, 2nd, or 3rd, the first Monday. That is the 1st, 2nd, or 3rd of December. We're going to get out on January 15th, whenever that happens, right? We know that the probability of success is 8 times out of 10. Right, 8 times out of 10 we win. When we win no less than 30%, and quite often, 60% or greater, right? So it's a great trade, that you should consider. And in fact, every year I trade it. So you'll get this slide so that you've got it, but understand past position 9%, get in December 1st, get out January 15th. We would like to do it on the Dow because that's where the statistics are, but we do it on the DIA because that's affordable. We enter 90 days or greater, which is usually a March position. We do a call, which goes tall, right? And we do one strike in the price, in the money. And one strike price in the money means that if it's at 160, we buy the 159. If it's at 280, right, we buy the 279. Now, it's not going to fault you if you do it at the money, but normally you want to be in the money a little bit. There are a couple of additions that I've added over the years, right? And these are Jim's additions, not the system itself, right? So when I get in, right, I'm going to look for a support and resistance level below where I get in. So, if I was getting in at the 160 Dow level, and we bought a 159, I may create a stop at 158. Right? Which means if it reverses and goes the other way, it's going to take me out. So one of the lessons I got early is run your wins long, cut your losses short. And what a lot of people do is they let their losses build. They buy Tesla, they say, well, if it goes down to 450, I'm going to get out. But then it goes down to 450, and they say, no, I think it's going to go up some more, and then it goes down to 425. Right? So you want to set a hard stop whenever you go into a trade. Okay. Now you can also do a trailing stop, but a hard stop means I'm expecting it to do this, and if it doesn't do that and goes the opposite way, I'm out of the trade. Okay, and you got to think about what's your maximum loss that you're prepared to lose on the trade. On a $455 trade, the maximum I'm probably going to be prepared to lose is $1. So if it goes down to 355, which I know the hard stop on that will probably be 158 or 157, right? So we do a hard stop based on support and resistance. Once we're in the money, we're into January or anytime before January, we can put in a trailing stop, okay? And what a trailing stop basically means is, the option went from $4.55 to $6.68. I could have at any point with Thinkorswim or any of the other brokerage accounts that are out there, and I use Thinkorswim, guys, you know that, but I've done E-Trade and I've done Schwab and I've done a few other interactive brokers. On any of those, I can create something called a trailing stop. And a trailing stop basically means I can pick a percentage or I can pick a number. So I could say, if for any reason the stock market reverses and the option value goes down by 50 cents, take me out. Okay? So what that will do will allow me, if the market reverses, to get out without losing the profit that I've made. So once I'm in the money, once I'm making money with the option, I definitely consider a trailing stop. And the reason I mention that is because The system says hold to January 15th and then get out. But if it's making money still, right, why not let it run a little bit longer, right? And if you had taken last year as an example, if you let it run a little bit longer, you could have made out like a bandit because it just continued to go up for a while, right? Okay. And you want to have confirmation of direction. Now, confirmation is something from a trading systems, from a trading perspective that you want. Later on, I'm going to show you some patterns. When I show you a pattern, the pattern is going to suggest that tomorrow it's going to be an up market. And you're going to want to buy whatever it is today so that you get maximum profit tomorrow. Okay? And I'm going to say you got to wait for confirmation. Confirmation means I don't buy today at the cheap price. I buy tomorrow at a little more expensive price, but it's going in the direction I expect. So whenever you're trading, candlesticks or charting patterns, or even, if you're looking at overnights and you're looking at doing a day trade, right? You just don't blindly say, well, first thing in the morning, buy me this. What you do is you wait to see if it's moving in the direction that we expect it to move, okay? And you'll see me do this a couple of times, and I'm going to do this right now with this Christmas trade, right? So this is the Christmas trade from last year. So December 2nd or 3rd, whatever that was, we're buying the Christmas trade. The market is at about 280 the day that we're trading. So it's at 280, right? And, being at 280 and it's time to trade the Christmas trade, most people just say, well, buy me a call, right? And I'm looking at the market and it's not going up on this day. It's going down on this day. So I expect it to go up, right, for the next 6 weeks. And today it's going down. Is that confirmation that it's going in the direction I expected? Nope. It's going in the opposite direction. So until I get confirmation it's going in the direction I expect, I'm not going to trade it, right? So this year, I'm looking at the 280 and I'm going, man, it's 280. I can't trade it because it's not giving me a buy signal. It's not telling me it's going in the direction, right? And it goes down that day, right? So, and then it goes down the next day, right? And you can kind of see down here, you got this little doji or mini hammer that happens, which is a sign of reversal, by the way. Okay, but then it moves up a little bit, cross, right, which are a candlestick and a hammer, right? Then it gives me this bearish harami, right? So it's telling me that should be a down cycle, right? So what I did here is I said, you know what? It's supposed to go up through to January 15th. So I set an order that says if the DIA goes above 280, right? Buy a DIA call March 280 position. So I can actually set this, right, and I do this regularly, set this so that when it does go above where it's supposed to be, it fires off, okay? So remember, system says just buy it, hold on to it till January 15th, right? I'm saying create a hard stop if you get into it so that you reduce your loss. And if it doesn't do what it's supposed to do first thing out of the gate, don't buy it. Wait until it does what it's supposed to do. And what it's supposed to do is be over 280 because that's December 1st, it's at 280, right? So I set the order to say, if it goes above 280, get me in, right? Right? So I created a stop, right, which was the bottom piece, right? And I also said if it goes above 280, right, get me in. And literally, I post on the 1st of December what I'm doing with the order that says if it goes above 280, get me into the March 280 call, right? And on December 12th, as I recall, it goes above 280, which means now I have confirmation it's going in the direction it should be going. Okay? You're going to see me do this afternoon when I talk about flag trades, and I talk about what happens when a market goes up and then goes sideways and how to play both sides. We're going to set orders that confirm the direction we think it's going to go based on some system or some technique or some pattern, okay? So this fills. When it fills, it costs me, one contract is $835, right? And I have a 280 position, right? Now, I won't go through all the details on this, but literally, I spent $8.35. We go fast forward to the 15th. On the 15th, it's worth $13.35. I make 60% of my money in a 6-week period. Is that a pretty good trade? Yeah, it is, right? But then I'm thinking, well, she's still on an uptrend, so why not let it run a little bit? Why not put a trailing stop on it that says, hey, it's at $13.35. If it reverses 50 cents, right, get me out. And that would be a trailing stop based on a dollar value. I could also set a hard stop that says, if it goes to this level, get me out, right? But I'm going to do one of those, a trailing stop or a hard stop, right? So I protect my money, but I let it run a little bit longer. Run your wins long, cut your losses short. When you begin a trade, you should have a stop, no question, right? So that the maximum I can lose here is $1 on a contract or $1 on a stock option or an index or whatever it might be, right? Now the stops for me are usually hard stops, or they're a trailing stop, right? We definitely want to kind of learn. Now, if you don't know what a trailing stop is, whatever brokerage you're using, E-Trade or Schwab or Thinkorswim or Options Express or whoever you're using, they quite often have little videos that will show you, certainly Thinkorswim does, about how to do a trailing stop with respect to it. Okay, we're talking about seasonal patterns, and we just profited from the 6 weeks from December 1st through January 15th, which is the Christmas trade. Worst month for the last 48 plus years, the worst month is September of every year. September of every year, we expect the market to go down, right? Now remember this, 67% of the time it goes down, but 33% of the time it goes the other way. So 1 out of 3 times it's going up, and 2 out of 3 it's going down. So how do you kind of use that information? Well, first of all, if you're thinking about buying a stock in September, you probably, if you see that it's going down, right, then you probably want to buy the stock, because in October, November, December, and January it's probably going up, right? It's not the best time to sell the stock, right? So we could play a put position every year in September, right? Knowing that 6 out of 10 times we're going to make money, and 4 times out of 10 we're going to lose money. So it can be a good situation for a put. Another time to play a put, by the way, is in the May or the June period of time. Usually in the May or June period of time, there's a significant drop. That's why they say in the stock market it may go away, because there's usually a drop, that happens in that May time period or in that September time period. So that can be a good time to play a put, right? And when you play that put, you're buying a 90-day put, and you're probably doing that, in August, right? Or the 1st of September to play that September kind of drop. Can be a good time to buy a stock at a cheap price, right? So buy in September, sell in August, or wait until October or November to sell. Best 3 months. Best 3 months are coming up. Best 3 months from an up position, from a going up position, are November, December, and January, right? So those are the best months, for us to kind of trade, to make money on the upside. Now, when I say make money on the upside, when you're thinking about that, right? What could you do? Well, I could buy calls for November, December, and January, right? And all 3 months generally go up, right? We know the December has a big up piece, but November and December do as well, right? So we can buy calls on an index. We can buy calls on the Russell. We can buy calls on the Dow. We can buy calls on the SPY or whatever it might be, right? So it can be. There's something else we can do. By kind of a show of my hands, right? How many of you are trading credit spreads right now? Okay, so about half, right? Okay, so when you think about a credit spread, which is a non-directional trade, right? I have a system, that does about 6, 7, 8% a month, wins 9 times out of 10. And usually what I say is in November, December, and January, you can be a little more aggressive, right? You can be more aggressive knowing that the put position, right, the vertical put, which for you that don't know what it is, we'll talk about later on this afternoon, but that put position, rather than making 30 cents on it, let's make 70 cents on it. Let's make $1 on it. Let's find a support level and be just under a support level and be more aggressive in November, December, and January. Now realize you're breaking the system rules, but you're breaking the system rules to play a directional pattern, okay? Obviously you want to make sure that you see that directional pattern before it happens, right? Right? So, you know, you definitely want to do this. Now, picking a stock or picking an index or picking an up pattern, I'm going to suggest to you, you know, when you're doing this, there's different ways to do it. So, and I don't want to get too complex, but I do want to show you some different systems with respect to doing that, and then we'll get into some options kind of conversations with respect to it, right? So, there are fundamental analysis and there's technical analysis. Fundamental analysis is the company. Is it a good company? Does it have good sales? Is it profitable? Does it have good revenue per employee? Does it have low debt? Does it have assets that are making money? So that's the company, or the PE ratios. That's how that stacks up against other companies. Okay? It can be a great company and you should never buy it because technically it's not the right time to buy it. So there's great companies, right? And then you have to make sure that that great company is the right time to buy it, which is really about the overall marketplace as well as the technicals of the company. So if you can get a good company, you can get good technicals, then you'll get a great trade. And there's all kinds of different systems out there, guys. I'm gonna mention two, go into one in a little more depth, but the other two I'm gonna show you where you can find more information and how to do it. You know, and then I'm gonna use a simple system that if you know nothing about the stock market, you can do in less than 20 minutes once a year, right? And it'll learn on average about 18% a year, okay? Past performance doesn't equal future performance. Investment does have risk. You'll want to know what you're doing before you do it. Okay? So I'm going to talk about CanSlim, which is the first system I learned for investing in stock. I'm going to talk about Buffett's approach, and Buffett's approach is 7 strategies, right? 7 criteria for picking a stock, you know. And then I'm going to talk about 4 criteria that I use, 4 keys that I look at fairly regularly. And then I'll talk a little bit about Dogs of the Dow, you know, which has been a system that's been around since 1973. Okay, so, you know, I really follow Buffett. You know, I studied after I learned the CanSlim method, I learned Buffett's system for investing. You know, one of the things that he says is, you know, never depend on one income stream. You know, so you definitely want to have a second, a third, a fourth income stream, whatever that means to you, right? So this is Buffett's system, right? So are we going to go in depth on Buffett's system? No, right? Okay, it's complicated. It's a system that you can use, no question. I'll show you where you can use it. But what Buffett basically looks at is he goes, okay, you know, what's my return on equity? The equity that's in a company, what's my return on equity? What's my return on debt? Or is there debt? He does not like companies that have debt, right? What's my profit margin? You know, over 5 years, you know, is it profitable 20% or greater? Okay. You know, he looks at valuation. Is it overpriced or underpriced? Right? Coca-Cola, for example, at $40 is incredibly well priced. It is a good buy. At $50, it's okay. At $60, it's not a good buy. Right? Right? So, I mean, stocks have value, right? And Buffett has a way to evaluate that. You know, and I use his system for evaluating what a stock is worth. You know, what's the price based on cash flow, right? And these are all screening parameters that he uses to pick a stock, right? You know, he looks at things like, well, what's the debt to equity ratio on the company, but what's the debt to equity ratio on other companies that are similar? He looks at the employees and says, okay, you know, based on similar businesses, do we earn more revenue per employee on this company or that company? Okay, and these are all scans that you could do, right? You know, you could do all 6 of them, or you could do 1 or 2 of them, right? You know, and one of the more important ones that he does is not listed here, is that Buffett likes to have a company that pays a dividend. He likes to have a company that pays a 2% to 5% dividend, no more than 5%. Okay? Now, the reason he likes companies that pay a dividend is if the company pays a dividend, which means there's extra money in the coffers to be able to pay that dividend, then it's going to attract buyers of the stock. When the demand for the stock goes up, supply goes down, price goes up. So if companies pay a dividend, what you would expect is that the stock value is going to go up over time. Okay? Now, based on that, there's a whole other system that came out of existence called Dogs of the Dow, which I'll talk about in just a minute. But based on that, we can actually trade, right? So that's kind of Buffett's kind of system. This is the CanSlim method, right? And remember, you're getting copies of these slides in particular, so you'll have it. In fact, on the Buffett slide, I actually go into paragraphs of what the scan means, right? So you'll know what it means and how you use it if you want to use it. This is the first system I learned. It's called CanSlim. It's based on current earnings, annual earnings, new products, supply and demand, institutional investors. It's a leader or a lagger in the market direction. Okay, so you can actually go to canslim.com or canslim.net and see the CanSlim method working. Right, it's done by IBD. Right, created by William O'Neill. Right, so it's a good system, been around. Only works in an uptrending market. Right, does not work in a downtrending or sideways market. So when the market's going up, great system, for you to take a look at picking a stock. Okay. Now, where do you do this? Well, lots of brokerages have scans that you can do, right? And if you go to canslim.net.com, you can actually see their scans with respect to it, but you can also do scans yourself. So one of the things that I've been using for years is a website called FinViz, right? FinViz. Now, FinViz allows you, if you go in the top of the tab bar, you'll see Home News and Screener. I can go to the screener, right? And when I go to the screener, I can plug in, show me every stock that has a 2% dividend. And, the 8,000 stocks will go down to 3,000 stocks. Okay? I can go in there and say, show me all the stocks, that have a return on equity of 20% or greater. And it'll go down from the 3,000 to a couple of hundred. Okay? Show me the companies that have debt of X and do it. I can use the CanSlim method. I can say, show me all the companies that are making 25% annual rates of return. Okay? So we can use this FinViz, to goof around, to play around, but to pick stocks, right? And it does the basics of the company, but it also does technical analysis as well as fundamental analysis, right? So it's a great little tool for us to take a look at. It's free, doesn't cost us anything. So we can do the scanner for free. We can use this all we want. So if you're thinking about, I want to be a stock investor, I want to pick good companies, I can say, okay, give me the companies that have a 2% dividend, that have no debt, that have equity returns of 20% or greater, which is 2 of Buffett's approaches, 3 of Buffett's approach, and then pick the stock, and I'll find 80 of them that are candidates, right? So it's a great tool for fine-tuning a stock, right? I've gotten away from doing CanSlim and gotten away from Buffett's, except for the dividend approach, right? And move more into making it kind of simple for myself. So I have a friend named Rance Mashak and Tim Lin, and they were vice presidents for TD Ameritrade for a number of years. They own their own businesses. They're stock traders themselves. Rance used to teach a program called The Pit, right? It was done at the Chicago Board of Options Exchange. You literally went to Chicago, and on the weekend, they turned on the machines for Rance, and we traded options live, on Saturday and Sunday in the Chicago Pit, where they do regular trading on Mondays and through Fridays. And, learned a lot of different strategies from Rance. But Rance and Tim are really engineers of software, right? So got to be a decade ago, talking to Rance and Tim and saying, okay, and they just had built the #1 software for TD Ameritrade, which helps people trade. And I said, so what are you going to do? He said, well, I have a 2-year non-compete. Not sure what we're going to do. Probably not in the software side. but I'd like to build another software program. And I said, well, when you build this software program, do the normal things, like, technical analysis and fundamental analysis, but can you also take a look at Buffett's approach for valuation and insider trading, and whether the insiders of the company are trading? Because I know when insiders buy the stock generally goes up. When insiders sell the stock generally goes down, right? So can you do something like that? And, over a 2-year period, they built a software program and introduced it, got to be about 8 years ago. And it's called iVest Plus, right? iVestPlus.com is the main site. You can actually go to ivestplus.com/fin, F-I-N, if you want to test it out for 30 days for free and get a discount. Because I helped them build it, or was a test subject, I helped work with them on it. They actually gave me a discount for anybody that I turn over to it. So, but this basically works on a pretty simple system. Basically works on green, yellow, orange, and red, right? And if you have green, yellow, orange, and red, green is good, yellow is okay, orange is not moving in the right direction, and red is a no, okay? And it works on the 4 major criteria. 1, is it a good company right now? What's the PE ratio? Is it making money? All those kind of characteristics. Are the sales doing well, right? 2nd, is it technically the right time to trade it? What's the overall market doing? What's the company doing in terms of moving averages? And we're going to get into moving averages in just a little bit. What's it doing in terms of technical competency, with respect to it? And it gives it a grade, right? Right? Gives it a grade based on the patterns that are happening. What's the valuation? Based on the way that Buffett, does calculations, is it a good buy or a bad buy? Is there an upside on this stock, or is it kind of maxed out, right? I mean, you would want to know that you're maxed out, because when you're maxed out, that's when you're selling, right? Because there's no more upside, right? And the last piece is, are insiders, are the directors, the owners buying? In our major institutions, whether it's a major institution or a major mutual fund, are they invested in that stock as well? Because if a major institution's invested in the stock, they're probably holding it for at least a year, right? If not longer than that. So very cool kind of process with respect to it, right? And all right, so I'm gonna get. I see many of us are back, and I did say 10 minutes, so I'm gonna get started. So. We were talking about 4 keys there to fundamentals, and I was mentioning Rance and Tim that built a software program, that kindly they gave me access to, for students and stuff like that. But this is iVest Plus, ivestplus.com/fin if you want to get a discount, and they'll allow you to do it for 30 days for free, and then I think it's like $29 a month. But basically takes a look at 4 major areas: fundamentals, then it takes a look at technicals, then it takes a look at valuation, then it takes a look at insider buying. And it makes it kind of simple to do. When I say simple to do, basically it has a box, and the box is fundamentals, or the box is technicals, or the box is valuation, or it can be insider buying. And it kind of tells you what's going on at that moment in time. So if I think that I want to trade to the upside, I'm looking for the 4 boxes to be kind of green, right? Or at least 3 greens and a yellow, right? Or 2 greens and 2 yellows. And what's really cool about it is that if you're a little bit of a math geek, you can actually go into each one of these and take a look at it in more detail. Now, I just want to know it's a good company. It's technically the right time to do it. It's a good valuation, and the insiders are buying it. So, basically what it does is it says, well, the fundamentals are pretty much all green. And you can actually go in to take a look at the fundamentals in a little more detail. So you can take a look at growth and profitability and cash flow and key ratios. You can go in and take a look at valuations to kind of see, based on PE ratios and the price to books and earning, what's the valuation. You can take a look at it. Hey, are there buyers? Are there owners that are doing it? Are there a lot of insiders that are doing it? And then technically, is it the right time? Now, it goes into more detail. So this is, first you get the 4 boxes. They're all green. And then you can go into the boxes and take a look, a quick look, like an overview. But if you want to, you can actually go into more detail. So it's a great way for us to pick good stocks so that we're not doing, 7%. We're doing 18%, 20% on the stock kind of piece, right? So, and you do want to get good at moving along that path. Now you can actually go into the technicals and the charts and look at different charts and patterns. Some of that stuff I'm going to talk about a little bit about this afternoon when we talk about, moving averages, for example. A moving average, like a 200-day, 50-day moving average, tells you whether the stock's moving up or moving down, right? It actually does things like, okay, find me all the stocks that are this, right? Find me all the stocks that have 4 green boxes, Find me all the stocks that have a moving average that's crossing right now. Find me all the stocks that have a MACD, and I'm not going to talk about indicators today, but that's another way. So you can find all the boxes. And in fact, this is actually a scan from Friday, right? And these are some of the stocks that have 4 green boxes as of yesterday, right? So, and if I wanted to, I could click on each one of them and go into a little more detail. In fact, when I come back from lunch, I might jump in here really quick and just take a look, with respect to it, just to kind of show you a little bit about it. But it's a great tool. It's a tool that immediately tells me fundamentally it's good, technically it's good, insiders it's good, and also the valuation is good. And whether that's big, which I think is big lots, or BRP, or the food place, layaway, LWAY. These are stocks that would be good fundamentally, technically, and also whatever. So it's a great tool. If you're just picking stocks, great tool for you to do, right? And you can go into more detail about the different pieces. You can go into the fundamentals and see growth and probability, and then go into each one of those boxes about the sales performance, right? And we do want to get stocks that are doing. ivestplus.com is the main site, and then /fin if you want to sign up and get a discount with respect to it, right? Okay, so I said there's a simple way of picking stocks, that can earn you about 18% a year, 17.7%, happens once a year, right? And I'm going to take this strategy this afternoon and kind of put it on steroids a little bit, but it's called Dogs of the Dow, right? So Dogs of the Dow was kind of based on the principle that if you give a dividend to somebody, that will get them enticed to buy your stock, which means that there'll be demand. When demand is increased, supply decreases and price goes up. So companies pay a dividend so that they have people, no matter what. I mean, Coca-Cola has been paying 41 cents every quarter for almost 50 years, right? So it pays its 2% dividend religiously for 58 years, right? Hasn't missed a dividend, good dividend stock, right? So it is one of Buffett's 7 criteria for picking a stock, and someone took this and said, well, what would happen if we took this and we went back in time and used it? And, and this is based on the Dow stock market. So it's based on the 30 big Dow stocks, the industrials. So it is the big stocks like IBM, Coca-Cola. They have world reach. They're in pretty much all the countries with respect to it. So it's a great base to begin with. It's Walt Disney, it's General Electric, it's American Express. I mean, it's Travelers. I mean, it's all the international IBM. It's all the kind of big stocks that are out there. Now, these big stocks, several of them, pay a dividend, right? And they call it the Dogs of the Dow because these stocks that are giving a dividend, right, are trying to court you. They're trying to give you a profit or a win, even if the stock doesn't go up, right? So they say it's dogs because they're trying to buy your vote. They're trying to buy your love, for example, right? So that's a simple system. It's based on the Dow 30, right? And what you do is on December 31st, there's going to be a website, which I'll give you in a little bit. And that website you go to and you take a look at the Dow 30 stocks. And you could do this research yourself, but you take a look at the Dow 30 stocks and you find the 10 stocks that are paying a dividend, or what's called a dividend yield. They're paying a dividend this year. It's a one-year trading system. When I say it's a one-year trading system, you on December 31st, even before then, December 31st, you find the dogs, you find the 10 of them, and on the January 1st, 2nd, or 3rd, whatever that first trading day is, you buy the 10 stocks. You buy the 10 dogs. Okay? And when you buy the 10 dogs, you buy them in equal dollar amounts. So if you have 10 grand, you put 1,000 into each one of them. Now the dogs will change each year. So you can't do it one year and then not the next. You have to do it, if I do it this year, then next year I got to take a look at the 10 and I got to go, well, 8 of them are the same and 2 of them, are not, right? So I got to dump the 2 that are not and buy the 2 new ones, right? And don't sell it, obviously, because it's a long-term trading system. This system is meant for a 5-year, 10-year kind of mindset. Best done in a retirement account. Best done, in a retirement account where it's a long-term kind of trade. In fact, later on, I'll show you how to make more money on the dogs. It's something I've been doing for well over 20 years now, right? In terms of making more money on the dogs, right? So literally, you buy 10 of them on the January, and you hold them until the last trading day, whether that's the 27th, 28th, 29th, 30th, whatever the last trading day is of the year. If it's in a retirement account, you sell it, right? Because you'll end up paying ordinary income, if you sell it in a regular brokerage account, right? Because it's been held less than 1 year. But generally on December 31st, you get rid of the stock. Now, if you're doing dogs the next year, you keep the ones that are still on the next dog list and you get rid of the ones that are not on the dog list. It is a diversification of different stocks. You've got stocks that are IBM or Pfizer or Coca-Cola or whatever that might be. So you're in different sectors, which is a little bit diversification. It's also only blue chip stocks. So one of the benefits of dogs is that when the market does crash, dogs gets affected, no question. But when the market crashes, you'll hear CNBC announcers say there's a flight to quality, right? Which basically means they're buying the Dow, right? Because they're buying big stocks they know have been around forever, which aren't going away. IBM's not going away. Coca-Cola's not going away. Pfizer's not going away, right? Those stocks have been around forever. They're going to be around forever because they have international and they're profitable, every single year. So, what that means is while the overall market, the S&P 500 is crashing a little bit, the dogs aren't crashing as badly, right? They lose less than the overall marketplace, in times of periods where it goes down a little bit. It's 1 year trading system. If it's in a brokerage account, personal account, and you sell it, you're going to get tagged with ordinary income. That's why I suggested that you put it into a retirement account where it doesn't matter whether you sell it or not, in the portfolio, because you're not taking the money until it comes out, And just as I talk about that, you do want to take your existing account and turn it into a self-directed account. If you have an existing 401k that is an orphan account, you're not working for the company anymore, make it a self-directed. Even if you can get self-directed, some companies now have allow you the ability to self-direct your retirement. So you want to check with your plan administrator. RSPs up in Canada, right? You want to self-direct your RSPs with respect to a number of different plans up there, right? So we definitely want to take control of this and start to use dogs because it's a great little system, that can do well for us. Equal dollar amounts, best done in a deferred account, meaning a retirement account, with respect to it. And every year you just repeat. You just repeat. Since 1973, dogs has done 17.7% annual return on average each year. Okay, now some years it's 30%, some years it's 20%, some years it's 15%, but overall dogs has done 17.7% or 18%. Okay, so here are the dogs, from 2020. You can kind of see that you've got Dow, Exxon, IBM, Verizon, Chevron, 3M, Walgreens, Cisco, and Coca-Cola. And actually about 2 years ago, one got kicked out. They don't change very often, but they do change every once in a while. Okay. So since 1973, it's been 17.17%. Well, there's something that came up that is called puppies of the Dow. Okay. Now puppies of the Dow is a system as well. It's a 5-stock system. Okay. So rather than buying the 10 Dow stocks, you buy the 5 puppies, right? Now, I wanted to make this really simple for you guys, right? And the puppies on average since 1973 have made 21%, right? Right? So, I mean, how do you make sure that it's a puppy? Well, if you look over, first of all, a puppy here would be the 5 lowest priced stocks, right? So it is the 5 lowest priced of these. So, rather than IBM at, 134, or 170 or whatever it's at, we picked the low one, which might be Coca-Cola at $50 today, $55 when it was posted back December 31st of last year, right? So we pick the Dow puppies, and if you can't figure that out, I'm going to try to make it really simple for you. Look over on the right-hand side, and it says small dog. Okay, that would be considered a puppy, right? Okay, so, and basically on January 1st, you buy the 5 puppies, and then you hold it until, December 31st, 30th, 29th, and then you sell them if it's in a regular account, and you put it in an IRA account. Now, consideration might be, geez, rather than selling it in a personal account, which is what the system says, because that is what the system says, get rid of them every year and buy new ones, I might just want to hold on to them until the 1st, 2nd, or 3rd of January, and then sell the 2 that I got to sell and just keep the 8 that are still there, right? And when I sell the 2 that I sell, I'll get capital gains as opposed to ordinary income. So you can save yourself some tax money, by holding it a couple of extra days if that's what you're doing in a personal account, right? One of the things we're going to take a look at, right, is, we can take a look at dogs and do that in a retirement account and then combine it, right, with a covered call piece, which is an option strategy. So what I'm saying there is, while we own the stock, let's rent it out, okay? If you own a stock, and it's the right type of stock, right, and I'll talk about what the right type of stock is in just a few minutes. If you own a stock and it's the right type of stock, what you want to do is you want to rent it out. You want to rent it out so that that you're making extra income. And extra income would be about 1% a month, right? So if I own Coca-Cola, and I think Coke's going from $50 to $60 over the next year, right? It's got a nice upward trend, and I think it's going to $60, and that's the max that it's going to go to. Then while that's happening, and I'm waiting for it to grow and go forward, what I'm going to do is I'm going to rent that stock out each month. So I'm going to kind of show you how to rent out the stock, whether it's the dogs of the Dow or other stocks that you may own, in just a few minutes. So you kind of do that. And I kind of call that, dogs on steroids, right? So I'm just going to stop this presentation for a second and kind of move to the next one to kind of get us moving along. And we'll probably have lunch there. There we go again. Probably see lunch about 1 or 1:30, depending on how I get through this. First of all, whenever I'm trading, I start with taking a look at the big picture first and then move to the little detail. So what I mean by that is I'm going to take a look at, and this is my checklist, which you'll get a copy of in the notes file, but you can take a look at, what's the world economy doing? I'm going to take a look at what the U.S. is doing, and specifically I'm looking at the January barometer and what it did. Is it bullish or bearish? We're going to talk about technicals this afternoon, so I'm going to talk about moving averages like the 200-day, 50-day moving average, the 30-day, 10-day moving average. Is the market moving up? Is the market moving down? What patterns are there? There are certain charting patterns that have high probability. For example, there might be a double top or a double bottom. Some of you know what that is, some of you don't. We'll go in to take a look at it, take a look at some probability. What are candlesticks doing? What happens in a day can tell you what's going to happen the next day. They've been around for hundreds of years with the Chinese, and they started selling tea and opium that way, and they were probability based. They still exist, they still work. What are the overnights doing? One of the things I look at is, what did Asia do and what did Europe do last night? Because their last night bleeds into our day. What happens in Europe, because Coca-Cola's in Europe, IBM's in Europe, we're a world economy nowadays. What happens in Asia quite often affects what happens in Europe. It affects Europe what happens in the U.S. So we take a look at overnights to kind of say, hey, is it an up market or down market? In fact, one of my favorite strategies to do is to see a 2% change in overnights and trade that day. Okay, and I'll talk about what you could trade that day, a little bit later on when I talk about up trades, down trades, and day trades, right? Support and resistance. Where are the support and resistance levels? And probably more importantly, what's the average price movement in the time period I'm trading? There's an average price movement on the E-minis in a day. There is an average price movement of Coca-Cola in the month, right? So we kind of need to know what the average price movement is, because that's going to tell us, predict for us, hey, if I'm risking 1 unit, am I going to get 3 units in return, right? And then, of course, what's my potential positions, writing them down, and doing the math before I actually do it. I'm also going to encourage you to kind of get a trading journal. What I mean, I don't care whether it's a book or an Excel spreadsheet or whatever it might be, but you want to start to track your trades, right? When I say track your trades, you want to know when you got in, when you got out. I would even say, in the notes sections, when did you trade at what time? Okay, because time period trading can give you some hints as to whether you're doing well or not. And it actually showed me that my trades first thing in the morning did not do as well as my mid-afternoon trades. Okay, now there's a reason for that, right? And it's a reason about the market. But you want to start to track your trades and see what's going on. You may want to get an Excel spreadsheet, and build it so that you know what your trades are and what you're making money. But track, your win ratio, your loss ratio, your return on investment, so that you know. And there might be certain trades that you do really badly at, and certain trades that you do really well at. And the ones that you do really well at, those are the ones you want to continue, obviously. Okay. So I've been trading now since I was 22. So that's a fair amount of time, 40 years. But for me, when I track this, I notice that certain days I do better than other days. And certain hours I do better than other hours. Okay? So that means I get rid of the time period where I'm doing badly and only focus on the time period I'm doing well. Now, there's a reason that occurred, but I kind of want to show you this, right? So I do some futures trading, which is, the 1 to 25 leverage. I do it on the S&P 500. So the symbol for a futures trade is /ES, right? So if you're looking for the symbol on E-Trade or on Thinkorswim, it's /ES, right? And, I can take a snapshot, of a week, right, to see, when do I do well, what days, right? And, this is actually my 55 system. My 55 system I'm going to share with you this afternoon, in a little bit. But the 55 system, certain days, right, it does better than other days, right? Right? So, here, right, you can kind of see, kind of goes sideways. So if it goes sideways, I can make a little bit of money or lose a little bit of money, or I could make a little bit, lose a little bit, make a little bit, lose a little bit, as it plays out, right? So I really don't want to play those days, because that's what I call grinding, right? You're grinding. Remember I told you when I was 42, I tried to get 25 cents, right? You're grinding to get that little bit of money. When there are certain days, right, when there's big movements, right? Okay, so on those days, those are the days you want to be in the market, whether it's a down movement or up movement with respect to it. So a decade ago, I started, even longer than that now, I started taking a look at, well, first thing in the morning, I don't do that well, right? That first hour or 2 hours, it's not as good as, later on, right? So why is that, right? Can I pick the days that are good days? I have a friend who used to be on the Boston floor before they closed Boston, and he's a futures trader. So we were talking about 2 years ago, and he said, so how often do you trade? And I said, well, I used to trade every day, but now, I do my cash flow trades monthly, and then I might trade 1 day a week, okay? But it's a day that I know is going to be a big day up or a big day down, okay? And over time, I learned, I said, yeah, Jim, look, there's only 25 to 50 days a year out of the 240 potential trading days that you should trade, right? Those other days, people lose money, right? Or they're trying to force the trade, okay? So what I'm saying to you is use a system that you know today is going to be a high probability day. It's going to go up big today or it's going to go down big today with high probability, and stay away from the days where you're just trying to, make a few dollars. Okay? Now you can make a few dollars, no question, but I'm going to suggest you or use a system, where if it's going sideways, you're using a different type of system, to make money with. But on those bigger days, you want to trade, right? Certain times of the day. Man, I said that, first thing out of the gate, not the best time for me. Well, it's not the best time for me. And I started to take a look at what happens in the market first time most days. And what happens in the market first time most days is you see the futures trades coming in, right? And then the market opens at 9:30 and there's major chaos. It's either going up or down or sideways, okay? So I noticed that from 9:30 when the market opens till about 10 or 10:15, anything can happen, okay? And in fact, most times it reverses. Starts off down and then reverses up. Starts up, starts off up, and then reverses down, right? And it's the market kind of finding what direction it's going to go for the day. So for me, right, I know the best times to trade, based on the volatility of the market, changes in the market, what happens in the market, is really that 10:15 time till noon. Okay, that to me is more directional one way or the other. Okay, now I use some systems to tell me when to get in and when to get out, right? But I know that that is the best time for me to trade. I'm going to make money on the upside or money on the downside 10:15 through noon, right? Doesn't mean I don't trade noon every once in a while because the pattern's still continuing, but I also know at noon, right, from kind of that 11:45 noon, right, to 1:15, 1:30, right, the brokers on Wall Street go for lunch, right? Right? There's not as many out there. There's not as many trades. People are going for lunch, whatever it is. And the market tends to go sideways between 11:45, 12 o'clock, and 1:15. Sideways means it goes up a little bit, down a little bit, up a little bit, down a little bit, up a little bit, down a little bit, which means, I can make a little bit of money, lose a little bit of money, make a little bit of money, lose, so I don't trade, right? So my trading style is, geez, about 10:15, I'm looking at the market, 10:15, I've looked at the overnights to see if it's an up day or down day. At 10:15, I'm looking, here's the direction. I'm going to play one side, either up or down between 10:15, and noon. I'm going to stay away from noon to 1:15, and then at 1:15 or 1:30, I'm going to play usually till 3:30, okay? Now, why 3:30? Market closes at 4, but why 3:30? Well, that last 30 minutes, weird things can happen, okay? Because the day traders that were trying to make money all of a sudden got to buy everything back, and that can force the value up or force the value down. You can have a nice winning trade, and in the last 30 minutes, it can crush you, right? So usually I like to be out before 3:30, right? Now, it doesn't always happen. Sometimes because of the position I'm taking, happened to me yesterday, right? Because the position I'm taking, I got to wait till 4 o'clock to see what happens, right? But I generally try to be out by 3:30, right? So either make my money or I don't by 3:30 because it's too volatile, right? And that last 30 minutes. And that's true. First, 30, 45 minutes, very volatile, right? Ups and downs, people getting in positions and out of positions. And the last 30 minutes, very volatile, people getting in and getting out. Now, there's kind of a double-edged sword to volatility because if you are buying options and there's high volatility, which is one of the elements of an option, the option is going to be more expensive. If you're selling options, right, the option is going to be sold for more money. And you can be a buyer of an option or you can be a seller of an option, right? But volatility is good if you're selling and not so good if you're buying, okay? Because so we kind of stay away if we're playing directionally, or we're a buyer of options, we kind of stay away from the 9:30 to 10:15, and we stay away from the 3:30 to 4 o'clock, right? So you can kind of see that. So you kind of see these reversals, and then you see a direction. You see it kind of going sideways, a little bit down, right? A little bit down, and then a major direction going up at 1:30, right? And this is kind of typical. Reversal, direction up or down, sideways, direction up or down. Okay, and then usually in that last 30 minutes from 3:30 to 4, pretty much anything can happen, right? It can extend, it can go sideways, or it could drop dramatically based on what's going on in the marketplace. So, based on tracking my trades, I notice there's certain days I do really well, and there's also certain time periods, and you want to do the same, right? Or just benefit from the knowledge that I'm doing. So, trade with the trend, right? Stay away from the grind. When you're choppy, going sideways, stay away from it unless you're doing like a credit spread or something like that. Play the major moves, right? Play big days, right? So playing big days to me means I'm going to watch what happens in Asia, and I'm going to watch what happens in Europe, and that will give me an indication of what the day is going to be like. Now, I said an indication, I didn't say absolute. You know, sometimes Asia will drop, Europe will drop, and then when the US opens, it's already down because it dropped overnight and it opened down, okay? So you didn't get a chance to play the downside, right? You know, and then maybe it rebounds a little bit. About 80% of the time, the Asia-Europe matches what the US is doing, and then every 20% of the time, the US sets a new trend, right? So just be, and that's the confirmation piece, right? That's one of the reasons, you know, if I think it's a down day, I don't buy the DIA put at 9:30 because I need to see confirmation that it actually is a down day, right? I'll give you an example of that in just a few minutes. Visually, you know, this is for the last 10 years, right? Shifts in the markets like the Dow, right? So, you know, 1% or greater up or 1% or greater down, right? That happens, you know, maybe 25 to 50 times a year. But that 25 to 50 times a year, market increases dramatically or decreases dramatically. And then the other days, it's usually between 1% down and 1% up. You know, so, you know, 90% of the time, 85% of the time, it's within a small range, and then you get these big range changes. I mean, wouldn't you like to have caught the $1,000 that the market dropped on February 22nd, 23rd? Right? Wouldn't you have liked to caught a couple days later the next 1,000, and then a day later the next 1,000? Right? Well, we could have seen that overnight because Asia moved 3-4% down. Europe moved 2-3% down. We know the U.S. is going to move 2%, 3% down today. You know, we could have picked that up, you know, right out of the gate, right? So we want to capitalize on those big down moves. So one of the things I do every day, you know, when I'm going to trade, right, and even when I'm not going to trade, just to take a look, is I go to marketwatch.com. Okay, when you go to marketwatch.com, right, and I usually do this, you know, 9 o'clock, 9:15 in the morning. I have a habit of looking at the overnights at midnight as well, just to see what Asia did, because, you know, midnight our time, Asia's up and they're trading already, right? Yeah, I think they're 14 hours ahead of us, right? So Market Watch, what it does is it shows you what happened in the US, it shows you what happened in Asia, it shows you what happens in Europe, right? So, you know, generally speaking, Asia's up, Europe's up, US is up today. Asia's down, Europe's down, US is down today, right? Asia's down, Europe's up, US is probably up, but it's going to be choppy up. Asia's choppy, Europe's choppy, US can do anything. Up, down, sideways, right? Asia's up, Europe's down, US is likely to be down. So what does that mean? Well, it means if the two of them are down or the two of them up, usually the US follows. You know, if they're choppy, US can be choppy, you know, but it also means that, you know, every once in a while it goes against the grain. That's why you need to not only look at this and say, well, today it should be an up day because of this reason, but I also know that 20% of the time it's not. So I need to see what happens out of the gate. I need to see what happens between 9:30 and 10, right? I need to see if it does reverse, what's the direction, right? So it's a good way of us predicting whether it's a big day or not, right? And I don't know whether you're day trading or not, you know, but this is a great way to kind of do it. So I kind of like to make things simple for myself. So I built some rules that I follow religiously. If I see that there is a 0 to 1% change, right? A 0.5% change, I should say, right? If I see a 0.5 point change, and I'll show you this on Market Watch in just a minute, right? If I see that I'm not going to trade. I'm not directionally trading that day. I may take a vertical position. I might take a spread, but I'm not trading up or down, based on the market, because it's going to go choppy and it can go against me, right? So I'm not going to play a call, or I'm not going to play a put. I'm not going to play directionally, play the E-mini to the upside, which is just a simple buy, or E-mini to the downside, which is a simple sell, right? If the trade from Asia and Europe is 0.5, 0.5% to 1%, I may trade. Most likely that trade is going to be a non-directional trade, right? What I mean by directional and non-directional? Directional would be, I think the market's going up, so I buy a call, on the DIA or the SP or whatever, right? Or I buy a put, on that position because I think it's going in a direction. Rather than doing that, I think it's going up today, but I'm not really sure. What I'm going to do is, rather than betting that it's going up on a call, I'm going to sell a put underneath it. Okay? Now, some of you don't know what that really means yet. I'll show you that a little later on with some real charts and some real pieces later on. But what that means is, when I sell something, money comes into my account, right? So I can sell something, an option, money comes into my account, and the only way I lose is if it goes against me, right? But I also have the benefit of the decay, which means that as time goes on, it can expire and I get to keep the money too. So I have two wins. Either it decays and I win, or it continues in the direction I'm going. So you guys that are credit spread traders, this is actually a non-directional directional trade, right? We expect it's going up and we're going to take a position, and it's a fixed position. We're making 10% on our money, or 5% on our money, or 11% on our money. We're making a fixed rate of return, but we have the benefit of knowing there's bias to the upside, right? And if it does reverse, we have a lot of room, right, where we can be okay based on its decaying. And I kind of call this the 3-day system, Monday, Wednesday, Friday, because we trade the SPY or the SPX. We trade the E-minis, and we trade this directionally, but we're doing a vertical trade. And I'll show you this a little bit later on, what we're going to trade. But this can be a great trade. You can make 5%, 10% Monday, Wednesday, and Friday and go home, right? You're making 5% each day. That's a good day at the office, man, right? If the overnights, Asia and Europe, are 1% to 2%, go to work, man. That's a directional trade. That's a buying the DIA call if it's going up. That's buying the DIA put, if it's going down, right? And I don't care whether you play the DIA or the SPY or the Russell. When I'm playing directionally, I tend to play the S&P 500, right? Because the Dow was included in the S&P 500. I have played the DIA, do play the DIA. Christmas trade is a DIA trade, right? If it's 2% or plus, meaning that Asia moved 2%, maybe 3%, 4%, 2% more, or Europe moved 2% or more, then definitely I'm in that day and I'm trading, right? Because that's a big directional trade. That's the 1,000 points that Dow dropped in February 3 different times, okay? You saw it overnight. You knew it was going to happen, right? Still waited my 30 minutes to see what happens first thing in the morning for confirmation. And then once confirmation happens, get into the trade, right? So it can be a great, great trade. Now, some of you that are pretty new, you're going, oh my God, right? That's a lot of stuff, right? But it actually is pretty simple, Bob. Not that hard, right? I know you're thinking about that just as I'm talking, right? So we're looking at Market Watch, and this is right at the top in Market Watch, first page, right? You see it has Asia, it has Europe, and it has the USA, right? So at 9 o'clock, I'm taking a look here, right? And I'm seeing that, geez, Asia, had an up day, right? Okay, I take a look at Europe. Europe had an up day, and this was a little up day. This was kind of a bigger up day, right? 0.6, right? This is all like 0.1. I shouldn't really play, but this is 0.6. It's getting into time period where I trade. So what would I expect the U.S. to do today? I got an up on Asia and I got an up in Europe. Probably going to be up what? Up in the U.S., Not going to be up huge, because it's only 0.6, which is that maybe zone, right? So I could play directional, but more than likely what I'm going to do is a non-directional vertical put trade based on the fact that I think it's going up, but I want to be safe if it goes down, right? And then I wait till 10 o'clock to see what kind of happened. And sure enough, the U.S. has a nice big up day, right? So we can use these overnights, to kind of, here's Thursday this week. Thursday this week, Asia has a big down day, right? Okay, so that's a fairly significant down, right? Is that 1% or greater, right? So I'm looking at the down. Europe has a big down day, right? So what am I thinking is going to happen today in the U.S.? Probably a big down day, right? Right? But remember, 80% of the time it matches and 20% it doesn't, right? Because sometimes you have these big moves down and then, right out of the gate, the US opens low, right? So it didn't have a chance to go down because it wasn't open, and now it's open and it opens 50 points lower than it should be, or 100 points lower than it should be, right? So you got to watch that. That's why I need that confirmation in that first 30 or 45 minutes. Okay, I think it's going to be a down day today, but what's the market doing out of the gate? That's why I wait till 10 or 10:15 to see what it does, right? So, and that's that confirmation of direction I mentioned on a trade. We think it's going to do this based on a technical pattern. We think it's going to do this based on a seasonal pattern. We think it's going to do this based on a candlestick. But we don't trade until we see it actually happen, right? So that's that confirmation kind of piece that we're looking for, right? Right? And then we get a down day, but it's not a significant down day, right? U.S. didn't crash 1% like Europe did and Asia did, right? U.S. only crashed a little tiny bit. The S&P only crashed a little tiny, but it did crash a little bit, right? Okay? So we're looking for those kind of pieces. Here's a couple of others, right, that did it, right? So it's not an absolute. It will happen 80% of the time. It'll happen, but I definitely want to have confirmation that it's a. And what do? Well, we play the direction. We play with the trend. Whatever that trend might be. This is actually Friday, right? And this is on the ES minis. So I look at the overnights. I suspect that it's going to be kind of an up day today, right? That's kind of what the trend is telling me, right? Overnights are telling me it's going to be kind of an up day. I'm looking, and with futures, you can actually see what happens overnight because futures trade 24 hours, right? So they trade during the night, right? Most of the markets open at 9:30 on East Coast time, S&P X or, the SPY or whatever it might be. So I'm looking at the futures to kind of see what happens, and then I'm actually going to go trade the SPX or the SPY, right? So right out of the gate, right, first 30 minutes, big uptrend. 10 o'clock, starts to move down, okay? Now, I'm expecting an uptrend today, and, at 10 o'clock, she starts to move down. So do I have confirmation that it's moving in the direction I want it to? I don't, right? So now I'm thinking, well, I think the overall day might be up, but we had the reversal and it's moving, and that's a definite downtrend right now, right? So I'm just going to let it play. So I let it play from 10 o'clock. I let it play from 11 o'clock. You'll see that there's some lines there. And those are moving averages. I'm going to explain to you what those are after the lunch break, but I use those lines to kind of tell me, should I get in or should I get out, right? So it's basically telling me right now I probably don't want to be in the trade yet, right? So I'm holding on. It's getting near 1 o'clock. It's going sideways a little bit. At 1 o'clock, I'm kind of want to trade, right? So I can kind of trade there at 1 o'clock. Didn't want to do that piece yet. So about 1 o'clock here, right? I get a buying signal. You can see this little cross here with this green and red line. So I get a little buying signal that, geez, looks like it's rebounding, and now I've got direction to the upside, okay? But it's not going up like it's supposed to right from the gate. And it's actually going down, up, down, up, down, up. So it's pretty choppy today, right? So am I gonna buy a call, you know, to trade this? And the answer is no, because it's choppy, right? But I think the overall bias, because of Asia, because of Europe, and it is right now giving me a buying signal, I think the overall bias is it should continue to go up, right? So I could have bought a future on this. I could have bought the SPX on this, right? But I'm gonna buy the SPY, right? Now the SPY, right? You know, is, you know, one hundredth of the SPX, right? So you know, where the SPX right now is trading at 3,490, the SPY is trading at 349. Okay, so and people say, well, I can't afford to buy stocks or options or whatever it might be. Well, I can buy the SPY, right? And here is a purchase of one contract on the SPY, and it's a $1, right, difference. I'm going to buy the 348 and the 347 position. Now, the reason I buy the 348 and the 347 position, I'm going to talk about this afternoon when we talk about technical analysis and support and resistance, but basically it's below a support level, right? I know the stock will come down, bounce off support, and go back up, okay? And rather than buying a call, I'm going to sell a put. And I'm going into technically how to sell a put this afternoon, so you know how to do it. It's pretty simple to do. I basically press a button and get paid, okay? I'll actually see if I can press a button this afternoon. But to take this position is going to cost me, you know, basically $100 for one contract, right? Is $100 for one contract okay? Right? That's what I'm going to have to put into the trade. Now, when I put this into the trade, they actually going to pay me to take the trade, right? So it's going to cost me $100 to get into this trade, and they're going to pay me immediately $10, right? Because that's kind of how a vertical works, right? You're selling something, you're not buying something. So literally, right, if the SPY and the SPX, the S&P 500, stays above, right, 348, right, I'm going to make money, okay? If the option expires, and this is a one-day option, Monday, Wednesday, and Friday, right, on the SPX, right, you have one-day options, okay? So that one-day option will expire at the end of the day. At 4 o'clock, it's dead, does not exist anymore. So I have two ways to win here. One, right, just stays above, and two, it just expires, which I know it's going to do later on this afternoon, right? So about 1 o'clock or 1:15, I do this trade. I also did an XPX trade, and I also did a futures trade at the same time, but I'm just kind of showing you this one because it's inexpensive to do, right? And then this happens for the balance of the day, right? So about 1 o'clock, right? You know, one time I'm in here, right? And then she crashes and burns here, right? Okay, did it go below 348? So as long as it doesn't go below 348, I'm as good as gold, right? So did this trade work out and make 10% on the trade? So even though I bet it's supposed to go up, should go up based on Asia and Europe, I'm doing a trade because I think it's going to be choppy, where all I'm trying to do is make 10% on my money today. How many people would be happy with a 10% rate of return on their cash in a day, right? Right? So we use vertical puts when we think the market's going up or we think the market's going down. Now, I'll address the other side of this afternoon when I get into showing this trade in more detail. But all I'm trying to do right now is say, hey, I look at the overnights, I look at Asia, I look at Europe, I think it's going up today. I look between 9:30 and 10:15 to see if in fact it's going up. If I get confirmation, then I'm going to trade in that piece. If I don't have perfect confirmation, but I think it has a bias to the upside, which I thought that 0.6 in Asia, that 0.6 in Europe tells me a bias to the upside. There was some piece in the morning where it's going up. Then I'm going to buy the opposite side or sell the opposite side to make money. Okay? And this can be a great trade, and it's a non-directional trade. So as long as it doesn't go below you're going to be in good shape, right? Now, the support and resistance piece is about taking a look, well, like, where does it go to in terms of support? Where does it go to in terms of resistance? And I'm actually going to go into that in much more detail this afternoon and show you a flag trade and show you a moving average trade based on support and resistance as well. Okay, so I kind of know that, right? So I'm kind of looking at risk and reward, and I'm looking more at probability. And we already kind of said this. We know that it's going sideways right now. Sideways is a good time for you to be doing verticals, right? We know that we can make more money if we change the rates of return. 15% a year will get you, if you take 10 grand and turn it into 1.5, it'll get you a nice return over a 36-year period. You know, what if we were making 10% a month, right? What we were making 10% a day? What if 3 days a week we were making 10%? Could that be a major shift for a lot of people? In fact, you might get bored of trading like I do, right? We want to make sure we're getting better at these systems, so you definitely want to use them, right? Okay, let's talk about math for a second, you know, before we break kind of for lunch, you know, which will take 30 minutes, okay? So one of the things you've got to get good at is realizing that trading is all about probability. It's all about the reward and the risk and the probability of success. I always ask, and this is something that you should do as well, right? If somebody says, well, you know, you can bet $100 and you can get $300, then I'm always going to ask the question, well, what's the probability of that, right? Because if you know what the probability is, you'll know whether you'll make out like a bandit or not, right? And probability is the key thing. Why do I do the Christmas trade? Because the probability is 8 times out of 10 I'm going to win, right? Right? So, I mean, I want the probability to be part of that. And that means to me, if somebody's trying to convince me to trade a new trading system, I need to back test it. I need to see the data. I need to know that I'm winning, you know, 60% of the time or half the time or 30% of the time, right? And if you've ever done any gambling on horses, you kind of know this, right? You know, I mean, the favorite wins 33% of the time, right? So if the favorite wins 33% of the time, and I always bet favorites, man, I have to have a 3-to-1 return ratio or I'm not making any money, okay? So, you know, if I win 25% of the time, I have to have a 1-to-4 ratio. If I win 33% of the time, I have to have a 1-to-3 ratio. If I win 50% of the time, I need to have a 2.2-to-1 ratio or greater, right? So, you know, that's kind of a mindset that I have because I played a lot of horses in my youth, right? In fact, I owned one racehorse as well. You know, actually my betting paid for the racehorse. That's a whole other story, guys. I'll see if we'll leave that one for another day, right? But, you know, 25% and winning 1 time out of 4, right, or winning, you know, the 4 unit versus 1 is the same as 33 out of 3 or 50 out of 2, right? So I've got to kind of have a goal in mind. And I want you to have a simple goal in mind when you're thinking about stock, right? And that stock piece is, I need to have a reason why I'm doing it, a probability of why I'm doing it. Like I know a double pipe bottom, that stock's going down and we see a double pipe bottom, I'll show you that a little bit later on, has an 88% chance of winning if it crosses the neckline on the upside. Well, 88% is a pretty good number, right? Right? So I know at 88%, I don't need to make much to make up for the fact that the percentage is high, right? When I do credit spreads, win 9 times out of 10, that's a 90% probability. It's actually higher than that. It's about 94% probability. Well, a 94% probability means I'm going to lose 1 time out of 20, right? So I know I can win 6%, 7%, 8% each month, you know, and I'll have money left over when I lose, right? So you've got to start thinking about, you know, I'm betting X to get Y, okay? Simple goal, win 60% of the time. Your goal should be to win 60% of your trades, which means you need to track it. You need to know on paper, you know, on an Excel spreadsheet or a piece of paper, geez, when I trade this, I win 60% of the time. And it might be by trade. You might do really well on the SPX, but you suck on futures, right? You know, and one of the reasons that happens for a lot of people is they start watching the thing going up and down and start freaking out because they're losing money or making money, right? You know, so you want to win 60% of the time, and you want to win two or greater. If you win 60% of the time and you're doing bet 1 unit to get 2 units, over time you're going to make a fortune, right? Now, if you can get that 60% to be 3-to-1, you'll have a great career as a trader, right? But you have to track it, and track it by trade, right? Christmas trade. So Christmas trade is my trade. I know I win 8 times out of 10, and I do 30% or greater. Okay, if I'm doing a futures trade, I know what my win ratio. I know it's 68% on a futures trade, right? So I know what my win ratio is, and I know what my rate of return is. And you want to do it by the type of trade that you're doing. You might be really good at stock trading, and you might suck as an option trader, right? So what do you need to do? More stock trades, right? Or get a better system, with respect to it. So we want to get to that 60% or greater. And I would actually say 3 to 1 is where you want to be, right? You want to have a 3 to 1, right? So let's say that I'm thinking about, buying a stock. I want to win 3 units, right? And I want to only be able to lose 1 unit if I lose, right? Well, I know my break even on that is I have to win 33% of the time, right? If I win 50% of the time, I'm going to do really well, right? And you can do the math pretty easily. I do 10 trades, I win 6, I make $3, I make $18, I lose 4 trades, I lose $1, I'm making $14 on a $10 account, right? So I know that that's a winning system for me if I win, 50% or greater, right? Anything over 33%, I'm actually going to win on that kind of system, right? So that's kind of a nice concept, a nice piece, but how do I move this, right, into reality? Well, first of all, the risk of the $1, has to be about a hard stop, right? We're going to talk about Coca-Cola in a minute. Coca-Cola trades, $50 a share right now. If the maximum I think I'm going to win on Coca-Cola is $3, I think in the next month it's going to move $3 from $50 to $53. My stop has to be, $1 or less. Okay, right? So I know if Coke goes from 50 down to 49 bucks, I need to be out of the trade, right? So you can create a hard stop based on a dollar amount, right? You can create a hard stop based on a support level, right? So Coke has certain support levels, right? What I mean by support is when it goes to a certain price, there's buyers, right? When it goes to another price, there's sellers, right? And every stock has support and resistance. So I want to know, what is the average trading momentum? What's the average price movement of a stock in the period I'm trading? Now I'm talking about trading Coke in a 1 month period, and I know Coke's number is about $3, right? I know it goes up $3, probably down $2. That's kind of how it does, but it goes up $3. Generally, sometimes every once in a while $4, but $3 is kind of the maximum it moves in a 1 month period of time. So I know if I'm risking on Coca-Cola, the maximum I can afford to risk on Coca-Cola with a 3 to 1 relationship is $1. Now, I know that's a money piece, but I'm also going to take a look at where is the support level for Coca-Cola. If Coke goes down to $40, right, Buffett starts looking at Coca-Cola. If Coke goes down to $37.50, he starts buying Coca-Cola. If Coke goes down to $35, he's buying Coca-Cola like crazy. And the way he does that is he actually sells puts at 35, right? That's a whole other strategy. Not going to have a chance to get to it, but he actually makes money and actually buys Coke at 35, right? So we can base a stop based on a dollar amount. We can base a stop on support and resistance, but that stop has to be relative to what you're getting, the 3 to 1 relationship, or moving up money or down, right? You'll hear some people say you can do a stop based on percentage. If the stock or the option moves down 10%, get out. I'm not a big fan of the percentage method. I'm either going to do it as a hard stop or a dollar stop, right? Right. So we definitely want to kind of do that. You have to know why you're buying the stock. Why are you buying the stock, or why are you buying the option? And stupid things are things like, I heard it was good. Tesla's a good buy right now, right? I mean, who the hell's telling you that, right? Do you know how many people there are out there that do false blogs to pump a stock? Thousands, right? Right. Certainly in the penny stocks, that's how they make money, right? They tell you it's worth 2 cents, it's going to 6 cents, right? And they have bought it at a half a cent, right? So they're making money the day you buy it, right? You heard it on Kramer. Drives me crazy. Kramer says that this stock is a good stock. Kramer is an entertainment program. 3 years ago, he came on the air and said, if you lost money listening to me, that's not my fault, because this program is for entertainment value. Ding, 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 right? Okay. So, you know, he may point you in the right direction for a stock or whatever, but he is not the best stock trader that's out there, guys, right? If it's on Kramer, it's probably already too late, right? Okay. A friend made a lot of money buying Bitcoin, okay, the one that's out there right now, right? Now, I got to be honest about this. I have never bought a Bitcoin. Likelihood is I'm not going to buy a Bitcoin, right? And the reason for that is it's more about news than it is about the profitability of Bitcoin, right? Technically, there is some reasons to buy Bitcoin. There are certain times that, you know, and I was tempted a few times to do it, you know, where Bitcoin gets to a certain level of support, and I know it goes back up to a certain level of resistance. So tempted, but there's too much government agency that might be involved, too much black stuff behind the back of it all, you know, the dark web. You know, I'm not interested in getting involved in any of that. You know, if you made money on Bitcoin, congratulations. I have friends that made money on Bitcoins. You know, heaven forbid you get into the multi-level Bitcoin stuff, which is all about multi-level and not about Bitcoin at all, right? You know, but you know, if I was trading Bitcoin, it would be technically, it would be, what's my resistance? What's my support? What's my average price movement? Key message for you to hear right here. What's the average price movement in the time period you're trading? What's the average price movement in the day trade I'm doing? What's the average price movement in the week trade I'm doing? What's the average price movement in the month that I'm trading? Okay, if you're trading daily, weekly, or monthly, right? So you want to kind of calculate that. I like it. I hope it does well, right? That doesn't make any sense to me whatsoever. You know, I want to hear things like, hey, it has a high probability, right? It has a high delta, you know, in terms of it's gonna be in the money. It broke support or it broke resistance, and there's a good chance it's going down to the next level or up to the next level. Past performance shows this. You know, the seasonal patterns tell you this, right? The Christmas trade, you know, from 1950, you got a pattern. There's back testing of data, right? There's a charting pattern that's happened. You know, there's a guy out there that sells a $1,000 4-hour training, and all it does is a double top, right? Which is an M pattern, okay? And that's all he teaches, and he charges $1,000, right? And people trade that M pattern, and they make money, so they're happy, right? I'm going to show you the M pattern, the W pattern, the double pipe bottom, the wedge. I'm going to show you a dozen patterns this afternoon, right? So you can make some money as well, and it didn't cost you the $1,000. Candlestick patterns, okay? I'm a big candlestick guy, right? When I retired, that's how I traded. Support and resistance and candlestick patterns. Candlestick patterns can tell you if it's moving up or moving down the next day. Candlestick patterns can tell you it's moving up or moving down in the next minute, right? So candlestick patterns are great things that you want. And there's 10 of them that you must know, and there's 70 of them you should be kind of familiar with, right? So we should at least talk about the 10, shouldn't we? Right? Now, one of the things you got with the training program here is you got 70 candlestick patterns, right? I'm also going to give you the $1 million patterns, which are the 10 most popular ones that you want to learn, and that'll come with the notes today. And a systems trade, right? Or Jim says it does this, right? Because if Jim said it does this, guess what I've done? The homework, the back test, the real trade to make sure it works. So let me give you a high probability system that you can trade, and then when we come back, we're going to put it on steroids a little bit, you know, by learning something called a call or a covered call position, which will teach us how to buy a call and to sell a call at the same time. So dogs of the Dow, right? You know, the puppies, you know, 20%. We already kind of learned that. We'll when we come back, we're going to learn how to make the additional 1% a month by doing a covered call. Charting patterns are something a dog would be a reason for me to buy a stock, whether that's Coca-Cola or IBM or whatever it might be. Charting patterns is another reason, right? So here we have a downtrend, right? We have a downtrend, big downtrend, and at the bottom we have one big down day and one big up day, right? And then that is called a double pipe bottom, okay? So a double pipe bottom is a pattern that might happen on a stock once every 2 years or so, right? Sometimes more frequently that if it's a volatile stock. But when a double pipe bottom happens, we draw a line across the neck, the top of those two candlesticks. We draw a line straight across. And if it breaks the right-hand side of the line, there's an 88% chance it's going to go up. Okay, is that a reason to trade this chart? It is. Now, this is the Russell, February of last year, right? What happened in February? Boom, right? Double pipe bottom, sign of reversal, right? Right? No, it may not. It may go sideways and continue down, but double pipe bottom's a sign of reversal. If I draw a line across the neckline, and if I see it open above the neckline in the next day, 2 days, 3 days, highly probable it's going up with about an 88% correlation. Okay, so what do I do here, right? Well, I think I've bottomed out. Might be time you need to stop playing the put side, maybe start thinking about the call side, right? Or maybe buying a vertical put at the bottom to just make a fixed amount, right? But what I do is I draw a line, right? So I draw a line across it, right? And as soon as I got to wait for confirmation. Even though I see this double pipe bottom, I don't buy that day. What I do is I wait for that candlestick, which is confirmation it's going in the direction it should. And that's when I buy the rut. That's when I buy the mini rut, which is the IWM, or I buy the call on the IWM to play the upside. Are you guys with me here? If you are, say, oh yeah, or put your hands up nice and high so I can see them. Right? Good job. All right. So I'm waiting for confirmation. So when I see a pattern, and I'm going to show you a hammer pattern and a doji pattern when we come back from lunch. When I see those patterns, I don't trade that day, and I know the next day is going to be an up day, right? I wait until I see it's an up day, and then I trade it, right? So we wait for confirmation that the stock, the index, the call is going, or the option is going in the direction. So I draw the line across the neckline, which is the top of those two candlesticks, the big one down and the big one up. I draw a line right across, and the moment the stock, the index, opens above that number, right? The moment it does, I'm into the trade on the upside. So I'm confirming. Now it means I'm going to not make as much money because I could have got it at a cheaper price, but I'll win more often, okay? And in this game, it's about winning more often, guys. Not about hitting a home run. It's about consistently doing 68% on your trades every year, right? And to do that, you got to be better at the confirmation side. Now, just taking a look at this, when it breaks, right? It breaks the 1070, which is that level. And I'm just going to kind of show you a couple of potential trades that could have happened, right? I could have said, well, you know what? I want to buy a call option on the Russell, right? And if I had bought the call option on the Russell back then, that's the Russell, which is 2,000 stocks. It's priced pretty expensive. It's at 1070, right? I can buy a call option at the Russell, and you can kind of see over here, it says 1070, right? Which would be, if the Russell goes above 1070, get me into the position. If the Russell goes above 1070, buy me a 1070 call with at least 90 odd days. And I couldn't quite get 90 here, so I got 86, right? And it's $117 per share. So this would be kind of an expensive trade, wouldn't it? I mean, you got one contract is 100 shares, so it would be 100 shares times 118 approximately, right? So that's a pretty expensive trade, right? But what happens to the Russell? She friggin' takes off, right? Right, when she takes off, I mean, you're looking at a few days later or 90 days later, that option is worth $354. Cost us $100 for the option. Now it's worth that's a 350% rate of return, right? Now, some of you will not be able to buy that option because it's just generally too expensive. But do I have to buy the rut? Can I buy the mini rut? And the mini rut is the IWM, right? So I can buy the IWM, and the IWM is not going to be $118. It's going to be about 1/10 of that. So it's going to be what? $11, right? $11 times 100, right? Is that a reasonable trade, right? Would you spend $1,000, to make 3,500? That's a pretty good rate of return, right? Right? So you do want to know a couple of things when you're trading a stock or an index or whatever it is that you're going to consider to trade. And you want to know the support and resistance levels, which we'll get into after the lunch break, which we're going to take for 30 minutes. But what you also want to know is, and this is an important message for you, write it down, put it in your head, think about it. What is the average price movement? I'll say that again. What is the average price movement in the period of time I'm trading? Okay, so if I'm trading Coca-Cola for a month because I'm going to do some options trading, I'm going to buy a 90-day option, but I'm trading it for a month. I need to know that Coke, is trading $3 in a month, right? I need to know if I'm doing a day trade on the SPX or the SPY, what's the average movement on the SPY or the SPX during that one day, right? And it could be, on the SPX, 40 points, right? In fact, I kind of know it's 40 points, right? Right, that's the maximum movement, and usually it moves, about every 18 or so, right? Up 18, up 18, up 18. So I need to know what that average movement is, right? So you figure out the average price movement on the day, or if you're a weekly trader, on the week, or if you're a monthly trader, on the month. But you need to kind of know that going in, so you know that I'm betting 1 to get 3, okay? So, and later on, we'll use support and resistance to put that a little bit better, right? So, and you got to kind of think about what you're going to trade. Are you a long-term trader, and I'm just looking for a good stock? Then I might be thinking about dogs of the Dow and just holding on to it for a year and then doing another strategy we'll talk about after lunch, which is a covered call strategy to make money, rent it out each month. I may be thinking about being a swing trader, where I'm doing a trade for 3 days, 3 weeks, maybe 3 months, right? I may be a weekly trader where I sell a credit spread each week or I sell a covered call each week, or I might be a day trader. But whatever you're going to do in terms of a period of time, listen to me really closely. You need to know what's the average price movement of the stock, the index, in that period of time, which means you need to take a look at the past and say, well, on average, it moves $3 up. On average, during a day, it moves 20 points to the upside and 10 points to the downside. Now, I've been trading the Russell 2000 now, right, for well over 19 plus years, right? So I've been trading that. I do credit spreads on the Russell. If you had asked me a year ago, what is the Russell trade at? I would have said, well, the Russell on an up day trades between, $6 and $12. And on a down day, it trades somewhere between $8 and $16 on the downside. Okay, actually has more downside than it has upside. I mean, it's 2 times bigger drop than it has on the upside. Now, because of what happened in February, has the average changed? It has. It got much more volatile, right? So now, right, a movement on the Russell on the upside or downside can be 30 to 50 points, right, in one day. Okay. So the average changes based on the volatility of the stock or the index. Stocks are a little more volatile right now. So, Coca-Cola, which is trading about $3 a month, if you went back 2 years, you'd see it's more like $2 a month, right? So what I'm saying to you is, it's not an absolute. I do it one time. I do it all the time, right? This week, trading the E-minis will be different than last week. Okay, and I need to know what's the average movement the last couple of days. Is it big or is it small? What's the average movement? Because that tells me how much I can bet to get the result. Okay, but you've got to get that average price movement based on your time period, whether it's a day or a week, and it's got to be as current as possible, right? So we're looking for average price movements. And what I'm basically saying is, you're going to look at a stock, right? And when you take a look at a stock, and this is just a hypothetical, not a real one, and I'll go to a real one in a minute. Man, it starts at $47 and it goes to 55. When it moves up about $8, right? Right. When it drops, it went from 55 to 52, so it's about a $3 drop to the downside. When it moved up from 52 to 62, right? That was a $10 move, right? So I look at kind of the last two to kind of figure out what it is. So if I have kind of an $8 move and a $10 move, that means I'm averaging about $9 on the upside, right? If I have a $3 move and I have a, whatever the next one is, right? I think it's 60. I know that, geez, it's about a $2 move to the downside or 250, right? So can I anticipate that the next move up is probably going to be about $9, right? So I know if it's a $9 piece, my maximum risk is probably $3, right? Because I want to win three to one relationship, and I want to win 60% or greater. Okay, so you start thinking about, well, the most important thing is, what are you risking compared to what you're getting? And the only way you're going to know what you're getting is if you look at the past history and find what the average price movement is for the period of time that you're trading. Okay, and that will help you in terms of your trades. This is a practical application to stock, right? So this is Coca-Cola. So literally with Coca-Cola, I can take a look and see what the big move is several months ago, and then kind of see, well, geez, it's about a $3 move in here, right? And when she reverses, it's kind of like a $2 move, right? Right. So we can kind of figure out that, geez, the relationship there, a small move on Coke's $2, a medium move is $3, a big move is $4. I haven't seen a big move for a while. It's mostly $3, right? It's trading at 50. If I think in a month it's going to go to 53, then my maximum risk is going to be $1. So I'm going to set a stop at $49 or a hard stop based on support, right? So I'm going to get out at 49, right? And play, well, am I going to risk $1 to make 3? Okay. Kind of simple math, right? Right. So we don't make it too complex, right? And one of the key things here is, what's the probability of success? And the only reason I would trade $1 for $3 is I see a pattern, I know a pattern, I have a high probability trade, I see a technical pattern, a seasonal pattern, or something that I know. And I know based on Coca-Cola, because I've studied it for, almost 40 years now, right? It's one of the first stocks I bought when I was 22, 23, that Coke generally goes from 40 to 50. When it gets to 50, when it breaks, and it doesn't break always at 50, when it gets to 50, it goes to 60. Right? Then at 60, it reverses back and goes down to 50 or goes down to 40. So I know that there's a good upside on Coke. I also know that the average trading range for Coke is $3. So I could risk buying Coke, to get the $3. Now, I would not do that personally. It's not a bad idea. There's nothing wrong with it. But if I believe that I can risk 1 unit to make 3 units on Coca-Cola, what am I going to do instead? I'm going to buy the option. Why buy the option? Because I can buy so much more, it will cost me so much less, right? So I may look at the math here, but definitely I'm going to buy the option, right? Right? And this is literally as of Friday. Coke's trading at $50, right? So 100 shares of Coca-Cola is going to cost me $5,000, right? I can actually buy the 50 call option, 90 days, right? 91 actually, as of Friday, which means on Monday it'll be 89, right? Right. So there's 91 days left of this option, which is the time period, right? And it's going to cost me about $218 to buy it, right? 218 times 100 shares is $218. 5,000 to own Coca-Cola, $218 to own Coca-Cola. $3 move. $3 move was going to get into the math of how an option works. I'm going to spend more time on that this afternoon. But at a 70% delta, it's going to be about $2, right? So the Coke's going to move $3, the option's going to move $2, right? So would I, and that's $2 per share, right? Which means that this option, right, could literally almost double, right? Would that be a pretty good risk-reward ratio? Right? It is, yeah, no question, right? Now, I mentioned the delta. Right, when you're doing an options, and this is an option chain, right? You can see that here's Coca-Cola at $50. That's the strike price, right? That's the purchase price and I'm using the mark, which is the average between the bid and the ask, 2.1. So times 100 shares, right? Coca-Cola is trading at $50. And I'm looking at what the last one was just to see if I could get it for 2 something, and I can. But, when I'm doing that, I'm also going to take a look at what the delta is. So I changed this column to say delta. Now, delta is a way that we evaluate options. And
The delta basically tells you there's a 70% chance that it's going to be in the money at the end of the 90 days, right? And it also gives me the math of how much the option will increase per dollar. So if Coke goes up by $1, the option is going to go up by 70% of the $1, right? So the option here is going to go up by 70 cents, right? Right. So the deeper you go in the money with an option, the higher the delta, right? But we definitely, you know, would see about a $2 increase. If we're shooting for $3 on Coca-Cola and it does go to $3 on the Coke, the option value will go up about $2, right? So we can get into a little more conversation about that piece. Not really important to me. I think Coke's going up to $3. I know the option's going to be about 70% of the $3. Now, how an option is priced is the Black-Scholes equation. We're going to spend the next 4 hours doing the Black-Scholes equation so you know how to price an option correctly and you can do it yourself. No, we're not. We're going to let the masters do their thing, right? All we care about is what's the price of the option, right? Some of you probably options been the first time I've talked about them a little bit. SPX, SPY, the futures is the first time you've heard it. You know, some of the language may be a little Greek to you. Like delta was Greek to me. I didn't know what that meant when I first got started, right? I thought delta was a frat, right? So you know, you wanna learn, and the way you learn is through repetition, right? So if it is a little Greek to you, you'll see it will become clearer than this afternoon. But also because we're going to get into what an option is and how it works and why it works, and you actually trade it a little bit on different stocks and different futures and things of that nature. But just hang out, right? Don't worry about it a little bit. And it's like anything you learn. Greek the first time, you know, oh, I'm getting it, oh, I'm getting it, you know, and you start practicing and it gets better and better, right? Practical application to day trades, right? I know that the SPX, right, which is something I trade, the SPX, right, you know, the moves on that, you know, up and down is about 40 points in a day, right? So it's going to move 40 points up or it's going to move 40 points down. And that is as of yesterday, okay? Could that change a month from now, right? Okay, so we're October 17th of 2020. So if you read this video a year from now, you need to go figure it out what it is today because it could have changed, right? So we definitely want to figure out what it is. And I also know, you know, what the moves are, right? I got that 40-point piece, but here is the last, you know, 5 or 6 days, right? And I can kind of figure out what an up move is and what a down move is, right? Right. So I know that. I also know that, you know, I can do it. I mentioned this trade that I did, right? Okay. So, you know, we can kind of see the profit, you know, with respect to it. But I want to use that piece, right? E-minis have high leverage, right? So just kind of want to kind of talk about futures on an E-mini. If I trade the option either goes up or down, the vertical goes down. Futures is a little bit different. So futures has high leverage, you know. If you're doing think or swim futures, one contract, which controls 100 shares, you know, costs you $6,000, right? That's a pretty expensive buy for one contract, right? So a $1 move, right, on the E-minis, right? So if the SPX goes up by $1, right, the E-minis will probably go up by $1, right? There's almost an exact correlation. But when it goes up $1, that means to me a $50 profit, okay? So for every 25 cents on a futures trade, right, I make $12.50, okay? Right? So here is a trade from Thursday this week, right? I think it was Thursday this week. But this trade, right, you know, we decide in the morning because the overnights were all positive, it's going up. Right, and we for whatever reason buy in at 34.07 on the trade, right, and then it just continued. Now the reason we got into the trade is because of a moving average, which I'm going to talk about in the next section, right? But we get into the trade because of a moving average. It gets in at 307, tells us to get out at 35.36. There's a $39 move to the upside, right? So I take $39, right, of E-mini of SPX movement up. I take $39 and I multiply it times $50. and I do $1,950 in one day on a $6,000 investment. Pretty good rate of return, 33%. Based on overnights where Asia was up significantly, Europe was up significantly. I think it's going to be up significantly. I get a technical pattern that after about 10 o'clock kicks in, right? And I buy the technical pattern at 10 o'clock after I see it's moving in the right direction, which is confirmation it's moving in the right direction, and I get a technical confirmation, which we're going to talk about in the next section, right? Goes up 39 bucks, make 1950 on a $6,000 investment. Is that a pretty good day at the office? That's Thursday, right? Now, listen to me really closely. I do trade futures in my Thinkorswim account, but I also trade futures, right, in other accounts, okay? And there's two in the US that you can consider. One is called Infinity Brokers. It will be in the notes that you'll be getting, right? And the other one is called AMP Futures, okay? Infinity and AMP, to get into a contract, one contract, which Thinkorswim charges you $6,000 for, AMP and Infinity will charge you $300 to $500. So literally in AMP, could I have spent $500 to have the same contract and made the same 1950? Because the movement was the same, right? So when you get to the point where you're thinking about do futures trading, you want to use a brokerage account that specializes in futures. And the ones that I've used in the past and still use is AMP and Infinity Brokers, right? Canadians, you guys, Infinity will not take a Canadian account, so forget them. But AMP Futures will take a Canadian account, right? So you can actually trade. Now, I'd rather put $500 down on a contract than putting $6,000, because I can buy more contracts with the 500, right? So if you're thinking about futures, you want to think about doing ampfutures.com, right? Right. So we can also, kind of think, what's the average movement here, right? So if I'm looking at the E-minis, right, which is the S&P, right, the S&PX, right? When she moves up about $18. When she moves down about $6. That just happens to be what? About a 3-to-1 relationship, right? Right. So I kind of know, geez, if I'm going to set a support level, wherever I get in, it's got to be $6 less than where it is, because that's how she moves, right? Right. Or I can set the support level based on a past support level. Now, literally, all I'm doing, guys, is taking the day, and this happens to be 10:15. And I'm saying, well, when she moves up this. And when she moves down, she moves up this. And I do it based on the current information, right? What's available to me this week, this month, whatever period of time. And this is on a day trade. So I'm actually doing it on the day and the past day as well, right? So I'm taking a look at what those movements are. And I also know that the maximum there is about 40 points, right? So we're taking a look. And you should always be taking a look at what am I risking to what am I getting? And more importantly, what the probability is, and of course, rate of return and how much, right? I love spreads, right? And one of the reasons I love spreads is the math works, right? When I watched Joey show spreads for the first time, and I watched him do a 2-hour kind of introduction to spreads, the math got me right away. Win 9 times out of 10. When you win, back then we were doing 10, 11, 12%. Today we're doing 6, 7, 8%, right, per month. Right, win 9 times out of 10, a little higher probability than that. When we lose 30 or 40%, right? I kind of figure out real fast that, geez, that means I'm making 50, 60% if I lose once. If I can turn that loser into a winner, I can make 80% or greater, right? So I love the math of spreads because it works, right? And if you can begin to marry, and this is for you guys that are spread traders right now, if you can marry the one time out of 10 where it goes against you, right, where that credit spread is going to cost you money, if you can marry directional trading, that, geez, I see it's moving against me, let me switch to be a directional trader, right, you can turn that loser into a winner, right? And when I say a winner, I mean, rather than losing 30%, you might make 10, 15, 20% on the trade or more, right? And that is kind of one of the things you do. Have you guys enjoyed like the morning so far, right? Put your hands up nice and high. Did you learn something you didn't know? Right? Do you think there might be more to learn? Right? There's always more to learn. So when we come back after the break, and we're going to take 30 minutes to kind of grab lunch. I think it should be about 1:30 or so. Right? We're going to take 30 minutes, so we'll be back in here at 2 o'clock East Coast time. Right? Still got a full 3 hours left. When I come back, I'm going to show you how to take the dogs or any stock and rent it out with covered calls. I'm going to teach you a little bit about how an option works. I'm going to teach you a little bit about how a vertical works. I'm going to get into technical trading, which will get us into support levels and patterns. And all of these patterns, you know, are provable. They're real. They exist. And if you can recognize the pattern, you know what's going to happen next. I'm going to talk about candlesticks and the doji and the hammer and the harami and the engulfing pattern and the 3 white soldiers and the 3 black crows and what that means and how it works. And all of those patterns are trading patterns. I'm going to show you how to do a flag trade, you know, so that you can play either side. You don't know what side, you don't know if it's going up or going down, or there's a high probability it's going up and a low probability it's going down, but it's not going sideways, so let's play both sides. So I'm going to kind of show you that system. I'm going to come back and talk about vertical puts directionally, playing the upside in November, December, and January, or playing it on a day trade, you know, if you think the market's going up, or I gave you a little taste of that this morning, but we're going to get into how that works and why it works a little bit later on. So if you've enjoyed it, you learned something, you're getting value out of it, give me a big thumbs up, right? So that's still doing well.
Yeah. I got a quick question for you regarding the Christmas trade. Can I ask?
Yeah, for sure. Yeah, for sure. Go ahead.
Oh, so when you were talking about the trailing stop on the Christmas trade, is that something that you would put starting on the 15th of January, or do you put that during the duration once it's profitable?
It's up to you. I mean, some people, like, I'm in the money. If you do it while you're in the money, you got to leave enough room based on the average movement down, so you don't get taken out early, because then you miss the rest of the trade.
Yeah.
So basically, I just believe in the trade, so I just let it run until January, and then in January, I kind of go, it looks like it's got more room. I'm just going to throw a trailing stop on it, let it run a few more days. You know, I mean, that trade last year, if you did what I did, it was about an 85% rate of return trade, right? Because I think we went to like the 17th before we got out, you know, which was over the 15th kind of piece, but then it kind of reversed a little bit. You know,
yeah.
So I usually put that trail in the last week, right?
Okay, so you could tighten it up near the end, basically.
Yeah. Well, I would like to see it. I mean, there's been a few years where I got out on the 15th, and she ran for the next 2 weeks, and I kind of went, crap. You know, I made 60%, and I could have made 100%. You know, right. So and then one of the rules I have is, you know, run your wins long, right? So if there's no like if it's still got some pretty good candlesticks, right? It's not hesitating at a resistance level. Just let that friggin' thing run and let it run the next 2 weeks, because when you get into, you know, February into March, now you're getting into, you know, day 45 left, and you're going to start to see decay. So even though you're making a little bit of money, you're losing money on the time period, right? So I might let it run an extra 2 weeks, but that's kind of the maximum.
Okay, thanks.
Great trade, you know. I don't know whether do you remember Mo?
Vaguely. You still in touch with him?
Yeah, still in touch with him. Yeah. So he a little while ago said, "Well, I'm putting it all into the Christmas trade," and I'm like, "What? Who told you to do that strategy?" Yeah, but it's such a winning trade. Like, but remember that, you know, 5%, 10% of your account conversation, you know. So it was good, because that was the year that it actually didn't work out, right? So,
oh no.
Yeah, so it was good that he didn't, and the stop took you out early anyway. So.
Okay.
All right, we should be hitting 2 o'clock, right? We on 2? Yeah, we're at 2 or 3. You guys ready? I'm ready. Yes. Good. All right, so gonna talk a little bit about options. When I talk a little bit about options, going to talk a little bit about kind of how they work and covered calls and things of that nature. I'll actually try to give you some examples and then actually go in and do a couple. We're not live in the marketplace, obviously, on Saturday, but I can look at some of the numbers and see kind of what they are. So we'll take a look at some simple strategies to begin, and then move into a few more complex strategies. I've got to kind of understand options, and I know half of you do and half of you don't, but I'm going to kind of walk through, understanding an option a little bit, both from a buying standpoint and from a selling standpoint, because you can buy an option or you can sell an option, right? So we kind of want to know the mechanics of kind of both and what's important. When you think about an option, it's kind of like buying a house. And what I mean by that is, a house has value, and that value is often considered the fair market value of the house, right? Which is called the strike price, right? So let's say that we have a house that's worth 100 grand, right? So the strike price is 100,000. Now, some people could buy the 102,000, and some people could buy the 98,000 because they're good negotiators, but the value of the house is really 100 grand, right? I want to buy the house, but I don't want to buy the house today. I want to buy it sometime in the future, like the next 90 days or so. So I go to you and I say, hey, look, I want to buy your house. I want to buy it for 100 grand today, but I want to have the right to pay you that 100,000 anytime in the next 90 days. And you're going to say, well, what's in it for me? And I'm going to say, well, I'm going to pay you a little bit of money to have that right? And we're going to write an options contract that literally says I have the right to buy the house at 100,000, right, for the next 90 days, and I will give you or pay you a premium. I will pay you a bit of money, which will be the down payment, right, not towards the house, but for the option of $5,000, right? So now you get the 5 grand, so you're happy, and you also know that the house could be sold within the next 90 days. Now, it's a unilateral right. I have the right to buy it for 100,000, but I do not have the obligation to buy it for 100,000, right? So I can back out of the contract, and you can't back out of the contract. If I exercise that right, you must sell it to me for 100,000, right? So what can happen in between? Well, in the next 90 days, the house, we find gold in the backyard, and the house now is worth 300,000, right? I have the right to buy it for 100, and then I can resell it for 300,000. Right? At the same time, that contract is now valuable consideration. That contract is literally worth 200 grand. Cost me 5 grand for the contract. It's worth 200,000. Rather than buying the house, I could sell the contract to someone else, right? For whatever the price is, right? Let's take another scenario. Scenario number 2, the house was 100,000. I have the right to buy it for $100,000 for the next 90 days. I paid you 5 grand. And then we find sewage in the backyard, the swamp, and the value of the house goes down to 50. Well, I'm not going to pay 100 grand for a $50,000 house because there are other houses I can buy. So I'm not going to exercise my options, and you're stuck with the house, right? And it only cost me 5 grand for that option for the 90 days. Well, an option on the stock market is very similar, right? An option in the stock market, it has the same sort of thing. It has a strike price, right, which is normally the fair market price, or a little higher or a little bit lower, right? It has a number or period of time, right, which is usually 60, 90 days, whatever that is. If we're a buyer of options, it's usually 90 days. If we're a seller of options, it's usually 45 days or less, right? So if we're a buyer, 90 days or more, right? It will expire. Right. Normally that expiration is the 3rd Friday of every month. So if I'm buying a Coca-Cola option and we're in October now, and I'm buying November, that option will normally expire on the 3rd Friday. The monthlies do anyway. You also have weeklies nowadays, and I'll talk about that a little bit later on, but monthlies are the 3rd Friday of every month, right? We also pay a premium. So if I want to buy an option on Coca-Cola, you saw that earlier, Coke was trading for $50. And I can buy the $50 strike price, the $50 fair market value, for $2.18 for 91 days, right? So the same as the house, I have the right. Now, if the stock goes up, the option goes up, which means I can either buy the stock and then resell it, or I can just sell the option in the open marketplace to people. Most people, what they do is they sell the option price. When you're thinking about an option, you'll hear the statement, it's in the money, at the money, or out of the money. All right, just to make sure you're clear on this. At the money would be if I'm buying a Coca-Cola option and Coke is trading for $50 and I buy the $50 option, that would be an at-the-money option. It means it's at the fair market value of what Coca-Cola's value is. If it was in the money, it would mean Coke's trading for 50 bucks, and I just bought the $45 Coca-Cola option. It's in the money because that option already has $5 of value, right? Because you can buy it at 45, but it already has $5 of value, which means you could sell it for 50 day one, okay? Now, there's a reason you would buy an in-the-money option versus an out-of-the-money option. Right now, we're just talking about in-the-money or out-of-the-money. If Coca-Cola's trading at 50 bucks, right, and this is something we're going to do, right, to make some money, is we're going to take a look at an option which is higher than that, and it's out of the money because, let's say I did the 52.50 option strike price, and I bought the rights to it. It might cost me 50 cents per share to buy that right, because there's no value, there's no intrinsic value, right? Coke has to go up to $52 before there's any value, right? 52.50. So it's called an out of the money option, right? So we have at the money, in the money, and out of the money, right? And you'll see when we take a look at some of the charts, you know, why it's important for you to kind of know why you're doing one or the other, right? So literally, you know, if I took a look at Coca-Cola, and this is actually a chart from Friday, right? And you take a look at the Coca-Cola option on Friday, Coke's selling for 50 bucks, right? I'm going to look at the at-the-money option. And when I look at the at-the-money option, you know, at this moment in time on that day, you know, the at-the-money option was about $4.40, right? 50 bucks, right? And you can kind of see that that's the at-the-money. Coke's at 50. There's the 50, right? An out-of-the-money option would be 55, right? And you're seeing, you know, you can buy an option for 10 cents. Well, a lot of people will say, well, I can buy an option for 10 cents, so I'll buy it for 10 cents, so it's so cheap I can buy lots of them. But the chances of you ever getting to $55 is really slim, right? So I can buy a 52.50 option, you know, for 51 cents, right? That would be out of the money because there's no intrinsic value, right? There is no market value where I could sell it in the marketplace. It's all time value. I'm buying time or I'm selling time, right? An in the money option would be at $47 because if Coke's at 50 bucks right now and I buy an option at $47.50, which I can, it already has $3 worth of value, right? It has $3 worth of value. Now, what's interesting here is, you know, sometimes buying an in the money option is a better option, right? So let me just give you an example here. At the money is $1.40. And there is no intrinsic value. There's no, it's moved up a buck or whatever, right? So that means that of that $1.46, most of it is time value. It's on buying the 91 days. Is this making sense? Right? Give me a nod if it is, right? Thank you. Okay. But look at the $47 option. The $47 option has $3 of value, right? Are you guys with me? Right? So there's less premium for time, right? So sometimes when you're trading, you do an in-the-money option, either one strike price or two strike prices in the money. Most of the time when we're selling an option, we're doing an out-of-the-money option. We're selling somebody else time, okay? So, you know, we're going to take a look at Coca-Cola, and we're going to take a look at it. And realize that options trading, options calculations, I showed you the Black-Scholes method of doing an option. Basically, an option has kind of different elements. First, it has intrinsic value, if it's worth something already. Then it has delta, gamma, theta, and vega. Theta is just time. You're buying 60 days or you're buying 90 days. You buy more time, it costs you more money. Vega is volatility, and this is kind of interesting because volatility is the second most important element of an option, right? You'll find between 9:30 and 10 options are more expensive. You'll find between 3:30 and 4 options are more expensive, which means if we're selling them, we make more money. If we're buying them, it costs us more money. You'll find February 24th of last year, options were double or 3 times what they normally would be. A $10 option is now $21. Why is it $21? Why is it $21? Because there's so much volatility now because the market was crashing 1,000 points. the volatility went up, and when volatility goes up, the option price goes up. Good if we're a seller, not good if we're a buyer, right? You know, so I remember one or two people saying, hey, I bought it, it moved 50 points and I didn't get any profit. And the reason was, well, you bought it at a high volatility time, and we're still in volatility, but it's going down a little bit, you know, so it's decreased in volatility and it's made up for the price change system. Gamma and delta, I'm not going to really talk about as an option piece. I only use delta to kind of figure out if Coke moves a buck up, the delta 70 means that the option's going to move 70 cents up. Okay, if I see a delta of 50.5, you know, it literally means if Coke goes up $1, the option will go up 50 cents. So it helps me on some of my calculations, right? You know, in terms of figuring out how much I'm gonna put out there, you know, with respect to it. Remember that options expire in value. Okay, so if we're a buyer of options, we're always buying 90 days or greater. There are rare circumstances where you do less than that. I'll talk about one of those circumstances this afternoon, right? If we're a seller of options, it's usually 45 days or less. And the reason is when we're a buyer, we don't want time to go against us. We don't want the decay. So we have a little bit of decay in that first 30 days. But when we're a seller, we actually want decay to happen because they paid us and we want the option to disappear. We want it to be gone. Right? So we want the decay to happen if we're a seller of an option, right? And that's kind of where we get into covered calls a little bit, you know, in terms of, you know, how we make money on a covered calls, right? So this is Coke, right? I already showed you Coke chart a little bit earlier today, right? Coke normally, you know, has a small up of 2, a big up of 4, and generally speaking, last couple of months, it's about $3 on an upside, right? So the reason I want to know that is that if I'm a buyer of an option, I want to know how much it's going to cost me for the option and what's the chances it's going to, you know, go up by 50% or 100% or 200%. And there's a good chance that if I buy a $2 option, right, that Coke could go up $3, which would mean about $2 on the option. So I actually, you know, could do pretty well in terms of Coke on the upside, you know, on the option, right? Coke goes down about $2 when it goes down. Right, and the average is about $3. Now that's what it is today. The last couple of months, you know, last year it would have been a little bit different, right? So the reason I want to know that is, let's say that I want to immediately, right, make some money. So the way I'm going to make some money is I'm going to take a look at selling an option. Okay, now let's assume that I buy Coca-Cola, right? And I'll walk you through a little bit about how to buy a stock in just a sec, but let's say that I buy 100 shares of Coca-Cola. While I expect Coke to go up over the next little while, right, I want to rent it out to make some money. Now, when I rent it out, right, I want to make some money, but I don't want my stock to be taken away, okay? So just think about this. Coke's at $50. I buy Coke at $50, and for the next 30 days, I want to rent it out. I know Coke usually goes up about $3 in a month. Right? So if I sell the 52.50 Coca-Cola option, what's the chances that it's going to get taken out in the next 30 days? Pretty slim, right? Because Coke, you know, it normally will have to go up to $3, right? Right? So it's slim. If it does get taken out, I'll be taken out. So I want to know what that average price movement is in the period of time that I'm selling as a covered call. I want to know it's $5 or $3 or whatever that might be, because I want to know if I'm going to get taken out. Now, I don't mind getting taken out, guys. You know, I just want to make sure that I'm not taken out the day I sell it, right? So it is something that we take as a consideration, right? So if I was to sell Coca-Cola, right, in terms of an option, selling the Coca-Cola option, right, not buying it, you know, I could sell the 50, so Coke's at $50. I own 100 shares of Coca-Cola. I could sell the 52 option, right, for about 51 cents. Now, 51 cents times 100 shares is $51, which means somebody on the other side of that trade, right, not me, somebody on the other side of the trade, the market maker or whoever it was, bought a call for 30 days, right, and they bought the call for 30 days with a strike price of $52.50, which means Coke has to go up to $52.50 for them to make any money. plus the cost of the acquisition, which is the other 50 cents, right? So Coke's got to go up $3 before they make a dime, right? So, you know, that may or may not happen, right? But it's a high probability that it's not going to happen, which means I get to do it again and again and again and again, right? Okay. So what's interesting about options is that 85% of them to 90% of them expire with no value. Now that's bad if you're a buyer of options, and it's good if you're a seller of options, which means 90% of the time you win, okay? Right, so we definitely want to understand both sides, both the winning side and the selling side, right? So one of the things that we can take a look at is we can be a buyer of options or we can be a seller of options. Now you'll get this complete list, you know, so that you've got it in your notes when I send it out, you know, on the email afterwards. But number one is we pick a stock, right? Now how you pick the stock, that could be Buffett's approach, that could be Ken Slim approach, that could be I'm taking a look at the 4 keys, I'm looking at insider buying, valuation, technical analysis, I'm using IVEST Plus. In fact, IVEST Plus has a covered call scan thing that's really good, right? So however I'm going to pick the stock, right? It may be, I know there's about 20 or 25 stocks that have high volatility, right? You know, and they're high volatility, so they normally do 2 or 4% a year, 2 or 4% a month rather than 1% a month. However you pick the stock, you're going to pick the stock, right? We're going to use dogs of the Dow. Now, the reason we're going to use dogs of the Dow is a simple strategy. You know, it does 18% a year on average since 1973. Simple strategy. It's a long-term strategy. I'm going to plan this for the next 5 or 10 years. So while I'm holding the stock and expecting it to do that 18% each year for the next 5 or 10 years, you know, I'm going to rent out the stock in between. A lot of my Canadian guys have done this. You know, they're going to rent out the stock in between to make an extra 1%, 1.5%, or whatever it would give. I need to determine the market. The market needs to be either flat on the stock, right? The overall market needs to be kind of flat or directional moving up. Right? Does not really work well in a down moving market. You would not be doing a cover call in February of last year. I've already got the year over. It's not 2020, so not over. It's already last year for me, right? Okay. So we're going to look for an uptrending or sideways market. We're going to check the options chain, and there's 2 things I'm going to look for on the options chain. One is that I'm getting about 1% minimum. That's a number 1 rule for me. I want to make 1% when I'm doing a cover call at least, right? And I'm going to look at the average price movement to see in 30 days, is there a chance I'm going to get taken out? Now, I don't mind being taken out. It's not a problem. It's not an issue. But I would like just the stock to slowly go up over time, right? I'm going to calculate the returns. Now, the returns are pretty easy. You know, if you think about Coca-Cola, I spent $50 to buy Coca-Cola. 100 shares of Coca-Cola is $5,000, right? And I rented it out this month for $51. If I rent it out for $51 on a $50 stock, that's 1%, right? So I know I'm making 1% on Coca-Cola. Whether Coca-Cola goes up, down, or sideways, I'm making 1% on Coca-Cola. And that's really the benefit of a cover call. And, you know, I was with a couple, got to be about 8 or 9 years ago, you know, and they had, they were looking for an extra $1,000 or $2,000 a month. That's all they wanted, right? And they had $200,000 worth of AT&T, right? They were AT&T employees. They had options. They bought the stock. They owned the stock. They had 200 grand worth of options. They did fairly well in their vested account, right? And they only wanted to make an extra $1,000 or $2,000 a month. So what's a simple strategy to make them hit their goal? Well, you do a covered call on the stock you own, AT&T. You make 1%, you're making $2,000 a month like that, right? Right. So if you own stock, you want to take a look at a covered call. You know, if you're thinking about stock, you want, and we sell the call. We don't buy the call. And this morning I talked about buying a call to go tall, right? We're gonna sell a call, which means we're gonna sell a position. And would it be okay if I jumped online on Thinkorswim and actually walked through this a little bit? Would that be okay for everybody? If it is, put your hands up. Great, right? So we're going to watch it, right? What I mean by watching it, when you do this type of trade, there's only 3 things that can happen. The stock goes up, the stock goes sideways, or the stock goes down. Stock goes up, we're good. Stock goes sideways, we're good. Stock goes down a little bit, we're good, right? Stock goes down quite a bit, might be something we want to do, right? So this works well in a sideways market. So we may close out the trade depending on whatever it might be. we're going to do dogs, right? And when I say we're going to do dogs as kind of an example, however you pick your stock, whether you use iVest Plus or you use Buffett or you pick your favorite stock, pick your stock, and then let's do the math together to make sure that you're doing it properly and you understand kind of the math. So I'm going to use dogs, right? So this year, you know, dogs, I'm going to use small dogs because I want a relatively inexpensive stock. And I know small dogs, rather than 18%, normally does about 21%. So I'm going to use the examples of Walgreens, maybe Cisco, maybe Coca-Cola, and kind of walk you through the steps I would do to evaluate whether I want to do this for the dog or not. So there's 5 dogs, right? Right. We've got the Dow, which is not the Dow Industrials. That's a company called the Dow. It's called Dow Inc., right? It's a company. It's not the Dow Jones Industrial, right? There's the Cisco, there's Coca-Cola, there's Pfizer, and there's Walgreens, right? So I'm going to walk you through the evaluation I would do normally if I was going to take a look at the dogs this year, next year, whatever it might be in terms of how to trade it, right? So first of all, and these are the puppies, these are the small dogs, you know, I'm literally going to pop up Coca-Cola, right? So I go to a chart and I look at the last year, right? So when I look at the chart, nice steady uptrend, February crashes, right? Rebounds a little bit, and I'm looking for the last 6 months or so, hopefully a year, but the last 6 months is okay, right? What's Coca-Cola doing? Kind of going sideways a little bit and up a little bit, okay? When you're looking for a covered call, you're looking for sideways or up, right? You're not looking for downtrending stocks, right? So Coke would be a good candidate, right? Then I got to see if the math works out. I can make 1% at least on it, right? So Coke's a good candidate, right? So that puppy is a pretty good puppy, right? Then I take a look at, I think this is Cisco, right? Cisco, big uptrend, big drop with February, big recovery right away, starts to move up, then gaps down because of something that has been in Cisco and it's on a downtrend. So is this a good candidate to do a cover call? Absolutely not. First of all, highly volatile, right? And the second thing is, man, you know, it is crashing and burning right now. Now, what's kind of interesting about Cisco, and I just want to point out this last little piece on Cisco, is you can see that there's kind of a W on Cisco, right? The chart on Cisco, right here. See this little thing here? There's a downstroke, an upstroke, a downstroke, an upstroke, and then a little bit of a reversal, right? This is a perfect double bottom. I mean, a perfect double bottom, right? It's going down to support, and I haven't talked about support yet, talked about the next section, then going back up to resistance, and it's going up and down between those. Then it goes past resistance, then comes back and touches resistance, and I would anticipate, you know, that Cisco will start to have a nice run up, okay? But it's on a downtrend right now, not a good candidate for doing a cover call, even though I think it might rebound, right? That's a technical piece, not a cover call piece, right? So I'm looking at that going, no, it's on a downtrend, forget it, right? So I'm not doing Cisco, no way, right? Right, so then I take a look at the next one we have, right, which is the Dow, the Dow Inc., right? And you kind of see, you know, sideways pattern, drop, rebound. It's on an uptrend, right? It's kind of uptrending, you know, so it's a pretty good candidate, right? It last 6 odd months, it's been moving in the right direction. I want a sideways stock or an uptrending stock, not a downtrend stock. So I got Coke might be a good candidate, and the Dow might be a good candidate, right? So I'm going to finish it off by looking at two more, Pfizer and then Walgreens, I think, right? So Pfizer, well, really choppy, right? But big choppy. When I'm doing a cover call, it's okay to do a drug stock if it's going within a range, right? Okay, but it's not really good directional, and there was that big gap there too, right? Drug stocks are not my favorite stocks to trade, and the reason for that is because they tend to be really volatile. When they're really volatile, it means they can go up a lot or down a lot in a very short period of time. Now think about it. Pfizer comes out with the cure for CV-19. What's going to happen to Pfizer? You know, Pfizer gets tossed off the list for providing, you know, drug testing, for C19, gaps down, right? So you can have those things. So I'm kind of looking. Now it's starting to move a little bit sideways, but there's not really 6 months of it going sideways or up. So I'm not going to do Pfizer, right? Right? And then I take a look at Walgreens. Man, I would have expected Walgreens to be on an uptrend, right? I would expect hand sanitizers, cleaning supplies, drugs, that Walgreens would be on an uptrend, but their stores are losing money hand over fist, right? So they're on a downtrend right now. So definitely not doing either one of those, right? So I have 2 candidates, right? I had 5. Now I've got 2 candidates I'm thinking about doing a covered call on, right? And there are other ways to, kind of pick a stock. You can kind of use Can Slim or the 4 keys or whatever it is, right? I need to kind of figure out, well, what's the average price movement, right, on one of those stocks, right? And I'm only going to take a look at 2. I'm going to look at Coca-Cola, and I'm going to look at the Dow, right? Because those are the 2 I plan on doing a covered call or trade with, right? Not sure why that happened. I guess my first video from the morning has rendering, right? Right? What's the average price movement, right? So I look at Coke, and I kind of see that, geez, big move on Coca-Cola is kind of $4. Little move on Coca-Cola is $2. Average kind of move on a regular kind of basis is $3. So I kind of know in the next, and I'm talking in a 30-day window, right? I'm literally looking between the red lines here, which is every 30 days an option, and I'm going, how far does it move here, right? And it looks like, on the downside, it might be $2, and on the upside, it's $3, okay? So I know my downside might be $2, and my upside might be, $3, right? I also know that the average price movement for that 30-day period is about $3. Now, I already know what the Dow price movement is. The other stock that we're considering, it's about $5, right? So it has a fairly good price movement. So when I'm thinking about this, I'm thinking about, well, geez, if it goes up, right, I want it to go up, but I don't really want to get taken out. It's okay if I get taken out, but I don't want to because I don't want to buy and sell the stock again, right? So I know it's a $3 kind of price movement for Coca-Cola, right? In terms of ROI, we're looking for 1% kind of as a low, up to 1.5%, right? That would be a normal stock. I mean, IBM, 1% regularly for a decade, right? Coca-Cola, 1% for a decade, right? So that would be a normal 30-day return on Coca-Cola or IBM or a normal stock. Now, are there some stocks that return more than 1% a month? There are, okay? So you'll find that there are some stocks, and I have a list of some of them, that will do 2% to 4% per month. The challenge with the 2% to 4% is that the stock is a little more volatile, which means it doesn't have a $3 move, it has a $10 move, right? Which means you can get taken out much quicker or less quicker than the other, right? So we want to make sure we get a good feel for what's this average price movement and what's the volatility. If you're making 2% on the stock, highly likely it has higher volatility, right? In March, you could get 2% on Coca-Cola. Why 2% on Coca-Cola? Because right after February into March, high volatility, which means option prices are worth more, which means you could sell it for more, right? Now it's kind of gone back to its 1% again, right? So we kind of like volatility a little bit. We're looking for something to be sideways. We're looking for it to go up, and we must make 1% minimum kind of as the target price, okay? So what happens if we buy Coca-Cola and then we rent it out for a month, right? What happens if it goes up, goes down, or goes sideways? Okay. If it goes sideways, let's say that we sold the 5250 Coca-Cola, right? We're selling it to somebody else, the market maker. It's not an individual, so don't think you're selling to Ted, Fred, or somebody else. You're selling it in the open marketplace. We sell it for $52.50, and we bring in 51 cents, $51, on a $5,000 investment. Well, if it doesn't go past $52.50, this guy's not going to exercise his option because he's hoping it goes past $52.50. That's what he bought it for, right? So if it doesn't go past $52.50, it's going to disappear. It'll expire. When it expires, right, we get to keep the $51. and we still own Coca-Cola. So what do? We do it again. Expires again. Expires again. We just literally sell 30 days every 30 days, right? So what happens if it goes up? Well, if it goes up, right, it's got to go past 52.50. If it goes to 51, he's not going to exercise the option. If it goes to 51.50, he's not going to exercise. If it goes to 52, he's not going to exercise the option because there's no value in it for him, right? His deal was, man, I'm buying this option at 52.50 because I think it's going past 52.50, right? Now, there's other reasons somebody might buy it, but I think it's going past 52.50, right? So if it goes between 51, 52, 52.50, right, he's not going to exercise his option and it'll expire, right? And you can sell it again, right? So it's not bad if it goes up, right? What happens if it goes to 53? Well, if it goes to 53, right, first of all, the option you sold will expire, right? But before it expires or when it expires, it's going to be in the money for him. So he is going to take your stock, right? So the stock will be sold at 52.50. Okay. So is that a bad thing? It's actually a good thing because not only do I make the 51 cents, the $51 for the 100 shares, but now I bought it at 50 bucks and it gets sold at $52. So I make $2.50 times the 100 shares, which means I make that profit. He doesn't get that profit. I get the profit, right? So it's not the worst thing, even if it moves up and moves past the strike price you sold, right? So now if it moves to 55, you get 250 and he gets 250, right? Because he made the call on it going from 52 to 55. It's one of the reasons you take a look at what the average price movement is within the 30 days for the covered call or for anything. Because I want to see, hey, is it about 52 or 50 or 53 bucks? If it's about that, highly likely I'm not going to get taken out. Right? If the average price range was $5, probably going to get taken out half the time, right? So we want to kind of know what that price range is to kind of think, well, am I going to, and like I said, it's not the worst thing to get taken out. You just miss the opportunity from 52.50 to 55, right? You still make the $2.50, right? I've seen people, that buy a stock, have a favorite stock, goes up and they go, crap, I got called out. And I go, well, do you think it's still going up? And they'll go, yeah. I said, we'll buy it back. Buy it back at 55 if you think it's going to 60. We also want to have a feel for this stock. Where is the resistance, right? So on Coca-Cola, I know the resistance levels pretty well, right? They're every $2.50. So you got a resistance, right? You'll have it at 52.50. You'll have the next level of resistance is 55 bucks. The next level of resistance is 57.50. Next level of resistance is 60 bucks. When it gets to 60 bucks, a lot of people sell Coca-Cola. Okay, so I kind of know that the max on Coke is 60 bucks, mid 50, 40, it's a great buy. And if it gets down to 37.50 or 35 bucks, buy as much as you can, right? Because it's going to rebound and go up. In fact, for a lot of years when I first got started, all I did was rolling stock. Went down to 40 bucks, I bought it. When it went to 50, I sold it, right? Comair went down to 18 bucks, I bought it. When it went up to 22 bucks, I sold it. And now Comair was bought by Delta, so you can't do Comair anymore, right? So let's take a couple of examples here, right, and kind of take a look. And what I'm going to do is, I'm hoping my Thinkorswim account is open, which it is, right? Can you guys see my Thinkorswim account? Give me a thumbs up if you can. Okay, cool, right? So first thing I do is, right, I look at the chart to kind of see, what's going on. So this is Coca-Cola. And it's Coca-Cola, I had that big 1-year chart, and this is actually the last couple of months on Coca-Cola. And you can kind of see, there right here, Coke is at $46 and kind of goes to $49, right? There's a move, right? There's a move there. That's a $49 to $51. So that moves $3 or $2, usually about a $3 move, right? So I know that the price movement is about $3, okay? I also know that the resistance level on Coca-Cola is $60. So that's a major resistance level. I know when it gets to 60 bucks, most people will sell it. So is it probable that Coke, will go to $60 in the next 6 months to a year? Likely. Is it stair-stepping up? Going up, sideways, up, sideways, up, sideways, came back down, kind of going up, going sideways. right? So Coke could be going up, right? So I'm only looking for it to go sideways or up. So a good chance it could continue to go up, right? So I'm gonna buy Coca-Cola. So I'm actually gonna go over to the trade tab now, because this is definitely a covered call potential. And I press on the trade tab, right? And I'm active trader, futures trader, Forex. I want to go to all products, right? This is on Thinkorswim. Obviously, if you're on Options Express or you're on E-Trade or whatever that might be, it would be something else, right? You know, and the way I buy Coca-Cola is I simply go up here, and that isn't Coca-Cola, that's DIA, right? There's Coke, right? You can see Coke's trading for 50 bucks right now. The last one was $50.03. If this was live in the market and I pressed this button, I would own 100 shares of Coca-Cola. Now I own Coke, right? Cost me 5,000 bucks to buy Coca-Cola. I want to rent it out. Now the way I rent it out is to look for a 30-day option to rent out. So all of these that you guys see over here are all options. This is a 6-day option. This is a 13-day option, a 20-day option, a 27-day option, a 34-day option, a 41-day option, right? You know, so we have weeklies and we have monthlies, right? So I'm looking for an option that's 30 days, right? Now, unfortunately, you know, because it's the weekend, right? I'm not going to be able to buy it. So I'm going to take a look at this one just because Saturday is going to go and Sunday is going to go, and this is going to go from 34 days to 32 days. Okay, so this is likely the option because it's going to be as close to 30 days on Monday as I can get, right? So I'm going to open this option up, and when I open this option up, it's going to give me all of the choices that I have, right? Now, if you're a vertical trader, you have two in the center. We're doing singles right now, so there's one price in the center. This is a single option, not a vertical option, right? So what that means is you can only see one number in the center, which is what you should be doing. So on Monday, this will be 32 days. I'm going to go to the 50 level, right, which is right there, okay? Coke's at 50. That's a strike price at 50. Are you guys with me so far, right? So I want to, I'm not a buyer of an option here, I'm a seller of an option here. I'm going to sell the next 30 days of this option. So, you know, in the columns it says bid and it says ask, right? If I hit the ask button, I'm going to buy an option. If I hit the bid button, you can see this says ask and this says bid, right? So I can actually go down and say, you know what, I'm going to sell the next strike price out, which is $52.50. Usually on a covered call, you're selling one or two strike prices out, okay? Now, on a monthly option, they give you $52.50, they give you $55. Sometimes on weeklies, they're $1, right? So you got to be careful about that because, you know, $1 is a different strike price than $52.50. But I'm gonna sell the $52.50 option, right? And literally, if I take a look over here, the last one, or the mark, the average was $6.60, 61 cents. The bid is 59 cents, and the ask is 52 cents, right? Which literally means somebody's trying to buy it for 59 cents, and somebody's trying to sell it for 62 cents, and the 60 cents is the average, right? So somewhere in the average there, you know, and I know, right, that I can sell it today if this was live in the marketplace at 59 cents. Why do I know that? Because that's the bid price. That's what somebody's offering for it to be bought at. I'm a seller, they're a buyer, right? Now, it's always the market maker, so don't worry about Fred, Ted, and Alice. They're okay. You know, you're not taking advantage of Fred, Ted, and Alice. You're selling this in the open marketplace, and there's thousands and thousands of these being sold every day, right? So what I literally do is say, well, you know, I'm going to try to get 60 cents, but I know I can get it for 59 cents. I want to sell it, so how do I sell it? Well, you see this little button here, it says buy, where it says sell. What am I going to do? I'm going to sell. When I sell, right, automatically this pink order form will pop up. This pink order form tells me what I'm doing, right? The first thing is, it's going to say -1, which means I'm a seller of an option. It's pink, which means I'm a seller of an option. If I was a buyer of an option, it would be plus, and it would be green, right? But I'm selling it, so it's maroon, pink, red, whatever your color combination is, right? I must make sure, if I bought 100 shares, I must make sure that the number I buy is the same as the number I sell, right? So sometimes on Thinkorswim, this number right here defaults to 10, right? That would mean 10 contracts. 10 contracts times 100 shares. Each contract is 1,000 shares, right? You only bought 100 shares of Coca-Cola. So if you only bought 100 shares of Coca-Cola, you can only sell one contract. If this is making sense, you know, give me a little head nod, because some of you look like you're going to sleep, right? And some of the people don't have their videos on because I know they're asleep, right? Okay. So the one contract equals 100 shares, so that's what we're going to do. Well, and literally what I'm going to do here is, you know, I'm going to go over here and press the confirm and send, and you can kind of see what the order says. The order says, do you want to sell one contract of Coca-Cola at $52.05, a call, you know, at $59, right? And that literally means you're going to make $59 profit max, right? Right? So you know, it's going to charge me 50 cents for the sale of it, which is the commission that's due to Thinkorswim for selling the contract. Now, Thinkorswim has different contract rates. It can be 50 cents or 65 cents. Normally, a contract sells for about 65 cents, you know, so it's not much. I should say this is 5 cents, right? Right? Or 50 cents, sorry. You know, so pretty good rate, okay? So if this was live in the market, I would send it on its way and I'd get filled kind of right away, right? Because we're not live in the market, it's not filling, obviously. I'll cancel that order before Monday so it doesn't go through, you know, but literally that fills at 59 cents. That's 59 cents times 100 shares, which is $59, and they put that money in my account today. I don't wait, I get that money, right? They put it, my account goes up by 59 bucks, okay? Now somebody's gonna say, how can you sell something you don't own? Happens all day long in the marketplace. Don't worry about it, don't think about it, don't sweat about it. It's totally irrelevant. You can sell what you don't own, okay? Right? It's all about having money on your account. Right? Now here you happen to own Coca-Cola, you happen to own 100 shares, right? So you have the right to that 100 shares and you can sell that right to somebody else, which is kind of what you're doing. You're selling the right for them to buy Coca-Cola at $52.50. And the only way they're going to do that is if it goes to $52.50. Right. Is everybody with me? If you are, just your hand up, shake, do so. Okay, good. Right? Now let's kind of do the math, guys, right? So I sold, right, at $52.50, right, at 59 bucks, right? Right, so I mean, just going to grab my calculator. I kind of know off the bat it's over 1%, but $59 on a $5,000 investment is 1.2%, right? So I'm making 1.2% each month, which means I'm going to make about 14% if I do a 1.2 each month for the next 12 months. If Coke does nothing, right? Okay, so that's great. If it goes up a little bit, it goes to $52.50. I'm going to make the 1.2%, plus I'll make the $2.50, you know, times 100, 250 bucks on Coke going up, and then I get to decide, do I want to do Coke again, right? So it's not the worst thing if Coke gets, you get taken out on Coke, but highly likely or unlikely to get taken out because you're in that $2.50, $3 range, and, you know, Coke only goes up $2 to $3 max, right? So a good kind of, now what happens if it goes down? Well, if Coke goes down, I still got the 59 bucks, right? I still own Coca-Cola. So if it goes to $49, right, you know, I can sell the $51 Coca-Cola, right? You know, if it goes to $48, I can sell the $51 Coca-Cola. I can sell the $50 Coca-Cola, right? You know, so I can always sell. If it goes below that, right, then you run into, okay, do I really want to own Coke anymore? Right? Now, if you're buying this for the long haul, Dogs of the Dow is in your retirement account. This is something you're doing for the next 5 or 10 years. It's not going to matter. You just simply sell the next $3 strike price, right? $2 strike price. You just keep selling it, selling it, selling it. If you do, you know, get taken out, you could potentially lose money. That's why we look for a sideways or uptrending stock, right? We don't want to be on the downtrend because then we can end up buying something we don't really want, right? All right, let's take a look. I'm going to go, the other stock that we looked at, do you remember what it was? It was called the Dow, right? Right, so let's take a quick look at the Dow. right? And this is the Dow Inc., right? Not the Dow Industrials, which is the big market. So I'm just going to put in, Dow, right? Take a look at the chart, right? So chart, actually there's a little technical thing that's happening right now, which is positive, just so you kind of know. So it has a positive technical, right? And, it looks like, geez, when it moves, take a look there, take a look there, you take a look there, even take a look here. It looks like it moves about $5, right? So the average price, movement on the Dow over the last several months, last 5 or 6 months, is about $5. Okay, so I know it's $4 or $5, right? So, and it's uptrending. I like that, right? Because that's a good thing for my covered call. I'm going to go over to the trade tab again. What I'm going to do is stick in the Dow, right? When I put in the Dow, it says I can buy the Dow, just coincidentally about $50 as well, right? So I can see the last one was 49.30, so I'm going to kind of sell it at 49.30. How I would take it is I go over here where the ask button is. I click on the ask button. An ask is a buy, right? It says how many do you want to buy, right? I'm going to buy 100 of them. I'm going to buy them at 49.49 here. I could try to get it for 49.30, but I'm going to get it, right? And I would send it on its way. And then if this was live in the marketplace, I would get buy, and actually I'm going to move it into the IRA. It would actually take that order and fill it, right? Now I own 100 shares of Dow, right? So I own 100 shares of Dow. Now I want to get to the rental of the Dow, right? So again, I'm going to go look for 30 days, right? I know 27 days is not it. It's probably going to be this one because on Monday this will be 32 days. I'm going to click on it, right? When I click on it, right, I want to kind of see what the prices are, right? Okay, so I'm looking at the prices here just to move you guys out of the way, right? So this is kind of where we're at, $50, right? A little bit less, 49.50, right? So I want to be a few dollars out of the money, right? Okay. Now I said that the Dow, can move $5, right? Okay. So $5 is kind of the maximum the Dow moves in a 30-day period. Remember, we took a look at the chart, and it was about $5, right? So I'm going to go to 55. Now I could sell the 52.50, but I'm going to go to 55 because I could sell the Dow for 50 cents. If I can sell the Dow for 50 cents on a $49.50 stock, that's going to be a little more than 1% again, right? So I'm going to get 1% on the trade, and it's got to move $5, right, in the next 30 days for somebody to take it out, right? And if it's at 55 and it moves $5, they're not going to take it out until it gets to 56, right? Because that's where they make money if they were to buy this piece. So literally what I'm going to do is I'm going to go over where it says bid, right? And the average is 57 cents here, guys. That's what the average is. You can see here that the bid is 50 cents and the ask is, 65, but 58 is kind of where we would probably get it, 55, 58. Literally all I'm going to do is I'm going to take this order. I'm going to click on the sell button. When I click on the sell button, I want to make sure it's one contract, right? It is the Dow. It's the 55 Dow. I know the average is 58 cents, so I'm going to put this up to 58 cents as opposed to 50 cents, which I know I could get right away, which is the difference between the bid and the ask, which means I'm asking for a little more than somebody's offered right now. And I'm going to make $58, right, immediately when I send this on its way, right? So it's giving me a prohibitive because of the position, right? So I'm going to send it on its way, make $58. What's $58 on a $49.50 stock? That's 1.2%, right? So almost the same as what Coca-Cola did for me, right? So both kind of good stocks that will give me 1%. 1% times 12, 1.2 times 12 is about 14% a year. So it's 14% a year, and the stock doesn't move a pretty good rate of return. But when you think about the stock market being 7% over the last 100 years, 14% and the stock didn't move, that's good. What if the stock does move, it's 18%? What if it does over the next year do what a dog does, a puppy does, and it goes up, right? Because that's what it's done since 1973. It goes up. Well, I'm going to make the 18% on the growth, and I'm also going to make the 12%, right? So if you own stock, definitely, no question about it, one of the things you want to do is you want to be a covered call seller, right? We want to sell covered calls, because it can give us great rates of return, right? So, and this is just those I just did that live with you, so you're kind of there. Now think about this. Dogs on average since 1973 has done 18%, much better than the 7% that you could do in the market if you bought a mutual fund or a stock or whatever it might be, right? And, I mentioned the fact that, 2017, that article came out that the average person made 4.5%. If you did just the S&P, you did 8%. If you did dogs, you did 17%, right? You want to take control and you want to rent out your stock, right? Think about it. Dogs is 18%. So let's say in a retirement account, you got your 18% growth position. No income, just growth position. And then you rent out it for income each month. You make another 12%. That's 30% a year, right? 30% a year in a retirement account, right? I mean, that's an incredible result, guys, right? Last night I was interested to see what kind of result that might be. My friend Tim Justice, Matt Justice, great traders. They often talk about do cover calls, do cover calls, do cover calls, and just leave them in your retirement account, leave them in your retirement account, right? Here's 10 grand over 5 years. If you did 30% in your retirement account and a covered call using dogs, right, getting 30% a year, 10 grand in 5 years is going to be 37,000. If I leave it a little bit longer, right, and maybe I move it for 10 years, right, 30% is 137,000, right? What if I leave it for 20 years? What if I use this strategy? I'm 40 years old or 45, and I do this for the next 20 years, right? If I do this for the next 20 years at 30%, that's $1.9 million on a $10,000 investment. Now, obviously, I'm compounding the money, so every year I make money, I do what? Put it back into the trades, right? But turning 10 grand into 1.9 using a simple strategy, something all of you can do literally this year, right, in a retirement account. What a great growth strategy. Are you guys with me? If you are, say, oh yeah, right? Right? So, I mean, 7%'s okay, right? 100%, 100 years, 7%. 18% on the dogs is great, but just adding a little covered call can get you to 20%, 25%, 30%. That can be a huge difference if you let it build over time. So I kind of love covered calls, right? One of the things that's cool, and I suggest that if you can, you take a look at that iVest Plus web software, because the iVest Plus software, will allow you to kind of pick stocks. But it also, if you go up here where it has the scans and the research, especially find, you can actually find cover calls that do better than 1%. You can find a cover call that does 2% a month. So a cover call that does 2% a month, right, that has all green boxes or 2 green boxes and a couple of yellow, that means it's a pretty good stock long term. It's got good growth potential, and you can make 2% a month. And 2% a month is 24% a year, right, guys. I mean, I used to do I used to have a website that I subscribed to, and this is 20 years ago, where all it is give me the high volatility covered calls that were making 2% or 4%, right? So this is a great thing to find those things where there's 2% or 4%. Now, what it'll do is, this is actually a picture of it, right? And it will show you find the covered call, you take a look at the covered call, and it'll kind of show you what the return is, right? So this return is anywhere from 2 to 4%. 2 to 4%, 24% or 48%. So not a bad little piece, right? Now, guys, I don't get any money for this. I don't subscribe to, meaning that I'm not getting a piece of the deal. This is just a really good software program that can help you pick a good stock and pick a good covered call. So if you get a chance, take a look at iVest Plus, right? You can use iVest Plus software to also pick a good covered call with respect to it, right? We already talked a little bit about the Dow doing that. We already did the math on that. There is something called the poor man's covered call. Now, I'm not going to go into great detail about this, but I just want to bring it to your attention. When we do a covered call, the first thing we do is we own the stock first. We buy Coca-Cola, we buy IBM, we buy 100 shares, right? Poor man's covered call basically means you are going to buy an option on Coca-Cola, right? You're going to buy a long option on Coca-Cola. And I say buy, we're going to buy an option that is 6 months to a year. A year would be called a leap, right? We're going to buy a leap at $50 on Coca-Cola. Will it cost us money to do that? Yes, right? But that gives us the right to buy Coca-Cola anytime in the next year for $50, right? So we have that also means I need to have the money to buy Coca-Cola at $50, right? So it's called a poor man's covered call, but realize that if you have to fire it off, right, you need to have the money to buy Coca-Cola, right? But it is good leverage, right? So that option will cost us a certain percentage of money. It might cost us, you know, for that long-term option, $4 for the next year, okay? And then what do I do? Well, each month I sell, right, the call against it, right? So each month I sell it, 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 and I make the premium on it. You know, so I mean, think about this. If I sell it for $50 each month, right? You know, how long does it take me to get back my money, right? So it is called a poor man's covered call because you use less money to do it, right? Now, I'm not saying you want to do this right away. It's just something you might want to take a look at, and you want to run the numbers to make sure it works for you because you're going to have to sell the covered call for 4 to 6 months before you start to make money, right? Right, so but it is a good way of getting into covered calls without owning the stock. Did you guys enjoy the last 45 minutes or so? If you did, give me a thumbs up. Right. So I'm going to move into technical analysis. Right, and I think we're running at 3 o'clock, so we're right on time. Right, so I'm going to take a short 10-minute break. You know, you can run. I can grab some coffee, and I'll switch out my screens. And when we come back, we're going to talk about technical analysis. We're going to talk about charting. We're going to talk about support and resistance. And I'm going to show you a couple of trading systems. I'm going to show you a flag system. I'm going to show you a 25 moving average system. I'll touch the 55 system, but I'll come back at the end of the day and go into the 55 system. So we've got a couple of trading systems we're going to take a look at as we look at technicals. And they can be the stock or they can be the option. It's entirely, or they could be the future. But the technical analysis will allow you to make the decision as to whether to do it. All right, so I'm going to kind of get started back. I said 10 minutes. I'd like to keep on track. Is that okay, guys? Can you see my screen?
Yep.
Okay. So I'm going to talk a little bit about where we're at and where we're going, right? So we talked a little about January barometer, best 6 months, dogs of the Dow, puppies of the Dow. You know, we talked about, you know, talked about a little bit about options, you know, about premiums, about positions, a little bit about fundamentals, you know, trade boxes, the 4 green, yellow, red with IVES plus. We talked about average price movement. We talked about a little bit about stock and index and options. And I don't really care what you trade. I don't care whether you trade stocks. I don't care whether you trade options, whether you trade futures. Entirely up to you. So do Bitcoin. Doesn't matter to me. But, you know, when you're doing that, you got to keep the math in mind. You know, I'm risking 1 unit to get 3 units. And most importantly, what's the probability of success? Now, adding to that, layering to that is kind of knowing where the market's going to go. Okay? And if you kind of know where the market's going to go, it's going to increase your probability of success. I'm going to talk a little bit about what's called technical analysis. When we talk about technical analysis, I'm going to give you a couple of tools. But then I actually want to take those tools and allow you to put them into practice. So I'll show you some actual live examples of how I would trade this, right, to make some money and why I'm doing it a certain way, right? You know, IVES Plus is certainly a tool you want to take. You know, if you don't have a brokerage account yet, you know, I would recommend Thinkorswim. That's the one I've been using for well over 18 or 19 years now. I did have an Options Express account. I still have an Options Express account. I think there's 30 grand in it. I don't really use it very often, but it's there. You know, each tool is kind of unique. Great tool out there to kind of compare brokerage account. It's called Google, right? You know, put in, you know, brokerage accounts and kind of see the comparison. Thinkorswim, E-Trade doesn't really matter to me. You know, Canadians, you know, you have a little less choices. You know, Thinkorswim is probably one of the choices. I think Options Express still does a Canadian. but you want to get a good broker. And they're all pretty much the same nowadays. They all have tools to evaluate a stock or an index or an option. They might have a little bit of education in them, right? But the big thing is, can I trade, and what's it cost me to trade? Options, Thinkorswim has one of the lowest options contracts. I think it's about 65 cents for everybody, but actually you can get it less than that, right, if you're an active trader, right? So think about this. You may start off as a hobby, but sooner or later, think about this as a business, right? So you can start in your own personal account. You can start in your own retirement account, which are personal accounts. One has a favorable tax treatment, but you can also trade within a business. So you can actually set up a business, which is a trading business, and when you do a trading business, you'll have more write-offs than you will just trading against the stock or the option, right? So, and you can do both. You can trade in your personal account, your retirement account, and business account. There's all kinds of reasons why you might set it up with a business, a small business. One of the reasons for me is I'll set up a small business. I'll put some money in it. I'll open up a Thinkorswim account or an account. I'll trade, make money within it. Now the business is making money. The bank sees money going into the business, and I guarantee a year from now, they're going to say, hey, do you want to borrow some money, right? And it's not money for me. It's money for the business. Did this with my son. 2 years after trading in his business, he got offered $20,000, right, for his business account. So what did he do? Took the 20 grand, put it into options, right? Cost was $450 a month, right? The payment, right? On 8.5%, 20,000, right? On a 4-year note, right? And he traded that, in his account. Okay. So you can use this to kind of leverage credit as well, right? So definitely something, if you have a question about that, ask me, but definitely start thinking about it. Quickest way to success for me is always getting mentorship. I'm glad you're here. You're learning from me. I learned from Warren. Warren learned from Ben Graham. I mean, passing it on is definitely the way to be. You want to make sure that you're getting there quicker. Just a quick thing about mentors and the difference between who they are and who they should be. Okay, a mentor is not a financial planner, right? A financial planner, their big thing is to put you into a mutual fund, put you into a balanced fund, do whatever it might be. They're not a broker. Right? A broker just wants you to sell you to trade the next month. Trade so he's making commissions. They're not an insurance company, right? They can be part of your team, right, for your overall wealth. But I mean, for mentorship, man, you want to get somebody that's a trader, somebody that's done it, somebody that's you're not paying out commissions for, that they're a pretty good teacher. I consider myself to be a pretty fair teacher. Would you agree? Right? So I mean, some of you are doing this, right? Some of you are still looking like that, right? Right? So you want to make sure, you got a good person on your team, and I'm glad you're on my team with respect to it. Fundamental analysis is PE ratios, whether it's a good company. Technical analysis is it the right time to trade? So we're going to talk a little bit about technical analysis, and it's all patterns, right? We see a box, a triangle, we know the next one's a star, right? So I'm going to kind of walk through some of these, so that you have it. First of all, market direction. Uptrending, right? Downtrending, sideways, oscillation, right? So we definitely need to know what the market's doing. So I always look at the stock, the index, right? And I'm going to look at the stock market first before I look at a stock, right? Because I want to make sure that the stock market's going up, because that will 75% of a stock's value is related to the overall marketplace, right? It also means I may not buy the stock, I might buy the index instead, right? So this is the Russell, and just, if you take a look at the Russell, right, there is an uptrending market on the Russell, right? We would expect this trend to continue until it starts to go sideways and goes down. So as far as I'm concerned, this would be a good covered call potential. This would be a call potential. This would be a buy the stock and hold it kind of potential, right? Market's going down. We usually take the tops of the mountaintops when we're drawing a chart to kind of see, what's going on, right? We draw the tops of the mountaintops so that when the stock breaks, right, it breaks through the mountain, which is a sign. It's a sign of reversal. It's moving in the right direction. This really isn't a sign of reversal yet, right? Breaking the support line is a sign of reversal in terms of the mountaintops, right? And of course, you know, when you're taking a look at stocks, you're going to kind of see that, you know, you also get sideways pieces, you know, where it goes sideways for periods of time. Okay. Uptrending, calls, right? You know, downtrending, puts. Sideways, covered calls and credit spreads. I mean, that's kind of rules of thumb with respect to uptrending, right? Sell a vertical put. Downtrending, sell a vertical call. Okay. And the reason for doing that is because we will make money by selling it. Money goes into our account, and there's no risk to us as it continues to go down. And in fact, as it continues to go down, you know, we sold it for $1. It'll shrink in value as it goes down because it gets further away. Right? At some point, it's going to get to 5 cents. When it gets to 5 cents, we buy it back and we do it again. Okay. So, you know, when it crashed and burned in February, you know, I was selling, right, vertical calls. I'm selling a vertical call, I'm buying it back. I'm selling a vertical call, I'm buying it back. I'm selling it for $1, I'm buying it back for 10 cents. Okay? So when the direction is going, right, up or down, you know, you can actually play the call going up or the put going down, but you can actually also do the vertical on the opposite side. So it's definitely a strategy that I use kind of on a regular basis, right? And you want to kind of also realize that, you know, that markets have support and resistance levels, right? A support and a resistance level is a percentage. Now on the Russell, support and resistance is every 50 points. So 1,000, 1,050, 1,100, 1,150, 1,200, 1,250. You know, right now we're over 1,600. Next one up is 1,650. The next one down, 1,600. From 1,600, it's going to go to 1,550. So I know that these are major support and resistance levels on the RUT, right? Right? I also know them on the SPX. So I know 3,500, major support and resistance level. I know it's 3,470 or 3,475, major support level, right? I know.
Jim, how do you know that?
You write it in. I'm going to
How
show
do you know that?
I write it in, right? I'm going to show you that, right?
Okay, great. Thank you.
That's exactly what I'm talking about, Kevin. Right?
Thank you.
Right? So I write in those support levels, right? So literally I know where those levels are. So I also know this, that if it breaks a level, right, and I'm going to talk about how it breaks a level and what's significant and what's not. When it breaks a level, is it likely to go to the next level, right? So if I know that the RUT is 1,600, right? You know, I know from the past that the next level up is 1,650. I also know that historically it's every 50. So even though I don't know what happens after 1,700, because we haven't been above 1,700, I kind of know it's going to be 1,750, then 1,800, right? Because that's what it does in the past, right? So, but the simplest way of doing it is you find the valleys and you find the hills, right? So the valleys, when a market comes down, it goes to a certain point and then it bounces. It goes down to a certain point, then it bounces. That becomes a valley. If I get 3 valleys together, then I know that that is support for that stock at that price point. If I go to the mountaintops, I kind of see that it gets to a certain level and it stays there. You look at the Russell on this slide right here, right? Back at that point in time, right? The mountaintop, the top mountaintop was 1,200. When it gets to 1,200, it bounces off of the ceiling and goes down. So we're looking for it to oscillate between a bottom and a top, okay? I know Coca-Cola, a bottom is $40. If it breaks 40 bucks, it's going down to $37.50. If it breaks $37.50, it's going down to 35 bucks because I've written that line so many times, okay? And those lines are not absolutes. They are what the stock is. What the stock is. So if I'm looking at a stock, it's going to have a support and resistance level. If I'm looking at a RUT, an index, it's going to have a support and resistance level. If I'm a regular trader of that stock, and I'm always a trader of the RUT or the DIA or the SPX, then I'm going to know what that is. Traded Coca-Cola for decades, really, right? So I kind of know what those numbers are because I've written that thing so many times. But if I don't know, the first thing I'm going to do is, let me take a look at a 1-year chart. Let me put in the support and resistance levels. Let me take a look at a 3-month chart, right? If I'm thinking about trading in a month. Okay, If I'm a day trader, I got to look at the last month, the last week, and the last couple of days, and I need to know where the support and resistance levels are. And literally, I draw them in. Where are the valleys? Where are the hills? Where are the valleys? Where does it bounce and come down? Where does it bounce and go up? Right? Right? And on the rut, it's every 50. So, you know, it's 1200, 1250, 1350. You're also going to see that stocks usually channel when they're uptrending, and sometimes when they're downtrending, but mostly when they're uptrending, between a range, right? So it'll go up and down. So not only, if you can see here, right, I can't even remember what this is. I think it's the rut, right? Right? Probably is. Yeah, it's the Russell, right? So you can see that there's lines where I've drawn in, right? You know, 1200, 1250, 1300. So I've drawn in the support and resistance levels. But I've also put in, you know, and you can do this with most tools that are on there, whether it's Options Express or it's Thinkorswim, you can put in a channel, right? And the channel kind of predicts where the next uptrend is, right? So I kind of know if I'm looking at this sucker, geez, if it breaks there, it's going to here. But I also know that, geez, it's probably going to follow this line a little bit. And look how many times it bounces and follows that little channel until it gets there, and then it breaks down, right? And then when it breaks down to support, breaks up, hangs for a minute, and then breaks up to the next level. And we get this nice triple top, which is a pattern, right? Triple top, if it breaks the neckline, probably going down, there's the kiss goodbye, right? And then she's on a downtrend, right? You know, so the first level of technical analysis, right, is always support and resistance levels. Right? Where are the major thresholds for it? Coca-Cola breaking $50, I know it's going to 55 probably. Breaks 55, I know it's going to 60. When it gets to 60, it's going to bounce and go down, right? Unless something dramatic happens with Coca-Cola, which it hasn't done in the last 20 years I've been trading it, right? So literally what I do is I put in the support and resistance levels, right? So I kind of know there's a down, 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 and I look for where is it down on the valleys, right? And I'm looking for at least 2, but probably 3 or 4 valleys. Where does it kind of bounce? Where does it bounce when it's going up, right? You can see right here, 1600, 1590 is kind of where the Russell at this point in time, right, which is this year, right, kind of holds on. And there's an M pattern right there. There's an M pattern that drops down and then kisses goodbye, which generally means it should crash and burn. Okay? So I'm looking at the support and resistance levels that tell me where it's going to go next, which helps me target the price. Now, I mentioned the average movement of a stock in the period of time that you're doing. Well, that tells me what happens in a month, right? Or a day if I'm looking at a day. But, you know, what about the next day, the next day? Well, that's going to be a support and resistance level, right? So I may look at, you know, I'm doing the SP or SPX. I'm trading the SPX at 3,500, right? And I know it's got to go, the top of that is, you know, 3,580, right? Is kind of where it hits resistance, and then it doesn't really go past that, right? But today it's only going to go 40 points. But I know that major resistance level, and you'll see this on my charts when I show them to you. I have resistance levels, big resistance and tiny resistance levels, because I'm day trading, right? Okay, so resistance and support's the first thing, and it's really about putting those valleys together and putting those mountain tops. And I also would take a look at the channel to see where the projection is of the next price up, right? Number one indicator, you know, for technically is the 200-day, 50-day moving average, right? The 200-day, 50-day moving average is something that you see on most shows where they say, hey, the 200-day and the 50-day is this, right? When the 50-day and the 200-day cross, if the price is going up and they cross at the top, that's called the death cross, okay? Now, it's the death of the stock, right? So it literally means in the next 6 months to a year, the stock will crash and burn, and sometimes even faster than that, right? You know, so 2008, here's the death cross in 2008 on the Dow, right? You can see that it happened in January of 2008, It actually happened earlier than that, right? Now we're in the future looking at the past, but if we were in the past at this moment in time, you know, a 200-day moving average is the last 200 days. A 50-day moving average is the last 50 days. If I move forward one day in time, the averages change, which means the crosses change. So actually you see it here in January being very firm, but it actually started to vacillate in November and December. So you had early warning that the Dow was going to crash, right? Right? Because live in time, it was going through the 250-day and coming back, moving through. And when it vacillates like that, you know, if it continues to go down, it's going to create a hard cross. Now, moving averages change every day, right? So if I show you this chart, it's different than the actual chart that was happening back in the history because it's looking at the last 200 days and 50 days, right? So that's my way of saying that in January, you can see it here, but it actually started in November and December. So you should have been doing a protective put or planning on playing the downside back then. And I started calling my mom and my dad up in Canada because they were in the market, right? When I called them, I said, hey, look, get out of the market. Both of them, their financial advisor told them to stay in the market, right? And both of them lost 40 to 50% in their account, okay? 200-day, 50-day moving average is the first indicator it's going to crash, right? Okay. And this year, 2020, right, I'm going to show you the 200-day, 50-day moving average, and it's going to show it happened in February, but it actually happened in November and December. That's where it started to vacillate. So you should have been well protected long before February rolled around, right? It's one of the reasons I posted on my site in December, think about a protected put. The S&P 500, same thing, right? 200-day, 50-day moving average crosses, death cross, right? The Russell 2000, death cross, right? So, and the Russell normally happens a little bit faster than the Dow or the SPX. You'll find on the Russell, the holy cross, which is the up one, and the death cross happened before the Dow and the S&P because it's a small cap, which means people can get in and out or out faster, where some of the mutual fund managers, you know, that have thousands of positions, takes time for them to get out, right? So what that means is look at the Russell first, then look at, you know, the S&P and the Dow, right? This is what happened in February of this year. Can you see distinctively there's a 200, market's moving up, there's a distinct cross, right? And it's on the downside. But what you also see is that the 200-day, 50-day moving average, right, crossed, right, in September, October, and November. So that was the early indication, man, we could have a bad year next year, right? We should probably be thinking about a put, right? And if you put a protective put in November, December, you know, and you did 6-month put to June, you made out like a bandit, man, you know, and that's what we do when we think the market's going to crash. We put in puts. We buy a put. We buy a put that's 90 days or longer. Now, if you're doing a 200-day, 50-day moving average and you're thinking about protecting your account, you want to do a put that's probably 6 months, right? So in December, January, I'm thinking of doing a June put, right? Because I want to catch that drop, right? Just a side note right now, you know, the U.S. is going through, you know, elections right now, and I'm apolitical, which means I don't go one way or the other, right? Okay, you know, unfortunately I have a green card, which means I can't vote anyway, right? So I never have the opinion about whether Trump is great or bad or whether Biden is good or bad. I do have an opinion about what may happen if one or the other gets into the stock market, right? But what I mean by that, one gets into the office and what happens on the stock market. Generally speaking, Trump is good for the stock market, right? Because his policies are about small business, about taxes and things of that nature. Biden, if he gets in, a little more socialistic, right? It's a little more socialistic, you know, what will happen is the stock market will see a crash or a downtrend, right? You know, so I want to be prepared in case one of them or the other one gets in. If Trump gets in, stock market's probably going to rally, right? Which means November, December are good months anyway. Now they could be great months. You know, Biden gets in, we might see choppy or down. So I'm thinking about that protective put, right? Now I'm going to kind of give you 2 ways that you can set this off. One of them is, I think I'm going to get one today, right? And one of them is, I'm going to get one in the future when the market does something, okay? And either one's okay with me because they both work, right? but it's highly likely that there's going to be some volatility on November, I think it's 3rd, right? Right? So we'll see some volatility one way or the other. Death cross, right? And something we want to do with a protective put. Holy cross. Interesting enough, and this happens very rarely, guys. Death cross, major crash. Holy cross, couple months later, right? I mean, we rebounded very fast. Normally it takes 18 months to rebound, right? I think we rebounded in 6 or 7 months, right? And we actually had the Holy Cross kind of last month in August, right? I guess last month would be September, so 2 months ago. So we have a Holy Cross, right? And it's gone over the 200-day 50-day average and into the 50-day moving average, and we have a nice upward kind of trend right now, right? So we do have a nice upward trend at the moment. It has rebounded pretty nicely, considering what happened, whether that's the stimulus package or whatever it might be, right? We just continuing that conversation just for a second. We haven't seen the other shoe fall yet, right? You got a moratorium right now on renters. You got a moratorium on mortgages, right? So right now, the real estate market's doing pretty well, and it's doing well because it's being uplifted a little bit because, people aren't seeing foreclosures. I think, once that's kind of the moratorium's gone, you're going to have to see people that can no longer live rent-free, right? And you got a lot of people in the U.S. that are living rent-free that have jobs. And they're doing it because they're taking advantage of the system at the moment, right? So when they start to pay rent, they got to make up for the past, and all of a sudden they got to pay $6,000 worth of rent, or they got to catch up on their mortgages. Houses are going to go into foreclosure. Occupancy rates are going to go down. Housing market next 6 months to a year may see a hit. Our housing market takes a hit. We may see stocks take equally a hit. So you start thinking about next year, 2012, right? And obviously we're technically take a look at 2021, right? So when we're taking a look at that, think about, geez, maybe that May-June time period where it's a downtrend anyway. If I get some economic data that's bad, I may have to think about another protected put, other than the November time period, right? Take control now. Take your self-directed, start trading within your own account. Get a protective put or a directional trade going for you on the downside, right? So when we kind of see that. This is actually from my credit spread trading site. So you guys that have bought credit spreads training from me, whether you bought the self-study program or the mentorship, right? I posted on December 30th of 2019. Hey, so the market's been doing pretty well, right? It's been going on for years. Makes me a little bit nervous. There's some candlesticks that suggest some things. Might be a downtrend. Hey, let's buy a March, right, put. Right? So if you had bought that March put, would have done pretty well for you, right? I know a couple of students, my mentorship students, actually bought puts, and I think one of them made $100,000 in 10 days, as I recall, right? I don't even know if that person might be on the line or not. Who knows, right? Okay. So, if I had have bought, a protective put on December 30th, right? And at December 30th, the DIA was at 284, right? Would have cost me, to do that, about $1.18 per share times 100 shares. That would have been about $1,000 to protect my account a little bit, right? And if I had done that and just let it ride, right? I mean, literally, that $1,000 would have turned into, much more, right? So, I mean, look at what happened in that 30 days, right? I mean, now that same option, right, is worth, $98, right? So is that a pretty good day at the office? Yeah, right? So protective puts are very useful when you think there's going to be a major crash or a downtrend with respect to it. So definitely something we kind of want to think about. I don't know how many people get an 800% rate of return, but that's a pretty good rate of return, in less than, December through March. What's that, 3 months? I'm preaching that we should be thinking about a put. The market is doing the 200-day, 50-day average last year about a put. And then on February 5th, right, an article comes out by MIT, right? And MIT says that there's a 70% chance that there's going to be a recession within the next 6 months. Now, I don't think that they knew that the recession was going to start in late February and go through March, right? But they had that thing. If you didn't listen to me, you should have been listening to MIT saying there's going to be a recession, right? Right? What if you had to wait until February? You didn't do the protective put in, December, January, or, it didn't even do it on February 5th when MIT said, there's a downtrend. Okay, so one of the things you want to watch for is the 200-day, 50-day moving average. And if the market drops below the 50-day moving average, that's significant. Okay, especially if it's a big drop. Okay, so if you have a big drop and it moves, through that 50-day average, that's pretty significant. And if you take a look here, back, I don't know what the date is on here. Got to be around the 15th or so, right? It's got to be around the 21st or 22nd. But anyway, here, this candlestick, which is a down candlestick, it's red, which means it opened high and went low, right? And it broke the 50-day moving average. That's significant, okay? Especially when it breaks with authority, right? And then the second day kicks off, and it breaks the 200-day, 50-day moving average. If you didn't think about it before, right, when it was vacillating, when it breaks 50-day moving average and the 200-day moving, it must cross in the next period of time, because the current movement predicts what's happening on the 200-day and 50-day. So when this happened, you should have went, oh my God, I need to have a put, right? Because it's dropping to the foot and it's dropping quick, right? Hopefully you caught it before, but definitely be watching that 50-day and that 200-day, in terms of it, right? Now, every charting package that's out there, and lots of free ones, like Yahoo Financial has a free one, stockcharts.com has free services, right? So any of those things, I've got one on my phone, that's Stock Charts, right? A lot of that is all free, right? So you can actually know when it does. On February 25th, when that first thing happened, you could have bought the Dow, right? And the Dow, I'm doing the DIA here, which is the mini Dow, right? You could have bought the Dow, the 270, for about $11.98, for about 12 bucks. 100 shares of that would have been $1,200, right? $1,200, significant, but not as much as what could happen if it goes towards you. And literally 1 month later, that same option that you bought when it started to crash, those big candlesticks, right? That 270 Dow, is worth 85 bucks, right? So, 12 bucks that you paid for it, now it's worth 85. I mean, that's a pretty good rate of return in 1 month, right? I mean, that could make for a great year for you, right? That's a $611, percent rate of return, right? So we definitely want to watch that 200-day, 50-day moving average. Now, moving averages are very useful, right? So there's a couple of moving averages besides the 200-day, 50-day that I take a look at. The 250-day is going to give me a long-term look, whether the market is, the downtrend or the uptrend. When it's vacillating up here, I'm thinking about a put for the next 6 months, right? When it's down here vacillating, I'm thinking about a call for the next 6 months, because it should break and go to the upside, right? I'm also going to use 2 moving averages to trade, okay? So you can use a simple moving average, which is one line, right? Or you can use a combination of moving averages to give you a signal to get in and to get out, okay? So if the 200-day, 50-day moving average is a good signal for long term, right? A 5 period and a 20 period is good for a shorter term. So I will use a 5 period and a 20 period to get into a stock, an index, a future, right? And I'll use it as the threshold to get into the stock or get out of the stock, or get into the position or get out of the position, or get into the future or get out of the future, right? Very simple kind. I mean, all it is a 200-day moving average with minus a 0, right? It's a 25, right? So it's moving. It's taking a look at a 5-day average, and it's taking a look at a 20-day average, which will allow me literally to trend in and trend out, okay? So, and I can start by just using the 20-day, or the 5-day for shorter periods to kind of make a decision. Okay, so I'll kind of show you this, you know, to kind of do it. Now I use the 5 and the 20 together, but literally you can use them separately, right? So this is the 20-day moving average on an E-mini, which is the S&P 500, right? Price breaks 20 bucks, the 20-day average. When it breaks the 20-day average, time for me to get in. When the price goes down below the 20 days, time for me to get out, right? So you can use moving averages as the indicator to get out. Now, you can do this not only with a 20-day, but you can also do this, you know, by putting in some support and resistance levels and mix the two together, which is what I do, right? So if I had just used this moving average to get in and get out on an E-mini, that's a $24 move, right? And it's a $24 move over basically 2 days, right? On an E-mini, every dollar is worth 50 bucks, right? $24 times, you know, one contract, that's 1,200 bucks in 2 days on a $6,000 investment. It's a pretty good thing. Love moving averages. Moving averages are a great way to trade, you know, but you want to make sure you put them on steroids. So I'll kind of show you them on steroids in a little bit, right? There's another big move using just the 20-day, right? If the price breaks the 20-day, without thinking about that this is a big W pattern, this is a bottom, you know, at 1990, right? There's some resistance here at 2000. You can kind of see the top here. 2000 is a resistance. This is a support level at 2000, right? You know, I mean, just based on it crossing, I should be into the trade. Now, these are trades that are happening in 3 to 7 days. So this would be something weekly I'm doing, right? Not daily. That's something I'm doing weekly, right? And just based on that kind of position, and you can do this on Forex, you can do this on anything, but use a 20-day average, right? Good for a weekly to a 2-week kind of trade kind of period. It's kind of a swing trade kind of piece. Better, right, if you add to it a second moving average, right? So a second moving average could be a 5-day average, right? So in here, you kind of see a 5-day average. The difference with this is now it's telling me I got to trade daily when price moves up. So if I'm using a shorter average, you know, based on looking at the month, right? You know, I might change the way I do that, right? So, you know, putting them together, well, we stick them together. So we add the two moving averages together, right? And I got to keep moving you guys around. Sorry for the delay there. Remember here, right? Right here, I'm waiting for it to cross. It crosses, right? When it crosses, I get into the trade. Now, this would have been about 2000, right? I have a longer term 20-day, which is the red line, and I have a 5-day short one, which is the blue line. Now, I probably would have started to think about getting out here because it's moving kind of sideways, but it tells me to get out here, right? So I got in at 2000, right? And I got out at, you know, 2038. It's a $38 movement on the upside in 3 days, right? So in 3 days, you know, on a $6,000 investment, one contract on the Thinkorswim platform, you know, that would have been 1,900 bucks, you know, or about 30% on my money, right? And that's just using a simple moving average. Now I'm doing this for the week, right? And I'm looking at a daily chart, right? And on that daily chart, I'm using a 25, right, period average, which is daily. So it's looking at a daily price. Are you guys with me? If I move to a day chart, okay, I'm still going to use a 25 period average, but I'm going to use it for the candlestick time period, right? And I'll show you this in just a minute. Now, my candlestick period on a day chart for day trading is 3 minutes, okay? 1 minute's too short, get a lot of false kind of pieces. 5 minutes is too long on an E-mini or an S&P X or an SPY. So I want to use a 3-minute candlestick, right? And I'll show you where you can do this in just a minute if you're on Thinkorswim. But I still use the same 25 period piece, right? So I use that 25 period piece to give me a signal to get in or get out, right? And again, you can kind of see here, right? You get a signal here, you know, to get in, right here at 2048, and you get a signal right here where it crosses again to get out at 2085 over the last 4 days, right? You got a $2,000 move, right? $40 move, $40 times 50 bucks for every dollar, right? Means on the E-minis that you would have done about $2 grand, right? Could I have used this same 25 on the SPX? Yes. Could I have used the same 25 on a stock? Yes. Could I have used this same 25 on the Russell? Yes. Whatever you use this 25 to give you a decision to get out. I used to use this 25 on Forex, right? And it would give me a signal to get in and get out in a 3-day to 3-week kind of period, right? These are usually kind of weekly trades. They're swing trades. They're 3 days, sometimes longer than that, but usually 3 days to a week, sometimes a little bit more if you got a nice positive trend. But again, it gives you a signal to get in and to get out, right? This is, again, the futures kind of thing. And I got to point this out. Past performance doesn't equal future performance. Investment does have risk. I'm showing you this to give you an education that using a simple moving average can help you make the decision. Now remember this, I've already figured out that a daily move is X. I've already figured out that an up move, the average price move, is Y, right? I already know that the support and resistance level is this, and then I'm using the 25, 20 period, 5 period, to give me a decision to get in or to get out, okay? So, I mean, take a look here. This is an overnight kind of piece, right? 9:30, right in here, choppy, right? Starts there. I don't get a decision in here. Choppy, not good for me. Anytime it's going sideways, I'm not doing it. I get a decision here. Boom, nice uptrend there, kind of from that, 10:45, right through till noon, right? Don't quite get out at noon. It's starting to go sideways, and then I get a nice pop up again, right? So just by using that 20 position, you can see major moves with respect to it. And those moves are big moves on the S&P, right? They would give you a really good day at the office if you're tracking along with this. Just using a period of time, which is a moving average, which is a 20 period, 5 period moving average, right? I'm not going to talk about this right now, but one of my favorite moving averages is what I call the 55 system, right? Now, I did not create the 55 system. I've been using the 55 system for a little more than 22 years now, so it's been a great system. What happened was I was golfing one day. Because I was golfing at like 6 o'clock in the morning and my friends can't golf because they were working and I was retired, right? I said, put me on with somebody. So a guy came on, I got on with him, we got talking. He's a trader. I started saying, well, what do you trade? He said, well, I day trade and I use the 55 system. I said, what's the 55 system? He says, well, it's a moving average system. Well, I said, I'll do a 25. He said, oh, 55 is better, right? So I was like, well, what do you mean it's better? Like, explain it to me. He said, well, we're golfing. I'm not going to explain it to you. Long story short, I paid him $3 grand to teach me, right? So literally after golf, we had beers. We went to his house. We went to the 55 system. We made money with 55 right there, right? You're right, because we started at 6 o'clock in the morning to do it, right? And literally, I became a devotee of the 55 system. So I'm going to walk you through the 55 in a little bit, but I just want to tease you a little bit with it. It's a great system, right? Right, and I'll explain to you when it is. Now, 55 works really well on good days and not so well, right, on days where it's going sideways. So I mix 55 with the overnights, right? So if I see a strong overnight up or a strong overnight down, Asia and Europe, then I'm going to use 55 or 25 to give me a decision to get in or to get out, right? And you can kind of see here over a 7-day odd period, there's 2 days where a big uptrend and a big downtrend using 55, kind of sideways on a day, big day up, kind of a sideways day and a big day up and a big day up, right? Which means, 5 of the 7 days, right, it made money for me, but 2 of the days, was a bit of a challenge, right? And the only thing I want to do is make sure that I have a reason for I think the market's going up today, whether it's a technical analysis or the overnights on Asia and Europe, which is what I tend to look for, right? Typically, you know, what I'm going to do is do this on a Monday and a Wednesday and a Friday, right? Monday, Wednesday, Friday, because I may be thinking about buying a call. I may be thinking about buying a put on the Dow or the SPX. But I'm also thinking about, hey, if it's an uptrending market, what if I did the vertical put? Because then I have the benefit of the time expiration, right, as well as the directional piece, okay? So mixing those two together is a kind of piece. Now I'm going to also mention, you know, that, you know, you have big moves here, right? That one little move there, you know, that 55 told me to get into, right? Now I'll go into 55 in a little more detail. You know, that's a $25 move. 50 bucks, that's $12.50 on $6,000 invested. Not a bad day at the office. One of the things you want to start to get familiar with is patterns that happen on a regular basis. And there's a couple of patterns out there that you want to become familiar with. You know, a head and shoulders pattern, right? A head and shoulders pattern can be upside down or it can be right side up. But it basically means, you know, there's kind of a peak, a big peak, and then a little peak, and then it drops. The same is true on the opposite side. So head and shoulders can be upside down or right side up. And what happens is you get to a certain level of support, the shoulder, it drops down, then it comes back up to the head, then it comes back to the shoulder, and then from there it usually goes down, right? Right? So you want to kind of double pipe bottom. Downtrend, big, I showed this earlier, big candlestick going down, hits a level of support, another big candlestick goes up, right? If I play that, it has an 88% probability of success. So I definitely look for pipe bottoms. They don't happen that often, right? Question for you. Can you just know one pattern and play that one pattern over and over and over? Yep. And in fact, can you actually scan for that pattern to see it? Yeah. Can you actually go to a website and for free, nothing, find all of the pipe bottoms that happen? Yep. Can you go and find all the head and shoulders that happen? Yep. Right? So there are a couple of patterns, and one of them is called a cup and a handle that I paid 82% religiously, 82% probability. And towards the bottom, when the market's coming down, it does one of kind of five things. It does a V pattern, it does a double bottom, it does a triple bottom, or it does a cup, and then it does a cup and a handle. Okay? Now, in order, right? You know, a cup and a handle has about an 82% probability if the next day when it opens above the surface level of the cup and the handle, it has a high probability of going up, right? I'm talking like 80%, 82% plus, right? Cup, right? About a 76%, you know, double bottom, a little more than 70%, you know, I should say triple bottom, right? Double bottom, probably 60%, a V, never know, right? Can just go up, go back down. So we look for these patterns, right, that are happening on our stock charts. But if you want to, you can actually trade them too. You can actually go to different software programs. I'll show you one in particular, right? And this is a right side up head and shoulders, right? You've got it. If this was the Russell, right? Okay, and I'm just going to use numbers from the past. Here's 1500, right? Here's 1550, right? Here's 1530, right? Here's 1600. Here's 1530, here's 1550, here's 1500. If it breaks 1500, it's going down to 1450, right? Because I know that if that head and shoulders shows up on the Russell, those are the numbers because I know what the support and resistance levels are, right? Always kind of doing it. If this is making sense, give me a yes, no, thumbs up or something, right? Thank you, right? Big downtrend, right? Right in the dead of this chart. Now, there's other things that are happening on this chart which are interesting because there's a W pattern on the left-hand side, right? There's actually a cup in the center there, right? So there's some other patterns, but in the dead center, there's this V, and then there's a big down day and a big up day, right? So what's that? A double pipe bottom, right? And I know if I draw a line across here, and the next day it opens above that line, highly likely it's going to continue up with an 88% probability, right? So when this is happening in November, right, I'm thinking, geez, I should play this. I should play the upside. Now, this is actually from 2012, so it's years ago, you know, but it happens every couple of years. You know, you see a big pipe bottom, right? So we play it. Now, I got to point something out here. I see this pipe happen, double pipe bottom. Do I trade on the day that it goes up? No, I wait for confirmation, which means it has to break above the neckline for me to get into the trade. Now, I won't get the best price, but I will be right more often when I do that. And this is about, hanging out. This is about length. This is about, man, making your wins 68% or greater, right? Okay, this is a head and shoulders pattern. You got a downtrend, you got a shoulder, right, which is a level of resistance, and this is on CNET, right? So about 60, at 60, there's some resistance. And if I drew a line right across here, right, Kevin, you can kind of see at 60, there's a what? Resistance, right? It's where the mountaintops are. There's also support right here at 45. And in fact, when you get to 45, it bounces. Goes up to 60, got a little resistance. Even up higher at 70, it's got resistance, right? So I literally see a shoulder, a head, ugly head, a shoulder, a little higher, right? And then it breaks. Now, this is common to a head and shoulders, but it's also common to a double top, right? Usually when the head and shoulders happens, or a double top happens, which is an M pattern, right? What'll happen is it'll drop down to the next level of support. In this case, there's the neckline at 45. The next level of support is down here someplace, and then it will rebound, which is called the kiss goodbye, right? So you have a downtrend, a rebound, and then typically what happens on an M pattern or head and shoulders, it crashes and burns. Very common kind of pattern, right? So, if you think about that, I can make a little bit of money here, right? But then it reverses on me, and I'm thinking, oh crap, I need to get out because it's going back up. But all it's doing is to kiss goodbye, right? So, typically you may play this side, right? But most professional traders will play this side because they're waiting for the kiss goodbye, right? Now, I play both, right? I play both, and when I see it bounce, I get out, right? And then I'll play the kiss goodbye as well, right? So just kind of a note with respect to it, right? So we often will see patterns like this that happen regularly, right? Right here, we have an M pattern. We have an M pattern. Can you kind of see that? We have an M pattern, and it dropped. So if it does the kiss goodbye, it's going to come back up, right? And then it's going to drop like a rock, right? So this could be a double top, right? That's going to crash and burn in a little bit. And it might even be a head and shoulders. This could be the shoulder right here. This could be the head, but I want to see what happens here. Does it do the kiss goodbye? What does it do, right? Because it could do that, right? So, it could be another head and shoulders pattern. I just got to wait for the other shoulder to show up. Quite often, a double M can be the head and a head and shoulders, right? So we kind of watch what's happening, right? And I don't know until it does it, right? But when it does it, I'll kind of know. If it was a head and shoulders, I'm drawing across the neckline, right? When it breaks, 900, which is a level of support, by the way, on the Russell in the past, right? She's probably going down to 850. If it goes from 850, it's going down to 800. I use support and resistance as my target prices. If I think it's breaking, $50 on Coca-Cola, it's going to 52.50 because that's the next level of resistance. If it breaks 52.50, it's going to $60, right? Because I already know that that's what the level of resistance is. Usually when there's head and shoulders, there's more volume, right? If you want to learn more about a head and shoulders pattern, I'm going to ask you to go to stockcharts.com, right? Go to stockcharts.com, and if you go to stockcharts.com, you can actually plug into, on the search bar, you can plug into head and shoulders, and it'll show you an upside down head and shoulders. It'll show you a right side up down head and shoulders. You can put in double top or double bottom, right, which is the M pattern, which turns into a W when it's upside down, right? And you can learn more about that pattern as well. I definitely would learn about an M pattern, right? I definitely would learn about a double pipe bottom. I definitely would learn about a head and shoulders, and I definitely would learn about, a triple bottom or a double bottom. And I'd also think about, thinking about some others as well, because there are some others out there as well. But learn those ones, right? Okay, so this is the rut, right? Actually, it's not. This is Rollins Inc., right? And you can kind of see right in here, it's doing a W pattern, right? Which is an upside down M. And it's also got the kiss goodbye. So what am I expecting this to do? Well, I'm expecting it to rebound off the top here and then move up dramatically. Because those patterns repeat, they repeat, and they repeat. So, you know, when you see a double bottom, you draw a neckline, you look for the kiss goodbye, and when it does the kiss goodbye, it goes up. This was resistance. It now becomes support, and then it goes to the next level. Okay, so I'm looking for that on a kind of a regular kind of basis on W's, which would be a double bottom or a double top. And you can see these patterns regularly, right? There's an M pattern on the Dow Jones Industrial, right? And this is on the DIA, right? There's another M pattern on the DIA. Obviously, if you're sitting here, you're going, well, okay, so is it going to do the kiss goodbye, right? You know, here it went down and then started to do the kiss goodbye, and then it did go down. So we can look at these patterns and we see them pretty regularly: double top, double bottom, head and shoulders, double pipe bottom, you know, stair step up, right? That's the sign of an uptrending market, a stair step. We also have something on a stair step called a flag, which I'll talk about in just a few minutes. Stock charts can do scans, right? So this is actually, if you kind of take a look at this period of time, this is this year, right? This is actually a stock chart scan from yesterday, right? All I wanted to do was I want to find stocks that have a W pattern or an M pattern, right? And you can kind of see right here, right? You got a W pattern. I draw across the neckline, right? Right across the neckline right there, right? And I got a little uptrend and maybe a little kiss goodbye, which means this stock might be in a good position, you know, to move forward, right? Now, I don't know what this stock is. All I know is this pattern I found going to stock charts and looking for tops and bottoms, right? So you can actually find whatever you want, you know, in terms of a pattern, right? And I know the guy that charges $1,000, you know, to teach you the M pattern by itself, right? You know, he has scanning software that goes out there and finds the M pattern, and then you trade the M pattern. But you can do it yourself, guys, right? Now, I don't go and look for M patterns. I don't go look for double tops and double bottoms. I don't go look for, you know, head and shoulders. I just know that they're there, and I look for them in the pattern when I'm looking at the Russell. I look for them in the pattern when I'm trading the DIA. Now, I can trade this on a weekly basis, but I actually look for these patterns when I'm day trading. If I'm going to trade today, you know, and I'm going to trade on Monday for sure, I know that already, right? Because I'm excited about this, right? Right? So I'm going to trade on Monday. I'm going to look for support and resistance. I'm going to look for the average movement. I'm going to look for what happens on a day, you know, which I know in the SPX is about 40 points, right? I'm going to look for, hey, what's happened in the last couple of days to show me a pattern? Is it an M pattern? Is it a double head? Is it a head and shoulders? What's going on? And then within the day, I'm going to look for the same patterns. So we can look at these patterns within a few minutes or a few weeks or a few months, right? Doesn't matter, right? It will work for you on a daily basis as well as work for you on a weekly kind of basis as well. So you got a nice little M pattern with respect to that, right? And this is actually, you know, I went on to, this is actually scans, predetermined scans, right? And I'll kind of show you this. When you go to stockcharts.com, you go on the bottom right hand. First of all, you got to go to the tools. When you go to the tools, you go to the bottom right hand side, and it says predetermined scans, and it has some incredible scans, right? You can find things that you didn't know you could find, right? Guys, there are dozens of patterns. Those are just some of the beginning ones: head and shoulders, double top bottom, or double pipe bottom. There's also a double pipe top, where you have a big up day and a big down day, which tells you that it should be going on the downside, right? Okay, again, we're looking for patterns. Well, one of the patterns you can look for are literally, you know, candlestick patterns, right? So I'm going to talk about what a candlestick pattern is, how it calculates, and what they kind of are, and then kind of show you the top 10, and you actually have the top 70. I gave you a little book on that you can take a look at. But let's say that the stock opens at $9. So this morning it opens at $9, first thing out of the gate, right? Then immediately, you know, the stock closes at $10 for the day. Okay, so it opened at 9, closed at 10, but during the day, it went below 9 and it went above 10. That can happen and happens kind of regularly, right? So what you can do is say, well, you know, it opened at 9, but at some point during the day, it went down to 7. right? And that becomes what is called the wick or the shadow on a candlestick, right? It's showing you the how low it went during the day, right? We can also have a candlestick, right, show the high of the day. So we see the wick, right, which is just a line, black line, that shows the high for the day. So it might have went up to 11, right? So it went down to 7, went up to 11, but it opened at 9 and it closed at 10. So kind of the way that they make a candlestick, right, is to put a little box around the beginning and the end. So what they do is they just put that little box around it. So if the box is white or clear or sometimes green, because you can set what color you want it to be, right, then that means it opened low, right, went lower, went higher, but it closed higher than it opened. So what this does is tell me what happened for the day, right? It tells me what happens for the day, and if I can take a look at 2 or 3 of these, or even one of them, I can tell you probably what's going to happen tomorrow, right? Been around for hundreds of years. That's literally what the Chinese did to sell opium and sell tea, you know, hundreds and hundreds of years ago in the trading, right? They come up with these patterns, and when they see the pattern, they would know the next day what's going to happen. So it would help them price, you know, what was going on with tea and opium back then, right? So sometimes they call the wick, the up on the bottom, or the shadow or the wick. It's really the high and low for the day, right? The real body, you know, can be white, and that would be opening low and closing high. And we have the reverse where it could open high and go low. And when they do is they fill that in and make it black, right? So they fill it in and make it black, or sometimes if you've got a red thing, they'll show it. They're color coded, right? So when you're looking at a chart here, you can kind of know, well, geez, you know, there are uptrends, right? And there are big candlesticks and little candlesticks. And this is your first hint, guys. Is it a big candlestick or is it a little candlestick? When she's uptrending in a major way, the candlesticks are going to be kind of big. And when they're small, it is hitting a resistance level, right? So you were asking, Kevin, you know, how do I put in the resistance level? Well, it's all about, you know, the peaks and the valleys. But when I see it start to go sideways, that's usually at a resistance level, whether it's a big resistance level or a little resistance level, right? You know, also, when it goes sideways, you're going to notice that the candlesticks aren't big anymore. They get really small, which is a sign of indecision. It means the bulls and the bears are fighting it out. The buyers and the sellers are fighting it out. The up guys and the down guys are fighting it out. When they're fighting it out, you will see that quite often that pattern is either a hammer or a doji, right? Leave that for now. We'll come back to it because I'm going to show you a hammer and a doji, right? But they also create patterns. Right? So I know, right, that these candlesticks become the charting pattern, become the charting piece, right? But they give me kind of an early indication of what's going on, right? So, you know, that's a white candlestick, right? That's a white candlestick. That's a black candlestick, sign of a downtrend, right? So I kind of know if it's going up or down. One of the things you want to watch for is this. You have candlesticks, and they're fairly large, and then they start to go small, right? It means it's the end of the trend. You're hitting a resistance. This is a time for you to get out of the stock. This is a time for you to get out of the position, right? You know, so I'm looking at Coca-Cola. When she gets up to 32.50, right, she's going to start going sideways, and I'm going to see little candlesticks that get really small. Time for me to get out, you know, or wait for the next bump to go to from 52.50 to 55, right? Right? But I know this is going to happen, you know, kind of regularly, right? So I'm looking for this and watching it, right? And you kind of see that the candlesticks usually will look like an X, or they'll look like a hammer, right? So a hammer and an X are signs of indecision. The bulls and bears are fighting it out. And I'm going to go into what a hammer is in a doji, what's called a doji, which is the X, right? Just a kind of a minute. But this would tell me that if I bought here, time for me to get out of this if I want to take profits, because there's a chance it's going to reverse and come back down, because once it hits resistance, it usually will go back down, or it'll penetrate resistance, which I'll talk about just in a minute, right? Because I want you to understand that, right? Right? So we often see that, geez, support is at X, right? And then when it gets to resistance, we sell, right? So literally we buy at 40, we sell at 50. We buy at 40, we sell at 50, right? We buy at 50, we sell at 60, right? So we use support and resistance to give us target prices, right, to shoot for. Now, in addition to the target price on the support and resistance of the stock, the index, the whatever it might be, the future, the whatever, we also want to take a look at, what is, in the period of time I'm trading, what is the average price movement within that period of time? Now, I know right now on Coca-Cola, it's $3. I know on the Dow, it's about $5, right? I know on the SPX, 40-point move is a kind of a big move, but it's really about 18 to 20 when it goes up, right? So I know that. It's about 6 when it goes down. So I know that already because I've already done what's the average price movement and where's support and resistance. Now, here's where it becomes kind of difficult. You have your prices and like, man, it goes to $80 and then it goes to 90. It's done the $10 movement I expect it to do. Should I get out or not, right? So that's where you got to kind of look at the past and say, well, has it gone past? Like Coca-Cola, good example. Just went from 40 to 50, right? Now 50 is a resistance point, and she's been sitting there for a little while, right? When she breaks 50, she goes to 51, highly likely it's going to 60. But it has to break the resistance, otherwise it bounces and goes down, right? So I may, decide, well, I'm going to get out, of my call position today and make money on it. And then I'm going to set another order that says, if it breaks 50, 50, 50, 50, 51, get me into the call again, right? So I'm going to take my profit and go home and then set it to break the next resistance level. So I don't mind getting out of a position, making money, and then setting a contingency order that if it does go in the direction I expect it to go, get me back in. Now I'm going to miss 50 cents or I'm going to miss $1, but it's highly more likely I'm going to win, right? So it's kind of how I play resistance. Take my profit and go home and then set an order to say if it goes to 51.50, right, 50.50, get me into the call position on Coca-Cola because I think it's going to 52. Right, kind of a better way of trading than just hoping and praying it goes up, because quite often it'll reverse and go back, right? I'd rather take the profit and go home, right? So we look for this. Okay, dojis and hammers. Okay, a hammer, right, is a head that has a tail, and the tail is 2 times the head, right? So that wick, that shadow, is 2 times the head. That's a true hammer, okay? A doji is a cross. Now, it can be a simple cross, but it has a wick up and it has a wick down, right? It can actually look like a cross, meaning one side is longer than the other side, right? Or it can be what's called a fat doji. It has a wick, and the head is a little bit bigger than just a line across, okay? So you got dojis, you got hammers, and you got fat dojis, okay? When a market comes up to resistance, right, it typically hits resistance and you see hammers and dojis going at the resistance level. Okay, it's one of the ways that you know that it is a true resistance, because you're seeing hammers and dojis, which means the buyers and sellers are fighting it out. Nobody's winning, right? One day the buyer wins, one day the seller wins. Most of the time they don't win. That would be a cross or a doji, right? And what a doji means, like a cross, means it opened at $8. It went up to $9, it went down to $7, and it closed at $8, right? So it closes at the same level that it opened, right? That would be a normal doji. If it closed it opened at 7 and closed at 7.25, that would be a little fatter doji, right? But it is a sign of indecision. Usually happens in a major reversal, or it happens on resistance and support. Okay, I'll say that again. Hammers and dojis normally happen at resistance and support, or it happens on a major reversal, right? So a big downtrend, I see a hammer, likely to reverse. Big downtrend, I see a doji, likely to reverse. I have a big uptrend, I see an upside down hammer, which is called a shooting star, likely to reverse. I have an uptrend, I see a doji, right, likely to reverse. And I'm talking with 62% to 68% probability, right? It's going to reverse, generally speaking, if you see those patterns. Now, 68% means 2 times it's going in the direction I think it's going, but 1/3 it's not. So I still wait for confirmation. I still wait to see, does it actually reverse? And that's when I get in, right? So they're important piece. Okay. Quite often when you're getting to any stock, any index, any piece, any future, you're getting to a resistance level, right? There's kind of three ways it breaks resistance. One way, not as significant as the others, and that's when you get a single penetration. You know, the candlestick this day, right, breaks 50 bucks. Okay, not significant, right? Because it can reverse and go back down to $49 tomorrow, right? So the fact that it broke 50 bucks doesn't mean it's going to 60. It just means it broke 50 bucks, right? And the next day, probably going to go sideways or reverse to go back down. So people get excited. Oh, it broke 50 bucks. I should get in. No, you should wait for the next day to see if you get confirmation it's going in that direction. Now, if the next day it's up above, 50 bucks, then I'm probably into the trade, but I don't look at that first penetration as a reason to get in, right? So that quite often happens for people. You know, they get excited and they say, well, it's breaking 50 bucks. I'm going to get in now to get a good price. If it gaps a resistance level, breaks right through it, right? Doesn't even touch it, goes right above it. Like it closed at 49 bucks on Friday, and on Monday it opened at 51. Likely it's going to 55, right? So gaps are more significant than a single penetration, okay? So I would be more apt to trade Coca-Cola or any stock if it gapped, was going. In fact, would you guys like to learn a little bit about gaps? I have a gap trade. Would you like to learn it? I hadn't planned on teaching it, but I could show it to you if you want me to. Let me see a show of hands. Right? Well, I got almost all of you putting your hands up. I was going to show it to you anyway. Right? One of my favorite trades. Right? Okay. So if it gaps, that can be a good thing for us, right? Okay. So what I'm really looking for is this, right? I want it to penetrate. I want it to open, right? Be above, and then I want it to come back down, right? And resistance now becomes support. It hits support and then breaks to the upside, right? This is the beginning of something called an Elliott wave. An Elliott wave is a system, a strategy, a concept that you may embrace sometime in the future. I used to have a software program, cost me 2,000 bucks, and all it did was show me this, right? Simple thing is, hey, it went above the line, came back down, touched the line, and then breaks out. So if Coca-Cola goes up, hits 51, comes back down to 50, hits 50, and then the next day after this hits, 51 again, she's going up to 55. So we like to see it break resistance, come back down to resistance, and then break up. Now, in Coca-Cola, because the candlesticks, might be $1 or 50 cents, less likely for you to see it than on the Dow Jones Industrial or the RUT, where you kind of see major movements that way, right? But I am looking for that bounce, looking for it to break, bounce, and go up, right? Because that kind of tells me it's on its way up based on a very strong pattern, which is called an Elliott wave, right? So we do look for those resistance levels, right? And we kind of see that they happen, right? And this actually gives us an opportunity to trade, okay? So when a stock is going up, it has nice big candlesticks, and then it has a flag, right? It has a sideways pattern. This is called a flag pattern, okay? Now, a flag pattern is a pattern that will continue, right? Now, the way this will continue, there is a 62 to 68% probability that the flag will continue to go up. When I see a flag, 62 to 68% probability, it's going to continue in the direction it was going. If I have a resistance level and it goes sideways for 3 to 5 days, highly likely it's going to continue to go up. I know that is the bias. Whether that's on a day chart or whether that's on a daily chart, I know that's the bias that it's going to continue to go up, right? Now, flags kind of look like a flag. The long candlesticks are a pole. The flag is the, going sideways, and it's usually dojis and hammers going sideways. But flags sometimes are not just straight. Sometimes they're down a little bit. Sometimes they're up a little bit. And sometimes they're not quite a flag, but they're a pennant, right? In trading, this is called a wedge, right? And the wedge, right, it goes from bigger candlesticks to smaller candlesticks on a wedge. If you see a pole, right, which is an uptrend, and then you see it going from big candlesticks to little candlesticks, sideways or a little bit down or a little bit up, that's a wedge, and it must break to one side. And when it breaks, likelihood is it's going to break to the direction it was going. Okay? So with kind of a 60% probability, you know, we can play a flag. So you have flags and wedges and pennants, right? Right? They can be a true flag, or they could be a downward wedge or an upward wedge. Whatever direction they were going, it's a downtrend and we get a wedge. A downtrend and a flag, highly likely, 60 to 62, 68% probability it's going to continue in that direction. So I know it's going to go. Unfortunately, 32% of the time, it's going to do what? Reverse, right? So decade ago, longer than that now, 2 decades ago, you know, I learned how to play flags and pennants because they happen regularly. Okay, so this is a pretty simple kind of strategy, but it's one that can make you quite a bit of money on a stock, on an index, on any of those things if you kind of watch for it. So this is E-minis. This is day trading again, right? And if you take a look here, you can kind of see uptrend, and then it goes sideways. Uptrend, and it goes sideways. Uptrend, and then it goes down, right? Uptrend, and it goes sideways. Big triple bottom top there, right? Well, look at that, little cup and a handle. Thank you very much, Jim. Over 280, it's going up, right? You know, so we look for this pole and this sideways action, okay? Right, so literally, right, we look for this, we draw it in, right? There's a flag, there's a flag, there's a flag, right? So we draw that in, and basically here's what we do. Here's the first flag that I just showed you on that chart, right? This is actually from my futures course from a few years ago, where we live traded this, right? Did really well as well. But literally, you know, we see, right, that there's a flag there, there's the pole, there's the flag, right? And what we're going to do is we're going to draw a line across to the price point, right? We're going to find out where the resistance is on this flag, and we're going to find out where the support is on this. Now, this isn't a major resistance. It's a minor resistance, right? It's a minor resistance in the first hour, right, that we're getting some resistance from going up to from 252 higher, right? So literally what we do is we kind of draw a line over to the price there, right? And you can see the bottom support level is at 2049. The top support level is at 2052. So there's a $3 move, right, on the E-minis, SPX, right, $3 move, kind of going sideways, right? And we expect that it's going to break to the top, right, 68% of the time, but it's going to break to the bottom 32% of the time, and I don't want to be wrong, right? I don't want to be wrong, so I'm going to wait for confirmation, right? So what I'm going to do is set up a trade that basically says, you know, if it breaks 2052.50, get me into the call or get me into the upside of this trade. If it breaks the bottom 2049, get me into the bottom of this trade, right? Now we would have to do this on the SPX, or we'd have to do this on the SPY, because you can't do it on futures, because on futures basically you're buying up or you're buying down, right? You know, but that is a good pattern for us to kind of trade that piece. And basically we're saying, hey, look, if it breaks 2049, if it goes down to 2049.50, I'm going to play the downside. If it goes to 2053, I'm going to play the upside, right? So, and 68% of the time, I'm going to be into that up trade, and 32% of the time, I'm going to be into the down trade. And if it continues to go sideways, it's not going to matter. High probability trade. I can do this on a day chart. I can do this on a monthly chart. I can do this when I notice that the Russell is going sideways for 5 days or 3 days, right? I can do this on the SPX. I see it's going sideways between, you know, 3,500, you know, and 3470. It's going sideways. Man, it's got to break to one side. It can't go sideways forever. It's got to break. So if it's going to break, I'm going to play the side that it breaks on. Okay, so I set the order to say, if she goes up to 30.53, get me into the call position. If it breaks into 30.53, get me into the SPX position on the call side, right? Or the SPY, right? So literally I'm playing both sides, right? You know, when I play this, it breaks and gets me into the 20.53, right? And I get a $3.50 point move. I already kind of knew it was a $3 move because I already knew that this was $3. Are you guys with me? So it's a $3 move. It's hitting another level of resistance. It's hitting a price movement, which is the average for here, which is about $3 back then. Not now, not today, Talking about 2015, that's what it was, right? So a $3 move. So I know it's time to get out, right? I know it's time to get out. You know, on one contract and a $3.50 move is $175. Right? Not a bad day, right? So, and I just play this over and over, guys, right? I just play it there. I know there's support and resistance there, right? As soon as I see the flag, right, I know that the next level is at least $3 up. It's at $55, right? And coincidentally, the next move up is $20.58, which is $3, right? So figuring out that average price move up and down is important for you, but also doing the support and resistance levels, right? So we can actually do this, right? And you'll kind of see this. I post every once in a while, you know, on my credit spread post, you know, and you guys that, I mean, Serge, it's been 2012 since, you know, you took credit spreads with me, right, up in Canada, right? I haven't changed the password on that site, right? The password is the same now as it was back then, right? So I say you get it for a year, but you guys have had it for forever, right? Still have it, right? You know, so I post when I'm doing a flag trade, I post those things, you know, because credit spreads is great cash flow, but every once in a while you want to do that, okay? There are all kinds of things that you can see on a chart, guys, right? I mean, look at this chart. This is, I think this is the Russell, as I recall, but I'm not really sure, right? Doesn't really matter, right? I mean, there are some things happening here that are interesting. Here we have a cup and we have a handle, right? If we draw the surface right here, right, and it breaks the surface, should go up, right? Here, you know, you got a W pattern, right? You actually have a triple bottom or a head and shoulders upside down, right? Right? So if it breaks the neckline, highly likely it's going to go up, right? So we can take a look. Here you have a W pattern, right? Breaks, does a little kiss goodbye, moving up, right? So there are these patterns that happen religiously, regularly, that you can kind of, here you have a pole, right? You have a nice little pole here. You have a movement sideways. If it breaks this, it's going to go up, right? It actually goes and hits resistance and keeps going up. So we look for these patterns, you know, to give us a high probability trade, you know, which is better than I hope that Coca-Cola goes up this month, right? So you can kind of see that there's different patterns that you can do here. You can trade after hours, by the way, right? You can trade on something like E-minis. You can trade, you know, pretty much 6 days a week. One day it's off, right? Right? So, you know, I don't like trading after hours. And the reason I don't like trading after hours is there's not much volume. And this is actually from the past, right? You can see that this is E-minis. 4 o'clock happens, you know, the volume goes down dramatically. There's no movement up or down, and it kind of goes sideways, right? There are movements overnight, right, on E-minis, right? But generally speaking, it's a grind. It goes up $1, it goes down $1, it goes up $2, it goes down $2. Unless you see something happen on Asia or Europe, that's pretty dramatic. You know, you're not going to see a big movement on the E-minis with respect to it. Couple of distinct, right, candlestick patterns. Hammer, right? It's a sign of reversal, right? When you see a downtrend and a hammer, whether it's upside down or right side up, doesn't matter. When there's a downtrend and you see a hammer, it's a sign of reversal. When there's an uptrend and you see a hammer, whether it's right side up or upside down, doesn't matter, sign of reversal, right? With about a 62, 68% probability, right? That still means that, you know, there's 32% chance it's not going to do what I expect it to do, right? So again, if I think, let's say I'm on an uptrend and I see a hammer, right? I think that it's going to reverse and go back down. I wait until the next day to see if it does go down, right? That's that confirmation piece, you know, with respect to it, right? You know, there's different names for hammers, right? So for example, if you have an uptrend and you have a hammer that's right side up, we'll call that a hanging man. In one of the books that you got 70 candlestick patterns. You know, those 70 candlestick patterns meticulously my son Michael did, right? You know, and they actually reveal what it means. You have an uptrend and a hanging pattern. It tells you what happens and it tells you what it means, right? You know, so this would be a hanging man. If it was reversed and it was black head and a long tail going down, that would be a shooting star, right? So there's different patterns. Okay, hammers. Downtrend and a hammer. Doesn't matter whether it's right side up or upside down, sign of reversal, right? Now, I'm not going to trade it until the next day when I see it actually reverse. But, you know, this is the rut from years ago. And you can say there's a hammer, right? There's confirmation it's moving in. And I would take confirmation over top of the high for that day. confirmation it's moving, and once it hits 680, man, it goes to 780. If you had played the Russell, played the IWM, or played the call on that, you rocked, man. Like literally, you know, in 6 weeks, you know, you made out like a bandit and made 300% on your money buying the call on the IWM, right? So we look at these patterns to predict, you know, should I be doing that trade or not, right? By the way, there's a upside down hammer, right? There's a doji and a hammer, sign of reversal, right? So we definitely want to make sure we get confirmation. And this is just me reminding you, you know, hey, look at downtrend. By the way, these are hammers and dojis. Downtrend, big hammer, right? What would you expect tomorrow to be? Uptrend, right? Because it's a reversal. 68% of the time it reverses and goes the other way, right? But I'm not going to trade it until I go to the top of the hammer and I see that next candlestick open above the hammer. If it opens above the hammer, which is the last price it did on Friday, if it opens on Monday above the top of the hammer, then I'm into the trade. Then I'm going with the direction, but I have to see it hit that. So one of my things that I do, and I do this regularly, I do this on flag trades, I do this on regular trades, is to say, if the Russell, if the Coca-Cola, if IBM, if the S&P, right, SPX, right, if it opens above this level, get me into the call position right away, okay? So I set the contingency to fire off, right? And that's one of the things you can do with a put, right? So you think the market's going to crash, you can pick a level of support that you think is, you know, hey, if it breaks here, it's going down. Like I know if the Russell goes below 1550, she's going down to 1500. I can literally say, if the Russell goes below 1500, the Russell goes to you know, 1549.50, right? Buy me an IWM and let me play the downside on the mini Russell on the IWM on a call, on a put, sorry, right? So we can set that, and I wait for that. And when it happens, get a beautiful uptrend, right? So we love, you know, seeing a hammer or a doji with respect to it. Major pieces are the doji and the hammer, right? They are a sign of reversal. They're a very great tool with respect to it. You don't have to figure this out yourself, guys. Cheat, right? What do I mean by cheat? All right, I gave you 70. You can kind of study them, and the way that I studied, those were actually set up to be flashcards, right? You'll see that there's 4 candlesticks on every page. You can actually go to Kinko's, you can go to Staples, you can say, hey, take these pages and make them into, you know, a quarter each and have them cut, and they become flashcards for you. That's really how they were created. They were flashcards for me and for my friends and family and other people as well, right? So you can use those, but there are 10, right, that you want to know, right? So here are the 10, right? This will be in the handout going out to you, you know, after the fact. But the 10 are, you want to make sure that you know the hammer and the doji, right? And the hammer and the doji become a shooting star and also a doji on the bottom. But you want to learn something called the engulfing pattern. And just to kind of give you a hint here, if it says bullish candlestick pattern, generally speaking, of the two, the last one, the one that just happened, right, is the one that tells you whether it's bullish or whether it's bearish. And so here we have a bullish engulfing, the very first pattern, right? The first pattern is black and the second pattern is white, right? And I kind of think of it as Pac-Man, that's how I remember it, right? And it's a bullish engulfing because it's eating the Pac-Man. It's engulfing the little one. So I remember, right, okay, a bullish one means the white is on the right-hand side and it's eating the black. If it's a bearish engulfing, which means it should be going down, right, it's black engulfing the white, right? And it's that last candlestick, you know, the one that we see that tells us whether it's a bullish or bearish. So this is a bullish engulfing, which generally means it's going to go up. A bearish engulfing generally means it's going to go down. Hammers, we already kind of know what that. Harami, Indian term, which means pregnant lady, right? Chinese term, which means pregnant lady. That's where it came from, right? So the harami, right? A bullish harami is a white small one, right? That's in the middle of a big black one, right? And it's bullish, right? Because it's actually a sign of reversal. Okay, a black harami or a bearish harami, right? Second one, it's a small little pregnant lady, right? That is that's bearish. Piercing just makes it look like it's going up or down. And if it's been going up and you get a piercing pattern, a black pattern, you know, that's bearish. If it's been going down, right, and you get a piercing, which is bullish, it means it's a sign of reversal. Okay? Right, these other patterns I kind of like. They don't happen very often, but they do happen a couple times a year. And that's a three white soldiers, which is the three white boxes, right? And then the three black boxes, which is three black crows, right? This actually happened a couple of times this year already. But what's interesting about these is you had three big down days, and what's important is day number 4, okay? You had three big up days, and what's important is day number 4, okay? Right? So this kind of gives you a hint as to whether it should be going up. So this is actually last 2 years ago, right? Around the December time period. Market is kind of crashing, right? And as it's crashing, you know, we can kind of see, right? Just hold on a sec. We can kind of see that we get three black crows, right? Okay, so when three black crows happen, the next pattern, whether it's below, at, or above, tells us what's going to happen to the marketplace, right? So three crows, generally speaking, right, is a downtrend, right? So it's a downtrend. So, but what's interesting is day 4, right? So day 4, it can open above, which would mean a reversal. It can open in between, or it can open towards the bottom, or it can open underneath. So there's kind of 4 things that could happen, right? So it is a sign of a downtrend. If it opens here, it's going to continue to go down, right? Highly likely it's going to continue to go down, right? If it opens here, right, at the bottom 1/3 of that third candlestick, right where it opened high, went low, and right at that bottom 1/3, right, that's where the candle is today. It's actually faking you out. It's going to continue to go down. It's profit taking. The guys who were shorting took some money, right? So this often fakes people out because they go, well, it's a doji, right? And which means it should go up, but it's a doji on the bottom 1/3, right? It's a candle, it's a hammer, but it's on the bottom 1/3. The head's on the bottom 1/3. It's profit taking. It's the guys that were playing the short side. They're taking some money. It's going to continue to go down, right? So we look for that piece, right? So we see this doji. What does it kind of mean? Right? See this doji, it's probably profit taking, right? It's going to kind of continue to go down, right? Now, if it does reverse, right, likelihood is, right, it will continue to go up, right? Now, this is what kind of, this is a bullish harami, right? A sign of reversal and literally should go up, right? So we know that kind of. Now, if it actually opens above the bottom 1/3, it's definitely a reversal. Doesn't matter what the candlestick is, it's a reversal based on the 3 down and the up. You get a nice bump from the buyers, you know, with respect to it, right? So it's definitely a sign of reversal. So this is December, right? I'm trading in December. I've got credit spreads on the top and the bottom. I'm worried about my bottom position. I see three black soldiers, or three crows, right? I see those 3 black crows happen. And this doji is there in the bottom 1/3 of the handles, or the hammer, of the 3 black crows. What does it mean? A doji normally means it should reverse and go the opposite way, right? But it's in the bottom 1/3. So what does that tell me? She's still, that's just profit taking. She's going to crash and burn, right? And she's going to crash and burn, and she crashes and burns in a major way, right? Thank God I knew that one pattern, because it saved me, because I was thinking, well, maybe she's reversing, right? You know, and then we get the, you know, another pattern, you know, another day down, and then we get this bullish engulfing. And what's the bullish engulfing? It's a sign of what? Reversal. So at this point, I know, geez, my put is safe, or if I want to, I can sell another put down there to move on to the upside, you know, and actually in the next little while, we see this stair-stepping kind of up, right? So it's always interesting to kind of see the 3 white soldiers or the 3 black crows, because what happens next is going to tell you whether it's going to go down like a rock or continue to go sideways or move up. You guys have 70 candlestick patterns. They'll send you the what I call the $1 million patterns, which are the bullish engulfing, the harami, the doji, the hammer. I used to have them posted on my wall right by my computer, right? So I can do it. There is a way for you to learn this, by the way, and some of you know this already. You can go to hotcandlestick, right, .com, and if you go to hotcandlestick.com, hotcandlestick.com, right, you can actually learn about candlesticks. If you look at some of the tools on the left-hand side, you'll see that they have some pictures of candlesticks. I have all 70 in the handout that you got when you signed up for this. But there's a cool little game at Hot Candlestick that I think you might want to take a look at, and that is the flashcard game, right? It kind of gave me the idea for flashcards, actually. But literally, it shows you 10 flashcards, and you have to pick what the pattern is. And you have to pick what the pattern is in less than 10 seconds, right? And you can play that game over and over and over and over and over and over. But literally once a week for years, I played that game to get good at it. Happened to play that game day before yesterday with somebody, hit 7 out of 10, right? So still doing pretty good on picking the can. And there's 70 patterns, right? So actually, did you guys enjoy that? Did you get some value out of that? Do you say you could trade a flag trade, a support and resistance, a piece? If you did, put your hands up nice and high. Let me see, right? I'm just going to set up the next one.
Yeah, you had mentioned there's a website that actually shows you the patterns as you're going along, aside from stock charts and hot candlesticks. What was that? Because I don't think that you had mentioned it.
Well, stockcharts.com, right?
Okay.
If you go there and you go to the tools in the top left-hand corner. In fact, can you see my screen still?
Yeah.
Okay. I just got to move things around here a little bit before we get back. Oops.
Yeah, and so this is the one that scans it for you too, right? At the same time, and as you're looking at the different stocks or
yeah, it's at stockcharts.com, right? Just gotta take a look, right? So on stockcharts.com, if you go over to the top left-hand side, you see this thing that says Charts and Tools.
Mm-hmm.
You go over to Charts and Tools and click on it. Here you can ask like, what's a head and shoulders, what's a whatever, right?
Okay.
But if you go down here on the right-hand side, sorry, right? You can go down here where it says predetermined scans.
Okay.
Right? Click on predetermined scans. And then these are all scans that it does, right? Right? So literally, these are scans based on technical indicators. We're not going to move into, but here's some moving average crossovers. Here's a breakaway up and a breakaway down. Here is engulfing patterns. Here is morning stars. Here's a double top, double bottom, right? So it gives you a double top, double bottom. It gives you a bottom breakout. It does all those patterns. And then it'll show you, here's a descending triple bottom breakout. There's 390 of them today.
Oh, okay. So if you click on it, does it actually even show you which stock it's looking at?
Well, you see where it says, right here, it says triple bottom breakout. There's 390 of them.
Right.
And then by topic, which is, do you want to take a look at the New York Stock Exchange? You want to take a look at the American? You want to take a look at the TSE? Right? Right? You can take a look here, over here, and then it'll show you the stocks that are doing that right at this moment in time.
Oh, okay. Awesome.
So here, like, let's take a look at TSE, right here.
Mm-hmm.
So that's what the fifth column in, right? Because I'm moving it up. I want to take a look at a double bottom breakout. And I know on TSE, there's 75 of them today, right? When I say today, it would be Friday because today is Saturday, right? But it will scan for that. It'll show you that. And then it's a matter of taking a look at that and deciding, is that something you want to trade, right?
Right.
That's on stockcharts.com,
Okay.
right? Okay. Cool.
Thank you.
You're welcome, right? Right. So gonna kind of keep going here, guys, right? Because I want to show you two kind of trades that are strong and powerful with respect to it. So that was 5 minutes, right? Okay. So talk a little bit about vertical spreads. Some of you guys already know credit spreads. Some of you are brand new to credit spreads. Some have been trading for a little while. But credit spreads, which is really a vertical concept, right? Is a great thing for day trading, right? It's a great thing for, the next November, December, and January, taking a position and getting a good rate of return on a position because we know the market's going to go up, right? So vertical spreads, a single option like a call or a single option like a put, that is a directional trade, right? A vertical, whether it's a vertical put or a vertical call, that's non-directional. And a call or a put, generally speaking, we are playing a direction. We're playing up or we're playing down. With verticals, we're playing sideways. We don't expect the stock to come down that far or to go up that far. Well, this can be a good opportunity for making passive income like a credit spread, but can also be a great opportunity, you know, when we think the market is going up or we think the market's kind of going down. Again, disclaimer, you know, past performance doesn't equal future performance. Investment does have risk. This is for educational purposes. This is to kind of show you what a vertical can do and how you can use it, right? But it literally, a vertical is two options artificially put together on the bottom or two options artificially put together on the top, right? So we can, on the bottom, play a vertical put, which is two options on the bottom, or on the top, we can play two options at the top. Now, here's my expectation. If I think the market is going up, I can buy a single call. And I can, as it goes up, I'm going to make money. Or, rather than doing that, leave that one alone, what I'm going to do is I'm going to sell, not buy, I'm going to sell a vertical put. Right? And I'm going to sell that vertical put below a level of support that I know it's not going to get touched. Right? So right now, the Russell's trading about 1625, as I recall. Right? So I kind of know it's got to go to 1600 and it's got to go to 1550. So I could sell two options below 1550. I could sell a 1540 and a 1530, right? And when I sell that, you know, on $1,000 investment, right? You know, I can make $100. I can make 10% on that by selling the 1540, 1530. And the only way I can get touched is if the Russell comes below the 1550. And it is going to expire in a period of time. And that period of time might be a week, that period of time might be a month, that period of time might be the end of today, right? So I have the advantage of knowing when it's going up, I can either play the call going up, which is a single option, or I can play the vertical put at the bottom. Now, credit spreads, you know, the thing that I'm pretty well known for, you know, we do a credit spread way out of the money. You know, we make 6%, 7%. And the likelihood is 9 times out of 10, we're not getting touched. But think about that for November, and think about that for December, and think about that for January coming up. Man, what happens? These are the best 3 months to invest. These are the best 3 months in terms of the market. So could I, right? Certainly I could buy a call, you know, for a 90-day or longer kind of period and benefit on the DIA or the Russell or whatever, or stock, and benefit from the best months, right? But there's a risk it's not going to go up, right? Could just go sideways, right? If I sell the put below that, my only risk is if it drops, which it doesn't typically do in November, December, and January. Are you guys with me? Right? So I could make 10% on my money in a month, right? It's 10% on my money on a month better than 6, 7% on a credit spread, right? So when I see the pattern, which is the November, December, January, right, then I'm going to be a little more aggressive doing a vertical put underneath a support level, right, which means I need to know if I'm doing a 30-day vertical call, you know, what does the Russell move in 30 days, or what does the SPX move in 30 days? If I'm doing it on a weekly, what does the SPX on a weekly do, right? What's an average move? What's the top and the bottom of the support level? If I'm doing a daily, it's what's the support and levels and what's that average price movement, right? So I still need to do the same thing in terms of average price movements. What's the movement? But I'm looking for the trend. Now, these options, if I sell them, right? If I sell them, right? You know, as long as it stays above that level, I'm good as gold, right? And it will expire. Both of them will expire in time. When I sell it, right? It does not cost me money to sell it. Money comes into my account, okay? So I'm selling something I don't own. Don't worry about that. Happens every day of the week, you know, on the stock market, right? I do need to have money in my account to be able to do this, right? So on the Russell, it'll be $1,000, right? If you're doing a $10 spread, you know, on the DIX, right? If you're, sorry, on the SPX, right? It's going to be, you know, it's going to be $500 for kind of one contract, you know? So if you're doing one contract, it's kind of $500. SPY, we can actually do you know, a 278 and a 275. So it's kind of a $1 piece, right? So depending on how much money you have, it would depend on what you're doing. Now, remember this as well. If you're doing something longer term, like the Russell, a DIA, or the SPX, or a stock, you know, and you're doing it for a month, you know, you can do this with no problem. But if you're doing this daily, right? If you're doing this daily, you do more than 3 of these trades in a week, you're going to get labeled as a pattern day trader, right? And if you're labeled as a pattern day trader, you know, you have to have $25,000 or more in your account at Thinkorswim, right? So just realize that if you're going to get into, you know, more day trading, you know, you're going to make sure you have 25 grand or more in your account. Otherwise, you know, you can get stopped from trading, right? So just make sure you, and Kevin, you're doing your head nod there, so you know that that's the truth. If I'm doing a long-term position, if I'm buying, I'm doing 90 days. If I'm doing a short-term position, I'm doing 45 days or less, right? So if I'm a seller of options, I'm doing 45 days or less, right? When we sell the covered call on Coca-Cola, we did 30 days, right? When we do credit spreads, we do 45 days. We can actually do a week if we're selling. We can actually do a day if we're selling, right? Especially if we're doing something like a vertical put at the bottom to play the downside, right? Now, just kind of talk about the vertical put so you understand it a little bit, and then I'll talk about the vertical call so you understand it. These are two options that are put together. Now, the way we look at these options, and if I get a chance, I'll go on Thinkorswim and show you a couple, but the way we look at these options is we don't see the underlying prices, right? All we see is, hey, I can make 40 cents here. All I see is I can make $1 here. All I see is I can make 10 cents here, right? So the Thinkorswim automatically combines these two options and just gives us a net price, right? So if I'm thinking about credit spreads, I might say, hey, let's get 50 cents here on the spread, right? Well, if I take a look at the underlying on this, and I'm talking about the Russell here for an example, a $10 spread, you know, let's say that I'm gonna do a vertical put, which is at the bottom based on a support level. I'm gonna sell a 620 and I'm gonna buy a 610, right? So literally what happens is in my account, I sell a 620, I get $4.50 comes into my account. At the exact same time I'm doing that, I buy a 610 for $4, which means a 50-cent credit comes into my account. They pay me. They pay me to own this position. I just got to have the $1,000 in my account, right? And the reason that's $1,000 is one contract equals 100 shares. And if you have one contract times 100 shares times a $10 price, then it's $1,000 you need to have on an account. If you were doing a $5 spread, right, you'd have to have $500 on account. If you were doing a $1 spread, you would have to have $1 on account, right? And that's the way they calculate the margin requirement for you to actually do that position. So if I'm doing the SPY, right, and I'm doing, you know, 278, 276, it's going to cost me $2, right, times 100, just $200 to take that trade. If I'm doing a $5 spread on the SPX, it's going to be $500 to take one contract, right? And it's a credit, it's coming into my account. So the kind of way we look at it is, you know, let's say I'm doing a credit spread on a Russell and it's a $10 spread like this one, right? $10 spread, you know, they're giving me 50 cents or $50 for 100, right? So that means they're going to take $9.50 out of my account, right? And put it on hold, right? They gave me the $50, but they're going to put $9.50 on hold until it expires. And when it expires, either I'm in the money or I'm not, right? So that's kind of how a vertical kind of works a little bit. And kind of what happens when you take this 50-cent spread, the sell says, I want it to stay above this level. That's really what the sell position is. The sell position is actually making you the money, right? You're selling this for $4.50. The buy position is actually protecting you. The actually buy position is protecting you that if it does go below this, you're not going to lose money, okay? Right? So the buy, we're expecting it to actually go up. On the sell, we actually make money if it goes below, right? And I'll kind of show you this as kind of a math thing in just a second so you kind of understand it a little bit. But the way we're going to do this is we are going to take a look at three things. We're going to take a look at the premium we're going to get, you know, which is the money they're going to pay us to take a position. when you're getting into dailies, you really need to know support and resistance, and you need to do average price movements. What does it move up and down, the stock, the index, whatever it might be that we're trading, the future, whatever, the SPX, whatever it is we're trading, what does it move, right? And you want to know what that average price movement is. Because if the average price movement on the Russell, you know, is $6 up, you know, and $15 down, you know, then you kind of know where you want to be, and you know where the support and resistance levels are, right? So we want to know what those price levels are. We want to take a look at what happens at Asia. So I normally will do a vertical put based on what I think the market's going to do, right? So here is October 16th, right? Got a bit of an uptrend, right? Europe's an uptrend, and the US is kind of uptrending. So I think it's going to be up, but I'm a little worried it might go sideways, right? Because Asia didn't fully go up, right? So I'm thinking, well, it should go up. I'm going to wait till 10 o'clock to see if it goes up. And my choice is buy a call, right? And buy that call on the DIA, buy that call on the SPX, buy that call on the Russell 2000, right? Could do it on a stock, but I'm probably going to do it on an index. Or, right, I can be relatively safe, right? And when I say relatively safe, I'm gonna do a vertical put on the SPX, right? And I could do the vertical put on the RUT, I could do the vertical put on the DIA, but I'm just gonna do the SPX. October 16th, when was that? Yesterday, right? Right, so I'm looking at futures in the morning, right? And I'm expecting it to be an up day, right? Right out of the gate, right out of the gate, you know, 9:30, it goes up. What do I know usually happens right out of the gate? It reverses. So I'm sitting there waiting for it to reverse, because it normally does that. Normally within the first, 30 minutes or so, it reverses. Even the first 45 minutes, it reverses. So I'm waiting for it to reverse, right? I did get a signal, which was the 5-day period, 20 period, to get in here. But I always wait till about 10 or 10:15 before I decide to trade. I want confirmation it's going in the direction it should be going. First 30 minutes, I'm going, oh my God, I'm missing out. Oh my God, I'm missing out. Oh my God, I'm missing out. But I don't trade till 10 or 10:15, right? And then at 10 o'clock, like clockwork, she friggin' reverses, right? Moves on the downside. Now it's supposed to be going up all day, right? It's supposed to be a big day up, right? But she starts to reverse and actually get a signal, that is the 5 period crossing the 20 period to get out. I'm not in, so it doesn't really matter, but I'm thinking about getting in, right? Then we get into lunch, and it does this little W pattern, right? And then we're getting into 1 o'clock, and I still haven't traded yesterday, right? So, but I'm watching, right? Just watching what's going on, right? And about 1 o'clock, right, I see a 5 period, 20 period buy signal, right? And I like to trade between 1:15 and 3:30, right? I like to trade because there's usually direction up or direction down. It doesn't tend to go sideways during that period of time, right? Right. So I take a look at the SPX. When I take a look at the SPX, which is very similar to the futures, they're very similar. This is the futures trade. You can see, right, if you take a look at this, there's kind of support, right, at 34.70, right? There's kind of support at 34.80 a little bit, right? There's definitely support at 34.50 or 35.50, 3,500, right? So we can kind of see this. And I know that the SPX, 40 points up, 40 points down, usually, 20 points or so moves to the upside, right? So I'm kind of looking at what's happened today. I'm getting a double bottom, right? I'm getting a triple bottom. I'm starting to move sideways at this 34.95. Can you guys kind of see that? Right? So I expect it to be an up day. Hasn't been so far, right? I mean, it did go up and then come back down, right? It's kind of moving sideways, which it does during the lunch kind of period, right? And then, as I'm doing this, I get a buy signal, and the buy signal is this one right here. Okay, 5 period, 20 period crosses, right? I know, typically, right, that it's moving between a certain level. I know 3,500 is a safe position, and I know that 34.75 is another support level, and it's kind of far away, right? So I'm pretty sure that they would be pretty safe if I sold you know, the 34.75 and the 34.70, right? Now, that's a $5 spread, so each contract is going to cost me $500, right? One contract cost me $500, but I'm selling it, so I get cash coming in, and I get 40 cents coming in, right? Which means what? On $500, what am I making, right? I'm making $40, right? $40 on a $500 investment, right? I think that's about 8%, right? Is 8%, and remember, this is 115, right? You know, it's 115, 130 is, you know, if I waited a little bit, it's 115, 130 getting into the trade, right? So I have, you know, 2 hours before 3:30, 2.5 hours, right? But kind of before 4 o'clock when it all dies, because the SPY or the SPX kind of dies at that period of time. Balance of the day, right? Kind of moves, nice solid up movement. And I'm sitting there with a 34.75 and a 34.70 position. Am I okay up until about 3 o'clock, right? So nice move up, right? Now, if I'd have just traded this on the upside, I could have just, you know, bought a call, right? Right in here, or traded the mini and just waited for it to X out, right? And I would have bought it, you know, down here at approximately 34.99, and I would have sold it in here at 34. That would have been a $5 move times $50. Would have been okay, right? You know, if I was doing the futures. Oops, sorry. If I was doing the futures. Then I get this signal to get out, right? And so I'm not sure why, but I didn't get out, right? And I think my rationale here was, well, it's not 3:30 yet. You know, 3:30 is kind of when I start to panic because it can go up or down pretty dramatically. You know, I'm just going to let it play out because I know it should go to 3,500 and bounce, right? You know, it goes to 3,500 and what does it do? Right? It goes right through 3,500. So now I know the next level of support is 34.95, right? Starts to hesitate here, right? And then breaks and goes to here, and then I get this hesitation and get this move down, which now I know it's going to 13.90. It's past 3:30 now. So at 3:30, there's only 30 minutes left, right? And then I'm going, well, in 30 minutes, you know, can it go from 34.95 down to 3.75? And that's not a typical move, right? A typical move down is kind of in $5 kind of increments, right? Okay, so it's not a typical move for it. So I'm just going to kind of wait it out a little bit and see if it goes, right? Now, could I have bought myself out of this position? Yep, anytime I felt like at 3 o'clock I could have bought out, 3:30 I could have bought out, might have lost a little bit of money, but, you know, I kind of believed that it wasn't going to go below, you know, that 380 kind of level because it tends to hang at that 380, 375, and that's why I bought the 34.75 was because it was below that 34.80, right? And sure enough, she friggin' goes down to 34.80 1 minute before close, right? And then bops up, right? So literally yesterday at 3:59, I'm going, really? I'm going to show this tomorrow. This is not my typical kind of trade, right? But it happened, right? And the nice thing is, it didn't go below that 34.80, which was that level of support that I bought below or sold below, right? So if we're going to do this as a day, if we're going to do this as a month, if we're going to do this as a week, it's really important that you make sure you've got your support and resistance levels there so you know where they are. And I knew that 34.80 was a strong support level, you know, so that it shouldn't. And actually, I actually thought that that 3,500 would hold, right? Because that's a major support level. And I actually thought the 34.95 would hold. And you can kind of see here, right? She's bouncing off 3,500. Right, when she breaks through, right, I'm expecting it to bounce like here at 34.95, which is another level of support, and she crashed. Now, this is one of the reasons, just to point this out, that usually if I'm trading between 115 and 130, I usually try to get out by 3:30. Because after 3:30, you never know. Because after 3:30, all the day traders are getting out, right? And that can cause the market to go up dramatically or go down dramatically, or it can go sideways, choppy really fast. A lot of volatility in that last 30 minutes. Now I hung in here just to hang in here, right? Because I was hoping and praying that that 34.95 was going to hold, right? And I hope and prayed that that 34.80 would hold, you know, but I already knew that the 34.95 was a strong position, and also knew that the 34.80 was a strong position. You can see right here, I have resistance lines and support lines on my chart, right? So I already know that that's a strong position, that's a strong position, that's a strong position, that's a strong position, because I've done this for the last week, seeing where the SPX kind of goes. Is this making sense to everybody, right? And we're playing that kind of direction, right? So we could have, rather than playing the SPX like I did, right? You know, we could have played the SPY. Right? So the SPY is in dollar increments, right? Now, this is not a real trade. This is actually a paper trade, but just kind of to show you, same thing. It is the SPX going up in that first hour, right? Reversing, right? And making a decision to get in about 1 o'clock. And about 1 o'clock, you know, I can see the Dow is up at 34.90, whatever. And the SPX, or the SPY, sorry, I meant to say the SPX. The XPX is at 3,490, and the SPY, which is the mini, right, is sitting here at 34. I just lost my mouse, right, 34.90, and I know that there's strong support right here, right, at 34.85, right. So here you can see, right, that I sold a 348 and a 347, and I got 10 cents, right? But it only cost me $1 per option, right? Times 100, which is $100, right? So this trade would have cost me $100, and I would have made $10 on the 100, right? And the commission, right, was $1, right? So could I have done a $100 trade? Yes. Could I have done a $500 trade? Yes. Could I have done a $1,000 trade? Yes, right? Now remember, I'm showing you this, but if you're going to do this 3 times a week, you're going to have more money in your account. And if you got more money in your account, I'd be trading some bigger positions. But 10% in a day, right, where I thought it was going to go up and it actually went against me, right? And at the end of the day, it didn't go down here. So we actually made out okay on this trade. So whatever you want to trade, $100, $500, $1,000, you can kind of trade it. There is the SPY, right? And you can kind of see the SPY, right, went down to 349, went back up, right, and then went down to 350, didn't come close to my 348, right? So even though this went down today, and I expected it to go up, if I do a vertical, it's a safer trade than playing the upside, okay? And if you can make 10% on your money on a Monday, make 10% on a Wednesday, make 10% on your Friday, if you compound that over time, you're doing incredibly well, especially when it doesn't go in the direction you expected it to go, right? Just got to make sure you know where that support and resistance levels are. Did that make sense to everybody? If it did, say, oh yeah, right? So verticals are great pieces. You know, you want to do it. You actually, as it goes up, you know, if I sold it for $1, I might be able to buy it back for 5 cents or so, right? So it can be a great trade, right? We also use verticals for credit spreads. About half of you are doing credit spreads, so I'm going to kind of stay away from that kind of concept with respect to it. But what I want to do is to show you a quick trade. That's a bonus trade. I know I'm running a little bit late there, but I want to give you this trade because it's a great trade, okay? This is kind of a bonus trade. It wasn't really in the materials with respect to it, but, you know, stocks actually gap every once in a while. And when they gap every once in a while, they can gap up or they can gap down, okay? What's interesting about a gap is most of the time when a stock gaps, right, it will revert back to the mean, which means it'll come back to where it was. And it doesn't matter whether it's an up gap or a down gap, right? Or it will continue on the trend. So remember we talked about a flag trade. In a flag trade, we play both sides. Well, on a gap, we play both sides. So what we do is we wait for the gap to happen, right? When it happens, and I guarantee today, if you go to stockcharts.com, you go to the little activity tools and you go to predetermined scans, you will find gap trades. Why do I know that? Because that's what I used to do to find my gap trades and still do, right? So when it gaps, right, which would have happened today for some stocks, it's either going to go back to where it was or it's going to continue down in a major way. It's not going to go sideways. The gap usually continues to go down or it reverts back to where it was because of news or whatever it might be, right? So I think this is Cisco, all right? I'm not sure it's Cisco, but I think it's, yep, Cisco, right? Has a gap, right? So you see the gap happen right here, okay? So literally on this gap, I have an open, I have a close, and I have a high and a low. So this day, when this gap happens, I find out what the top high was, and I find out what the low was for the day. Not the open or the close, but the high and the low, right? When I find the high and the low, what I'm going to do is I'm going to set an order that says the next day, right? Not today, the next day, and then this might be on a Friday night and do it on a Sunday. If the Cisco opens below, you know, if you take a look here, I can find out exactly what that is, but it looks like it's $42.50, right, or 43 bucks. If Cisco opens below $43, buy or sell Cisco, right? Now, if I was going to do a call, or if I was going to do an option position on this, if Cisco goes below opens below $43, buy a put at $43 on Cisco, right? So I'm going to buy the put on the downside. Now I have to give it a week or two to run, right? So I want that call position probably to be 90 days or greater, right? Because I want their time for it to move, you know, that week or 2 weeks. It usually takes about 7 to 10 days for it to move in the direction one way or the other. I'm also, at the same time I set that thing to say, if Cisco goes to 43, right, buy a put on Cisco at 43, I'm going to kind of look at what the top position is, right? And let's say that this is 44.25. Okay, so the top position is 44.25 on that gap day, this day right here. I'm going to say, if Cisco opens at 43.26, 1 penny over where it was when it gapped, right? Buy a call on Cisco at $43, for example, right? I want it to be 1 strike price in the money, okay? So what does that basically do? Well, I know that this is what the gap was. I know if it should continue to go down or it should reverse and go back to the mean, and I don't care which of those it does, just like the flag trade, I don't care which it does. If it goes below, likely to continue to go down, which I'll make money. If it goes above, likely to continue to go back to the mean, which I'll make money, right? And literally, once one of those fires off, now what else could happen? Well, on Monday, it could go sideways, right? Okay, but it can't go sideways forever, right? So 1 or 2 things is going to happen. Sooner or later, it's going to go below, or sooner or later, it's going to go above, or it's going to continue to go sideways. And if it continues to go sideways for 7 to 10 days, I'm going to get out of the trade, because there's no point in me waiting any longer. I'm supposed to make money within 5 or 10 days on this system, right? No more than 2 weeks, you know, 10 days, 10 business days, 2 weeks, 14 days. I want to get in or out of the trade within that period of time, right? So, and you guys can kind of see, you know, Cisco, you know, went from 43 down to 42, and then from 42, you know, went down to 41, and then went down to 39 pretty quickly, right? Now, if I had bought the stock, that's a $1, $2 move on the stock, you know, and the stock is at what, 35 bucks? $1 or $2, let's say $2 on a $35 stock, you know, that is about an 8% move in 5 or 10 days. On the option, that would be about 30 to 60% return on my investment, right? So when I do this, I'm going to buy or sell the put or the call on the gap trade, okay? And what I would encourage you to do is go to stockcharts.com tonight, go to the predetermined scans, right? When you go to the predetermined scans, look for gap ups and gap downs. Now, there's some rules about the gap, so let me kind of explain what the rules are, because you just don't look at the gap and say, oh, that's what I'm going to trade today, right? So here are some of the rules for the gap trade, right? You know, and there are some pieces that you'll be getting. I'm actually giving you some website support materials and a checklist and a lot of the things that I'm doing, right? So here are some of the rules, right? This is Cisco, right? 7 to 14 days is the normal trade period. Playing both sides, just like the flag trade, you know, with respect to it. You know, I can buy the stock on the upside. I can sell the stock on the downside, which would be shorting a stock. But I'm going to buy the call on the upside, and I'm going to buy the put on the downside. And literally, if it's 1 penny below the low, I'm in. If it's 1 penny above the high, I'm in. But literally, it's going to get me to both sides. And you can kind of see that moved fairly dramatically over time, right? Number one, you're going to look for the gap. When the gap happens, you want to see a volume spike, okay? So this is on stockcharts.com. You'll see the average volume that goes along at the bottom, right? You can put this on your Thinkorswim account or your other accounts, right? And you can kind of see, you know, what's the normal average volume, and you want to see a spike along with the gap. And the spike is going to be just a rough look. Is it 2.5 times what it is normally, right? Now you can actually go over and look at the volume and say, well, it was 100,000 and now it's 300,000, so it's 2.5 times. But I just look visually, is it 2.5 times where it was? So first I must see the gap, and then second I must see this volume spike, right? This is kind of one of the hints with respect to it. So I'm going to look for that volume spike, right? And it's got to be 2.5 times, right? And I'm also going to take a look at what the average price movement is, right? I want to know, is it moving up or is it moving down, and what's it moving up or what's it moving down, right? So what is the support and resistance levels? You know, what's the level there? You know, so I'm going to take a look to kind of see, well, it's a $5 move usually. That kind of gives me a target price to know, hey, it gapped and it could move $5 further down, or it could come back $5, right? So I'm going to kind of look for those kind of movements with respect to it, right? I'm going to kind of look for, is it 2.5 times the piece, right? Here's a nice piece. Not quite 2.5 times though, maybe 2 times. But here I have a nice piece here where she gapped, right? This is Apollo, right? Normally moves about $5 up and $5 down. And it is 2.5 times the normal volume, right? So Apollo would be a good piece. When you get into the trade, when the top side fires off, you got to cancel the downside. If the downside fires off, you got to cancel the top side. And I also want to make sure that I put in a stop, right? So if I'm playing the downside, the stop is going to be the top of the candlestick that was gapped. If I'm playing the top side, right, I'm playing the high, the stop is going to be the candlestick bottom that gapped, right? Okay, so literally, if you take a look here, Apollo, right? She gaps up, right? You got a nice volume spike. I think it's going to continue to go up. So I'm going to put a stop here. Once I get into the trade, I'm going to put a stop here at that 85 level, which is the bottom of that candlestick. So whatever the candlestick is, the opposite side is where you put the hard stop, right? Right. So, you know, this is Apollo. Nice. This actually happened to me while I was on a mentorship several years ago, right? And Apollo had a nice move back to them, a $5 move in 3 days. $5 move in 3 days on an $85 stock, not huge, right? But it was a 12% return on the investment in less than 3 days. If I had have bought the put, it would have been substantially more, right? So you can do this. This is another gap trade from the past, right? You know, and you can kind of take a look at this gap trade. You know, this is aluminum. I don't even know what that is, right? But it gaps, right? Then continues to go up. You got a $3 move in 5 days, a 10% return on the purchase of that stock, right? You know, you've got gaps that happen regularly, right? These are just some other gaps, but you can kind of see, man, 6.5%, 7% kind of piece. Now, where you're going to find these is at stockcharts.com. In fact, you know, one of the things you want to do is when you go to stock charts, right? You want to look for this charting tool, right? Top left-hand corner where it says charts and tools. And then once you click on charts and tools, I'm moving you guys, that's why I'm hesitating, right? You want to look on the bottom right-hand side and find this thing that says predetermined scans. Now, predetermined scans are different scans. You know, you can do this on a double top or a double bottom, but I can actually look for gaps, right? You know, and this is, you know, gap ups. You can kind of see that there's 59 gaps up, right? There's runaway gaps, which means that there's a big movement on the gap. We have gaps down, 86 gap down, right? There's 9 gaps down, 23 gaps down. So we just look at these and we pull it up, we look at it, and is there a gap? Yes, because we know there's going to be a gap, but is the spike volume 2.5 times? If it's 2.5 times, then we play it. One other piece with respect to this is you want to make sure that you have no less than a $5 stock, right? So no less than a $5 stock, so penny stocks you're not going to trade. And you need at least 100,000 shares trading each day, right? So you want to make sure that you add that to your rules. You want 2.5 times the spike volume, you want the gap, and you want to make sure that it's $5 or more. And you also want to make sure that you're not playing any kind of penny stocks, and you got 100,000 shares trading each day, right? And you find that on stock charts. Did that make sense to you? If it did, say, oh yeah. Now, just because I showed it to you does not mean that you're a master yet of that kind of trade, right? Right? So what you want to do is either go back in history and trade it, right? Or you can paper trade it moving forward, okay? So when I used to do gap trading, I used to look at what happened on Friday of every week, and I would trade it every Monday. I would trade 3 to 5 of them, right? And I would hold them until the next Friday, and generally speaking, in the 5 days, it either moves up or down or goes sideways. And if it didn't work, I would get rid of it, and I would do the next one the next Friday. There's always going to be a source of a gap trade. It happens regularly over and over and over with respect to it. But paper trade it, you know, so that you get kind of good at it with respect to it, right? So I want to kind of show you kind of quickly the 55 system, right, in the last 10 minutes or so, you know, so you can kind of see it. You know, so you can do it, and then we'll kind of wrap up for the day, right? So let me just get 55 for you. Run it a little bit long today. I hope that's okay for everybody, right? Right? Good, good. Now 55 is kind of a simple kind of system. Like I told you, I was golfing. I paid a guy $3,000 to learn the system back 22 years ago. You know, I've been using it for a long time, right? You know, and 55 is based on kind of moving averages, right? So we're not going to do a long-term trade. We're not going to do a medium-term trade, right? You know, 55 can be used for those, by the way. You can use it, you know, for taking a look at the Russell and seeing if it's going up or down, right? You can use it for taking a look at a weekly trade, but I use it for day trading, right? So the way I use it for day trading is taking a look at, you know, kind of short-term kind of trading. This is the Russell 2000, you know, the last few days of the Russell 2000, right? I can kind of figure out where support and resistance levels are on the Russell 2000. You know, I might do this on the SPX. I might do this on, you know, E-minis, you know, but I'm going to take a look at kind of the last 5 days and write in my support and resistance levels. I'm going to kind of write in, hey, what's the average, you know, trading range kind of on a daily basis? You know, what does it move kind of on a daily basis, right? And the way that this works is we're going to use 2 moving averages, but both of them are going to be 5-period moving averages. Notice I said period and not days, right? A period is the candlestick. Now, a candlestick may be a day if we're looking at a month chart, but a candlestick can be a few minutes if we want to set it up as a few minutes. Right? So literally, I'm going to do a 5-period high for the day or for the period, right? I'm going to do a 5-period low, which means I'm not looking at the open price. I'm not looking at the low price, right? I'm looking at the low price. I'm not looking at the open price. I'm not looking at the close price. You know, I'm looking at the high price. So it has taken 5 of the high prices and taking 5 of the low prices each period, which may be in a day or maybe a day if we're doing a month, but I'm going to look at those, and it's going to create a 5-period high and a 5-period low. The 5-period low, I code that as a green line. The 5-period high right? And would you guys like me to jump on Thinkorswim real quick and show you how to do this? Okay, I'll show you how to do it in a second. The 5-period high I do as a red, right? And this system's been around for decades, literally, and traders have been using it for decades. And it kind of works at, I've got a high and I've got a low, and I'm going to watch the candlestick, the price, to see if it passes through these positions. If it passes through the first position, I'm interested. If it passes through the second position, I'm getting ready to trade. Okay? On the downside, if it passes through the top position, I'm interested. If it passes through the second position, I'm getting ready to trade. So I can trade up or I can trade down a stock, an index, future, anything, right? Okay? So, and it does take this 5-period high and 5-period low, right? So let's take a look here. This is an entry point on the, gonna move you guys out of the way, right? So this is the low, right? And this is the high, right? It's actually reverse color coded, but this is the low and this is the high, right? So the first time that a candlestick crosses this, right? And I said cross it, which means it must close above it, right? Which is this candlestick right here. I'm interested. So when it crosses the low period, the 5-period low, I'm interested in the trade, okay? Now, it crossed, but it didn't go past the second line, which is the 5-period high. It actually stayed in the center, which sometimes is a sideways kind of pattern, right? It's a hammer, it's a sideways kind of pattern. And then we see that it crossed here to the upside, right? Now, because it crossed to the upside does not mean I get in. It crossed, which means I'm getting ready to trade. I have to wait until that next candlestick to trade. If that next candlestick is above the high, I get in. Okay, so it might be 2 or 3 candlesticks before I see it go above the high to get into the trade. Okay, and this is kind of a momentum, right? Kind of momentum-based trading. Okay, I will continue to be in this trade until it's time to get out of the trade, and the time to get out of the trade, right, would be if it breaks the first line, I'm interested. It's probably time to get out of the trade. Now, I have to tell you honestly, I combined candlesticks to trade this, right? But the system basically says, if it crosses the first line, you need to be interested to get out of the trade. If it crosses the second line and opens below the second line, you must get out of the trade, right? So here I got the first fire off, right? Here I got the second fire off. Here I'm into the trade, right? I'm into the trade all the way for the next periods of time, right? Now in this case, you know, this is the Russell 2000, right? Okay, I'm into the trade until, right, it breaks, that's interest, it breaks here, which is the second one, and then opens below, I must be out. I didn't say I should be out, what did I say? Must be out. And when it breaks that second line and opens below that second line, I'm out of the trade. Now, I had, you know, 7 or 8 good days of trading on the Russell here, so I made out okay, right? And I made out okay if this was a day trade and it was moving up, right? Now, how do I combine it with other things? What do I know this pattern here is? It's bearish because it's red, right? And it's, you know, in between the bullish, so it is a bearish harami, right? So it's telling me that the trend is over, right, based on the candlestick. So likelihood is I wouldn't have waited to get out here. I probably would have got out as soon as it broke this line because the bearish harami is telling me that. Hard system says wait until it opens below the line, right? Right? Here, right? Okay, let's play the other side. Now I'm thinking about, geez, I played the upside. Now I'm getting some indications about playing the downside. So here it breaks the first line, right? And when it breaks the first line, it actually breaks the second line too, right? So it broke both lines, right? So that's my level of interest. Then it opens below the second line. So if I was going to play the downside, when this candlestick happens, I would play the downside, right? Now the system says I play the downside until it breaks the two lines again, right? So, you know, here I would have played the downside, the downside, the downside, the downside, the downside, the downside, and I would have stayed into it until this happened, right? And then I would have gotten out of the position. But what am I seeing here from a candlestick perspective? Big candlestick, big candlestick, big candlestick, big candlestick, little candlestick, hammers and dojis. So what do I know I'm hitting down here? I mean, I don't have to wait for it to happen. I know I'm hitting resistance. Are you guys with me? Right? So system says wait until it goes through that second one, but I could have missed a few points here, and I probably would have got out right here as it started to go sideways, right? Because I'm combining a moving average system with my knowledge about what a candlestick does. Is this making sense to you? Right? So the better you become at using a moving average or using a candlestick, it will help you do better in terms of it, right? And that's really the 55 system, right? Now, when I say it's the 55 system, I'm actually going to go onto Thinkorswim so we can take a look at this. I'll show you how to set it up on your chart so you can do it, right? And then we'll actually take a look at, I'll go on to maybe, a day trade or something like that and see what happened, and then I'll kind of wrap up in the last 5 minutes. Is that okay with you guys? You're still good to go? All right, great. All right. So let's start with, I keep moving you guys in the way. All right, let's start with the chart, right? So, this is Thinkorswim. A lot of you have Thinkorswim. You can kind of see the charts on Thinkorswim. You can kind of see right here, I have a moving average kind of thing. I'm going to get rid of those just so we start fresh, right? So I'm going to say remove all studies so there aren't any studies on my Thinkorswim account, right? So just means they disappeared. They're still there. They're saved, right? Right? So let's say that I'm looking at the Dow and I want to see about trading the Dow using the 55 system, right? So the first thing I'm going to do is go up here where it says studies, right? I'm going to click on studies, and I'm not going to add a study, right? And there are lots of studies you can add. There's over 100 of them in there. I'm going to go to where it says edit studies, right? And I'm going to click on edit studies. So when I click on edit studies, it says, what studies, Jim, do you want to edit, right? So I'm going to go over to the little bar here, and I'm going to put in simple, because it is a simple moving average, right? I'm going to click where it says simple moving average, which comes up, right? And I click on it, and you can see it put a simple moving average there. I'm going to click on it again, because I want 2 of them, and I've got a simple moving average, right? Now, it automatically defaults to a 9-period moving average on the close, and that's not what I want, so I need to change these, right, to make them relevant to me. So I'm going to go over to where the little wheel is here, right? You guys are seeing me do this, right? Okay. I'm going to click on the little wheel. When I click on the little wheel, I'm going to see where it says close, right? And rather than having close, I want to have a high or a low. So I'm going to look for the high and the low, and I kind of know this already. The high and the low are hiding underneath the taskbar, right? So I'm going to click on the high, which means I'm looking at the highs for the day, not the close for the day, but the highs for the day. So I'm going to click on the highs for the day, right? I want this to be 5 periods, which is going to be 5 candlesticks, whether they're day candlesticks, minute candlesticks, or whatever, it doesn't matter. They're going to be 5. I'm going to move this to 5, right? So I have a 5-period high. Now this is going to be the top of the chart, right? And if I'm thinking about it being the top of the chart, I want it to be red. So I'm going to change this green to a red, right? Because that's my sign to get out, right? Then I'm going to actually, I moved you guys in the way again, right? Okay, I'm going to press OK, right? So I'm going to press OK, right? And you can see it changed it, right, to a 5-period. Now it looks like I put a 1 in there someplace. You see that? Shouldn't be in there, right? Yeah, accidentally I did that, so I'm going to make that 0 again. It's just a 5-period. I must have clicked something by accident. Press OK, and I got a 5-period high, right? Now what I'm going to do is go over to the little wheel again, right? And I'm going to change it. Now this time I want it to be the low, which I know the low is also up there. So I'm going to move that little taskbar to find the low. I'm going to click on the low. I'm going to move it from 5 days or 5 periods or 9 periods to 5, right? And because it's the bottom position, you know, I kind of want it to be green, so I'm going to kind of leave that green in there, right? See, there's that green in there already, right? So I'm going to press OK. Now this is the important piece. Once I do this, I want to say Save Study, right? And I want to put in a name, right? So I'm going to name this 55 system, right? So it's a 5-period high and a 5-period low. You can put 55. I really don't care. Whatever it is what it is, right? Right? It automatically applies it, but I can press apply it and I can press OK, and immediately I get lines that are 5-period lows and 5-period highs. Okay? Now this is the Dow from July through whatever. It's telling me to buy the Dow, get out of the Dow. Buy the Dow, stay in the Dow, get out of the Dow. Play the downside of the Dow, play the upside. So literally I could do this to look at the Dow or the SPX on a longer term, like daily, right? You know, or, you know, if I wanted to, I could go to my trade tab here. I could go to active trader, right? When I go to active trader, right, you can kind of see that this is E-minis, no longer the Dow, right? And you can see that there's a 5-period, there's a 520 here, right, which I can use. And I also have saved this already, right? So I can get rid of all the studies, right? Yes. And then I can say, okay, let me load a study set, right? Load a study set, and you can kind of see 55 systems there, right? So it tells me when to get in, right? When to get out, play the downside, when to get in, when to get out, when to get in, when to get out. And I wish I had played 55 directionally, right? Because I could have made a ton of money as she crashed and burned it on Friday. As it was, you know, I made the SPY and the SPX on the vertical put, but that would have been a great piece. So that's 55 system. Great system, play with it. What I suggest that you do is you paper trade it on a stock. If you want to do dailies, like trade for a week or a month, right? You'll see it gives you a buy signal. Or if you want to, trade it on the SPX or the SPY to see what happens to that piece, but it will give you. Match it with the overnights, right? Right? If you match it with the overnights will tell you you have a bias to the up or a bias to the down, right? And you want 1% or greater, right? And then you want to use 55 to tell you when to get in, right? So, guys, I went a little longer than I expected. Is that all right? If you guys enjoyed that, you know, you can unmute yourself and say, good job, Jim, because I wouldn't mind, you know, that as my last comments for kind of the day. I did a good job, or give me the thumbs up or whatever it might be.
Well done, Jim.
Yeah, there we go, right?
Always great stuff.
Yeah, great stuff. So
Thank you very much, Jim.
Did you learn something you didn't know?
Oh, absolutely.
Did you see 1 or 2 problems that you're doing right now that by using some systems, you can be better at trading?
Absolutely.
Right? Did you learn 1 or 2 systems that you didn't know existed that now you know existed, whether it's a weekly or a monthly or whether it's a daily, that you know you can make 10% on a day even though the market didn't go anywhere, right? And doing a vertical with respect to it. So I hope you enjoyed that. I certainly enjoyed the last couple of last week kind of building this, it taking all my skill sets and kind of putting it into trade. First time I did it, so give me a big yes, you did a good job, Jim. Right? Awesome. If you want to, send me a testimonial, video, audio, doesn't matter, a little writing a note saying, hey, that was a great day, right? The video will come out in the next 24 hours, and all of the slides that have data and information on them, you know, like the system and, you know, get in here, get out there, you know, that's all getting into the note slide, and you'll get a copy of that, you know, so you'll have notes as well, right? So when I talk about, you know, the matrix, you'll get a copy of the matrix. When I talk about here are the steps on the covered call, you get all the steps on the covered call, you know, so you'll get all of those as part of the download. I enjoy spending time with you. I'm happy to stick around for the next 20 minutes or so if you want to ask me some questions, but the course is over today. Give me a big applause, and we'll see you next time, guys. Thank you.
Thank you very much, Jim.
Thanks, Jim.